Hello everyone and welcome to today's session on investment banking. Investment banking is a specific branch of banking that helps businesses to raise funds and provides them with financial advice and support. It provides substantial financial advising, capital raising, government and financial institution services, financial and risk management services, and to help enterprises. The main role of investment banking is to provide assistance to firms, governments and high net worth individuals in expanding their businesses by acting as a medium that handles the complete procedure of analyzing and evaluating the business and will also manage all the documentation work involved in the process. It requires financial modeling and valuation. Investment banking analysts and associates spend a lot of time in creating financial models and utilizing various valuation techniques to advise their clients and close agreements, whether for underwriting or M&A activity. The average salary ranges around $100,000 and with years of experience, you can even earn millions of dollars per annum. So before we dive deeper into this exhaustive session on investment banking, do not forget to hit the subscribe button and click the bell icon. Let's have a look at the agenda for today's session. We'll start with introduction to what is financial system and how financial systems work. Then we'll study about structure of the financial system. Moving ahead, we're going to discuss about various ways of raising capital. Then we'll learn about types of bonds on collateral basis. Moving ahead, we'll discuss about interest rate and its impacts on bonds. Then we'll have thorough introduction to money market. Then we'll deepen our understanding about features of money market. Moving ahead, we'll discuss about capital markets versus money markets. And at the end, we're going to conclude our session with investment banking interview questions.
Let's begin with a simple example of a company named ABC. Suppose ABC wants to merge with another company. How will it know that the other company will be beneficial for it? Or how is it going to raise the desired funds? And who is going to handle the complete documentation and help in figuring out new investment plans? Well, the short answer to all these questions is an investment bank. Investment banks play a vital role in making a company go big by acting as a risk taker or say middleman. Typically, investment banking focuses on two main areas. The first one is the M&A advisory and next we have underwriting. So M&A advisory stands for Mergers and Acquisitions Advisory. It is the process of assisting corporations and institutions in locating, evaluating and completing company acquisitions. Underwriting is a procedure used by banks to get funds from investors for a client, mostly in the form of equity or debt securities. Now let us move on to the next topic, which is how do investment banks work? Investment banks are divided into two types, the sell side and the buy side. Now the sell side shares of newly issued IPOs, provides market making services, places new bond issues and assists customers with transactions. Coming to the buy side. The buy side on the other hand trades securities such as shares and bonds in order to maximize profits. It collaborates with hedge funds, mutual funds and pension funds. Now let us take a look at the careers available in investment banking. Investment banking jobs are among the most desirable jobs in the financial industry. As an investment banker, you will be expected to assist the clients in raising funds and expanding their businesses. Though it is not that easy to get into the domain, once you make it through the journey, the results are really rewarding. The average salary ranges around $100,000. With years of experience, you can even earn up to $500,000 per annum. The main role that investment banking demands is to provide assistance to firms, governments, and wealthy individuals in expanding their businesses by acting as a medium that will handle the complete procedure of analyzing and evaluating the business and will also manage all the documentation work involved in the process. The world of investment banking is not for everyone to live in. This job profile comes with a very high competition and extremely tight working hours. But the financial perks offered are unparalleled. You will live a very fast-paced life and deal with exquisite clients while enjoying a lifestyle that others can only dream of.
So let us see, when we talk about the financial system, what are the different things in the financial system or what are the different elements of a financial system? So first of all, in any financial system, first of all, there are participants, then there are markets, products and services. So you'll say participant means what? So participant means it could be bank, it could be mutual fund, it could be insurance company. All these particular participants ultimately work in a place called market. So right now, let us talk in a very simple manner that if I talk about a capital market, where they do work? They work on a stock exchange. So stock exchange become market for us. So if I have to do any particular transaction, it is essential that I will have to have a trading account, which is ultimately linked to either Bombay Stock Exchange or National Stock Exchange, and that becomes the market. Product. So product could be anything. Suppose if I'm dealing with an insurance company, it would be insurance product. If I'm dealing with a stockbroker, it would be the broking services. If I'm dealing with a bank, it would be banking services. So products and services would be there. Just in very simple word. So nothing great in this particular slide. Now let us move further. And you can see in the top and at the bottom, there are two words which is mentioned in the slide: indirect finance and direct finance. Before I actually go as per this slide, let me just give you an overview that in the entire financial system.
Let's have a quick quiz question, guys. And the question is, which of the following is not a tab in Excel? And your options are View, Page Layout, Quick Access, and Data. Please mention your answers in the comment section below.
What is the basic idea about the capital? So suppose if we talk about any particular private company which becomes a public company, which means now it is a corporate which is listed, let us say Tata Motor or Reliance Industry, these are the listed company. So essentially I am just giving you a very raw idea so that ultimately you start visualizing the situation. The moment you start thinking like a story, like a visualizing situation, you will be in a more better position to understand all the ins and outs of that. That will help you later on dramatically. So when I say that any particular company requires capital, the first question is, why does a company require capital? The company already is very big in size. Why does it require capital? So as an individual or as a company or as a country, if anyone has to go beyond a particular point, if they have to grow beyond a particular point, then the own capital is not always sufficient. They have to get some extra capital if they have to expand their business in any particular manner. So if I have made up my mind that as a company, as a promoter of my company, I want to expand further, I have two prominent ways of raising the capital. One is called equity capital and another is called debt capital. Now, what is this equity? Equity is nothing but own capital, which is my own capital. And when I say debt capital is not nothing but borrowed capital. Still, if it is not making sense to some people, sir, what is this own capital, borrowed capital? Let us go further in a very simple manner. I have today a company. Just listen as a story. I have one company, which it is Tata Motor. 100% ownership of Tata Motors is with me. I am say like Ratan Tata and I have 100% ownership with me. Now I thought I want to raise say like 1000 crore or say like 5000 crore or 10,000 crore of money from public. So there are two methods. Either I go to a bank and borrow the money. Another method is I don't want to borrow the money. I want to go into stock market, into the area of stock market and get money raised through the public. So what I will do, I will say that I will dilute stake in my company.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.
I will sell certain shares in my company. Let us say 10% of my holding, I will dilute it in favor of the public. So it means now from future months onward, I will have only 90% ownership in my company. And the 10% ownership is ultimately diluted in favor of different public. So there are public across India. They will ultimately subscribe shares of my company in the process of IPO, which is called initial public offering. After that particular IPO is over, these particular shares will get listed on the stock exchange and then they can decide whether they want to own the share or they want to sell the share. So once they bought the shares of my company, now I am not 100% owner in my company. I am 90% owner in my company. So who is 10% owner? The public. So it means the money that I've got from the public, this is called equity capital, which is nothing but the own capital, which was earlier my own capital. Now this own capital belongs to some outsider. Now, what is the point of raising money through equity? When you raise money through equity, there is not a compulsory requirement that you have to return back this capital to the public. Let us say that we raised 10,000 crore from the public. Is there any compulsion that we have to repay this money to the public? The answer is no. You can hold this money for any number of years till the company is in existence. Your money is with you. So ideally, we can say it's a very, very, very long-term capital. Whenever we talk about capital, we have to identify whether the capital is long-term in nature or short-term in nature. Imagine if you have a short-term capital, there is always pressure to repay that capital. But if it is long-term, you don't have to worry. You know that in the long term, we will grow very well. We will make a lot of profits. Our company will double in size, triple in size. So no, nothing to worry about. So basically, this is a long-term capital. Now the question is, you have raised money from the public. Is there any obligation to pay something to the public? Whenever the company raise money through share, and company makes profit, the company has the option to pay to the shareholder dividend, which is nothing but distribution of profit. I'm repeating once again in simple word, the company has the option to pay dividend, but not a compulsion to pay the dividend out of the profits of the company. It means that so far you are clear that this method of raising capital is very long term in nature. You do not have to return back the capital. Only the owner of the company has sacrificed certain stake in the company. Let us say 10%, 56 stake is gone, but he got the capital permanently, and there is no obligation even for any particular payment of dividend also. He may pay, he may not pay, whatever is the situation. And of course, if the company does not make profit, for example, currently you can see Paytm, Zomato, these are listed companies and they are not making profit. So they are not under obligation to pay dividend, because if then there is no profit, how they pay dividend? Now let us go to the other part. That is basically the company has started raising money by borrowing from the bank. So if you borrow from the bank, first of all, there is a definition that ultimately after a certain tenure, a certain duration, you are under a compulsion to repay that money back to the bank. There is always a compulsion. Suppose if I bought a 10-year loan, so after 10 years, I'm supposed to return that money. If it is a 5-year loan, I have to return after 5 years. So there is a compulsion with regards to repayment of capital. The second is, against this borrowed money, there is a specific interest tag. Let us say that I borrowed money from bank at the rate of 10%. So whether I make profit or I make a loss, I am under compulsion to make the payment in the form of interest to the bank. Imagine if you are already making a loss and still further you make payment of interest to the bank, that interest will ultimately compound your loss further. If suppose if my loss was 900 crore and I'm making 100 crore of interest payment, my loss will get accentuated. It will enhance by another 100 crore and it will become 1000 crore. To certain extent, ultimately the debt becomes a problem. Now the question is, if debt is a problem, then why to raise money through debt? Always keep raising money through equity only. Beyond a particular point, no particular promoter will like that he should keep diluting the stake in the company. Today I raised money by giving 10% stake. Again, might be after 2 years, I will again sell my 10% stake, but there will be a certain limit beyond which I do not want to sell the stake. And if you're not able to sell the stake in your company, then how come you are going to raise the money? So that is a very important point, that you have to strike a balance. Later on, when we further advance and we study any particular thing related to finance, that time I will explain you that ideally what should be the debt to equity ratio for the purpose of raising the capital. There are certain ideal standard that has to be followed for the purpose of striking a balance between the capital raised through equity and through the debt. Now let us come to this slide. That was just a background explanation, but now let us come to the slide. So first of all, on the left side, means in the yellow box, you can see that there are certain people who are basically providers of finance. These people are providing finance. So one is called lender. So lender obviously would be like financial institution. It could be bank. It could also be an insurance company which can lend money. Now, suppose somebody say, so insurance company, how it lends money? Understand the business of insurance. Insurance company collects crores of premium from the people, but the claims does not comes all of a sudden. The claims would be say like 1%, 2%, 5% as per the claim history. It means whatever premium they have received, ultimately they have to grow that particular premium. They have to generate some profit out of that premium. In other words, we can say that crores of money which is received a premium, these insurance company will be investing. So investing means what? Let us say they say that they want to lend the money. So to whom they will lend it? They will not lend to public. Usually the insurance company will lend the money to the government of India. So government Government of India is also borrower. If you come on the green side, on the right hand side, you will find under the borrower, just the second last entity is government. So government in India, I personally feel, is the biggest borrowing entity, because to run a country you need the maximum amount of borrowing. So government of India maximum borrows, and the maximum lending that is done, I feel that it is like insurance company, that too particularly LIC, sometimes even more than the individual bank that the LIC would be lending. Apart from the lenders, you can see there are savers who are giving money. So you will say, how savers give money? Savers deposit the money in the bank, and ultimately these deposits by the bank is given to the people in the form of loan. So that is the reason that even government encourages people to save money, because if you will save money, then only you will deposit money. If you will deposit money, then only banks will be able to give loans to other public. Imagine a situation, a country that a person does not want to save. They say, I will live today. I do not want to live for the future, live in the present. And I'm not going to save any single penny. How the bank will get the money? And if the bank is not getting money, how do we lend the money? If they are not able to lend the money, how the corporate world will grow? So this is a complete cycle. That is the reason that in under Income Tax Act, different area, we keep on getting certain tax benefit, that if you save this money, you will get this tax benefit and so on. So these are the certain lender, these are the ultimately borrower. In between, you can see there is a financial market. So whenever the money goes, it does not go from lender to borrow directly. It is channelized through the financial market. So we say financial markets, what banking, you understand very easily. Let us say I was talking currently about a company, say like Tata Motor. So all those people who have saved money, let us say if Tata Motors come with an IPO, so what does the Tata Motors will do? It will take money from these particular people by issuing a certain share, which is called IPO. And once these particular shares get listed on the stock exchange, ultimately it will be given to those particular people who are investors. They will be the investor who will start holding the shares, buying the share, or trading the share, whatever be the case. This year, it is anticipated Tata company is coming up with one big IPO. I think it's Tata Technology, not Tata Consultancy, Tata Technology. That is expected that this year it is going to hit the market, which is going to be one of the biggest IPO. So this is about the direct and indirect finance. IPO is nothing but initial public offering. If you go by the name, initial public offering. Again, read that particular word, initial. What is initial? First time. Public offering means what? I'm offering to the public. What are you offering to the public? The shares in my company. So I'm asking the public, these are the shares in my company. I'm coming for the first time to the stock market. Would you like to buy the shares? If the public shows interest, then they will subscribe to the shares of the company. As you have seen in the year gone by, Zomato, Paytm, many companies, Nykaa, many companies have come to the market and they have listed the stock exchange. So this is nothing what we call IPO. If already a company is listed in the market and still further they want to raise capital, then we don't call IPO because it's already listed. IPO means what? Initial public offering. Now it's no more initial. Then we use the word called FPO, which means follow on public offer. So already the public offer was done earlier. Now this is a follow on to that. So we will say it is a FPO. So in mostly IPOs come in the market. FPO are quite rare in the market. It's not that it does not come. It's quite rare, but mostly we will see in the market, which is called IPO. Yeah, the direct finance simply means that if you go to the bank and you directly take money from the bank, or you can say that through certain particular financial intermediary, you are basically taking. What is intermediary? Let us say it is a bank. So one person gives money to the bank, that is the depositor, and you go to the bank and you take money from the bank. So basically it is just through the bank that these two people are connected, borrower and lender. This is called indirect finance. When we talk about the direct finance, which is rooted through the financial market, that is basically called as a direct finance. So for example, IPO. What is happening in the IPO? Ultimately, people who have saved money, they ultimately give it directly to the company. What happens in the IPO? You do not give to someone else. You fill up the application form, the money goes directly to the company. So that is the reason we say it's a direct finance. You're not saying that I'm going to give it to X person, then the X person will give it to Tata Motor. If it is Tata Motors IPO, you are directly giving the money to Tata Motors through the IPO route. That is why we say it's a direct finance. So now we move to the next part. Basically, what are the functions of a financial system? So you can read it. I'm not again going line by line, but basically, if you see in the bottom, we have tried to ultimately correlate different entities with each other. So suppose if it is stock market, bond market, short-term fixed security market. What is short-term fixed security market? Any particular instrument like bond, which is issued for a very short period of time. So it might be for 6 months, 1 year. There are different short-term maturities market, which we will discuss. What are those instruments? So those instruments also form part of the financial system. And ultimately there could be banking sector, there could be government, and ultimately all this particular money, whether it is from stock market or from the banking or from the bond market or from the government, ultimately it goes to whom? To the firm. We say firm, so what do we mean by the firm? Firm is nothing but industry is nothing but, in layman term, we can say a company. So a company can raise money through any of these modes. Definitely any particular company will raise, let us talk this because right now Adani is very prominent company because of its news. So Adani has hit the market for shares also. There are shares which are listed, so they got money through shares also. They have certain bonds which are listed in overseas market, so they got money through bonds also. They have borrowed money from the Indian banks and multinational foreign banks also, so it means they have got the money from that source also. So this is a very ideal example where they have tapped money from different sources, and all these sources collectively, when they give money to that, we say all these are part of the financial system. Normally people get confused that when we are talking about a financial system or when we talk about capital market, it is just stock exchange. Not necessary. Later on you will see that capital market includes even commodity market, foreign currency market, interest rate market, banking sector, any particular thing which is connected with the capital raising activity or capital lending activity or capital formation activity. All this collectively is called basically a financial system. So that was just basically given here. We will talk more about the financial system. So now we see about the structure. We talk about the structure. First term that we encounter is financial instrument. What is financial instrument? Very simple word: shares, bonds, debenture. That is instrument. That is the any particular instrument through which you raise money. That is called financial instrument. Financial regulator. Of course, I will talk later on also, but just to give you a fair idea, financial regulator is nothing but a particular body for every specific sector, which ultimately governs certain laws, which lays down the terms and condition, which tells that if somebody is in violation of those terms and condition, then what would be the panel provisions applicable for them, which could be very harsh as good as say like imprisonment also, or fines or penalties, or somebody could be completely like thrown away from the markets also. They could be delisted also. Anything could happen. That is the role of the financial regulator. So in simple words, we can say that ultimately the investor protection is the primary objective of the financial regulator. The second thing, whatever companies are doing, that should be completely transparent. For example, if the companies are preparing their accounts, so whether the account statements are transparent or not, whether they are properly audited or not, all this is also one of the duties of the financial regulator. So I will touch upon this part later on also, but I hope the point is clear. When any particular sector is having a regulator, the investor is confident that ultimately money would remain safe for one simple reason, because everyone is working as per the regulatory norm. So right now, many people will ask, can we trade or speculate or invest in cryptocurrency? So the very basic answer is, if you want to do, no one can stop you. But ultimately, there is a great amount of risk because it is not regulated. So if it would have been regulated, then I would say, yeah, the risk is always there. But yes, to a large extent, there is no counterparty risk or no default risk because it's regulated. But currently, that particular segment is not regulated. So if anybody is doing any transaction, it is at his own peril, it is at his own risk. So that is the basic about the point is not about discussing about the cryptocurrency. The point is discussing about the financial regulator. The third is financial market. So now, by and large, you've understood when we particularly talk about a place through where you are raising money, where things are getting traded, that is called the financial market. So it could be a stock exchange, it could be just a common place, it could be a banking place. That is called a financial market. Financial participant, all those people who collectively participate in this financial market are called financial participant. For example, in simple word, investor, borrower, lender, raiser, issuer, banks, mutual funds, all these are nothing but the financial participant. And financial services, as we discussed, and more we will discuss later on. This is just given as a gist on this particular slide. More detail we will discuss it. The financial services, it could be like broking services, depository services, merchant banking services, underwriting services, and also one of the important things that we will discuss later on, it is investment banking services. So right now we are talking all basic thing because it's part of the financial market. Later on we will study investment banking. That also becomes one of the prominent things about the financial services. Now you can see here in detail, we are going to talk one by one. So first of all, first thing first, Financial participant. Who are the financial participant? It is given investment bank. Currently, I'm not talking what is investment bank. At a proper time, I will discuss in detail with example what is an investment bank. Up in financial market, you have retail and corporate banks. Then you have mutual funds and hedge fund. Just briefly, what is hedge fund? Hedge funds are unregulated entity, and basically they give services to HNI. What is HNI? High net worth individual. Usually the hedge funds come from advanced countries like USA and UK, and the mandate of hedge fund is that whoever HNIs have given money to them, they are expecting super normal return. They don't mind even if you put the money at.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.
Big risk. So for example, those people may come, they may short in the market, they may take exposure in a commodity cycle, they may take exposure in some alternative investment. They can do anything. There is nothing regulated. But the objective of hedge fund is ultimately they had to generate super normal return. In the event of doing that, there can be a possibility that even they can lose significantly the investors' money. So investors are ready for that particular situation. They say, but we want returns which is super normal in nature. That is the role of the hedge fund. In India, we do not find India-owned hedge fund. But in India, the hedge funds that are operating, that usually comes from the overseas country. Next, we have the government. So you'll say government is also financial participant very much. Government companies are listed. You know that a lot of public sector undertakings are listed. Government borrows money. We have government banks also. We have government insurance company also. So government is also in a big manner a financial participant in the system. Stock exchanges, I don't have to tell, but yes, I just want to say prominently in India, we have two exchanges, Bombay Stock Exchange and National Stock Exchange. But apart from that, we have a lot of regional stock exchanges also. So for example, in the class I've seen one person, I think is from Kolkata. So we have a Kolkata Stock Exchange. I think there are other stock exchanges south also, but the activity on those stock exchanges is very, very minimal. Almost no activity. So even within BSE and NSE, if you go by the volume, what is the traded volume of each day? National Stock Exchange has the highest trading volume every day. I think it would be 3 to 4 times more as compared to the Bombay Stock Exchange. On the contrary, the Bombay Stock Exchange is the oldest exchange in India. I think it started operations in 1979, and somewhere in 93 or 94, National Stock Exchange started. But National Stock Exchange was more technologically oriented. It was the first stock exchange which started on online screen-based trading activity, and now it has got the maximum number of trading volume on a day-to-day basis. Coming to the depository part, so depository, more detail we will discuss. We have one slide dedicated to that. But depository simply means that whenever a particular person is holding shares in electronic form, in digital form, which technically we say dematerialized form, that is nothing but a depository is required. So you need to open a depository account where your dematerialized shares are stored. Just to give a idea that why are we talking about demat. So in older days, like prior to 2000, most of the Indian shares were in physical form. So what do we mean by physical form? So let us say that if today you want to see the insurance policy, you still can see the insurance policy in physical form. But tomorrow when insurance policy also become dematerialized, the word is coming dematerialized. What is dematerialized? The anything where you put D, it means that thing gets over, means the material is getting over, and you are converting that particular physical activity or physical form into digital form or into electronic form. That process is called dematerialization. So now in today's scenario, almost, I don't have the exact statistical record before me, but I can say that almost 99% or even more than that shares in the stock market are completely dematerialized. They are held in demat form only. So when you hold shares in demat form, transfer of shares from one person to another person becomes instantly. It does not take time. It happens on a real time basis because now we are doing the transactions based upon the internet. But go before 2000, when shares used to get transferred on a physical basis, so it used to take 2 to 3 months to get transferred from one person to another person's name. I've seen that era also when my grandfather or my other relatives used to hold shares in physical form. So 2 to 3 months is used to take. It means in enormous time used to be taken for transferring shares from one place to another. So because of all this electronic mechanism, now Demat has become one of the very important activity, and within 2-3 years maximum, all insurance policies will also be held in the Demat form only. Currently also you can hold insurance policy or mutual fund units as an option. It's not compulsory. Even mutual funds you can hold in Demat form, but in future everything will be completely in digital form only. Let us move further now. When we talk about other things like other participants, so you can see retail investor. I don't have to speak much about it. You know that insurance and pension companies. So there are a lot of insurance and pension companies. Mostly pension companies are related to insurance only, but there is a separate another thing which is called NPS, new pension scheme, for which we have a separate altogether place only where we can start creating pension for our olden days also. Registrar is nothing but if you have heard the name of Karvi, some people are from Hyderabad side also, so definitely you know Karvi because it started operation from Hyderabad. So Karvi is a registrar. Registrar work is just to hold all back office activity on behalf of the company. For example, let us say it's the Reliance Industry. So who are the total shareholders of the Reliance Industry? Each shareholder is holding how many shares? Ultimately, if the company says dividend, then posting the dividend or sending the dividend to the individual's bank record, sending the annual report of the company to each individual shareholder. If there is any particular meeting of the company, then sending the intimation or notice of that meeting to individual shareholder. All this back office activity on behalf of the company is done by the registrar. So sometimes we say registrar, I would add one more word also to that. Sometimes we call registrar and transfer agent. It is nothing but RNT agent, registrar and transfer agent. One example I'd given Carvi. Another prominent example is called CAMS. This is a listed company in the market. It is called CAMS. Apart from that, there are many other small and big companies, but these are the two prominent companies which does the work of the registrar. Then you have the clearing houses. So clearing house simply means that, of course, we will in detail, I think in the second, third, fourth module somewhere, you will see the detailed procedure of clearing and settlement. But right now, clearing simply means that whenever basically you sell the share and somebody else buy the share, ultimately through the stock exchange, all this goes to the clearing house. And on the clearing house, this transaction will get cleared, and then only the person will receive the share. So it is not that if I sell the share directly from my account, it goes to the buyer's account. It will go through the process of clearing mechanism, and then only the other person will receive the share. It is just like, suppose if you give a check to someone. So what happens? The other person deposit the check in his bank account, but from that particular bank, it goes to the clearing house. At the clearing house, it will be identified whether the check is genuine, the date is put proper, the signature is matching or not, whether the concerned person's bank account has a relevant or a sufficient balance in his account or not. And once everything is okay, then they will say, yeah, this particular check should go through and the other person account will be credited. The same thing happens in the stock market or in any financial market, that whatever transaction has taken place, it has to be verified. That has to be done in a clearing house. And once it is passed from the clearing house, then ultimately the other side of the transaction takes place in the buyer or the seller's account. Broker, intermediary, simply intermediary, that is, we can say middleman. Like whenever you do a transaction, you have to do through a broker. You cannot say I'll directly sell to another person. You have to get registered in India with a particular broker. I hope you almost everyone must have heard different names like India Infoline or Sher Khan or Motilal Oswal or Geojit Financial. So these particular broking firms act as intermediary. They provide you the trading platform. You have to get registered with them through proper KYC norm, and then you can start trading and investing through these broker. Custodian, mostly in India, you will not find the concept of custodian in the context of investor, but the role of the custodian is simply to safeguard or safe keep the assets on behalf of the customer. So let us say if I am talking in the context of mutual fund. So what does the mutual fund do? The fund manager holds the cash basically in the bank. Let us say that I have invested in X mutual fund, say like 1 lakh rupee. So 1 lakh rupees goes to mutual fund, but mutual fund owner or the mutual fund manager does not keep cash with himself. He park that money with the bank. Now out of that money, he buys certain securities in the market. So when he buys certain securities in the market, those securities are also not kept with the mutual fund. Just like you keep the money in the bank, similarly you keep the securities with the custodian. The idea is that the ownership and management should remain separate. trade. Otherwise, there can be a chance that people can trade in those securities because they are having access to that security. So they can trade it for their own individual benefit also. So that is the reason they keep it separately. Another example would be, suppose if some foreign investor or foreign institution investor, typically we call it as FII. FII has to come to India and invest. So that FII will not come into India. They will just register. They will be in USA, but they will set up a desk and they will appoint a custodian and they will give all the payment authorization and whatever they have to hold the shares on behalf of them, that right to the custodian, and custodian will act as an intermediary for holding the shares and bank balances on behalf of the FII. So I hope the custodian word itself tells you it is coming from the word custody. And I hope everybody understand what is the meaning of the custody. That is to keep something in our custody. That is called the custodian. So this is something about. Let's move and see one more thing now. When we talk about financial market, you see there that below capital market, money market, FX market, and derivatives market. Everything we will discuss in detail. But when we talk about capital market, mostly we are talking about, say, like you can see below the capital market, primary market and secondary market. What is primary market? Whenever the company hits the market for the first time, that is whenever they launch any particular share or bonds, that is called basically the primary market. If you want to make the primary market more successful, then the company should think about going into secondary market also. That means it should get its shares and bonds and debenture listed in the stock exchange. If you get that thing done, it means then your primary market is also very active. In simple word, if I know that if I am buying a particular company shares or bond and eventually it will be listed, so I know that I can ultimately sell the shares on the exchange. But let us say if somebody raised the money through bond or through share and it is not listed, then I would think, what is the point? How would I get the price discovery? How will I find a particular buyer? How can I dispose this particular share? How can I realize money out of it? How can I make profit out of this transaction? So then people will not be interested. So it's very important that secondary market is nothing but, in simple word, it is called stock exchange. That is called secondary market, a place where you can get different numbers of buyers and sellers for different prices, and eventually you can offload the holding that you have bought in the IPO. And you can see in the secondary market below, it is both for debt market and for the equity market. I hope by now you are clear what is the meaning of the equity market and what is the debt market. Equity market in simple terms is nothing but stock market, or very commonly where people call it as share market. That is called equity market. Now we go just beyond capital market. There is a concept called money market. Next is money market. Again, for money market, we have separate slide, but in short, money market means any instrument which is issued for a period of less than 1 year. Those instruments are called money market. For example, of course, we'll discuss in the slide. For example, it is a T-bill, that is Treasury bill, or short-term government security, or commercial paper, or call money. All this is part of the money market. So for the time being, you can just understand that money market instrument are those instruments whose maturity is not more than 1 year, whose maturity is within a period of 1 year from the date of its issue. Those particular thing is getting traded or are getting issued in the money market. The third is FX. FX is nothing but foreign exchange market. So foreign exchange market is a very big market. You again have a very detailed thing about FX market separately, but very interestingly, FX market is a market which is 24 hours working everywhere. It is not stopping anytime. It keeps on working 24 hours. Might be in some place it would be working by this and that time. Other place it would be this and that time. But overall, if you see, FX market is active for the 24 hours, because you know that 24 hours different countries have different time zone, and anyone has to make payment at any point of time. So that is the reason that FX market is working. FX market does not mean, foreign exchange market does not mean just making payment. Even people may trade in the foreign currency. Even people may basically take exposure in the foreign currency derivative market. Even people can go for the hedging in the foreign market, that we will see in the derivative thing. And last is the derivatives market. So derivatives, very detailed study we have. Derivatives can be for stock market, derivatives can be for commodity market, and derivatives can be for foreign currency and even for interest rate also. And if you go to USA, country like USA, You will be surprised to know, if you already know, it's well and good, but if you don't know, you'll be surprised to know even weather conditions prediction is done through the derivative market. There are a lot of futures related to climate. So somebody can say that I am predicting to today it will be heavy rain, or today it will be a sunny day. That also is basically a part of the derivatives market in USA, because it's a very matured market. India is a evolving market. It's not a matured market. Might be in future. Today we may surprise, but in tomorrow, tomorrow means in days to come, we will see that in India also we can have such kind of a product. Below you can see, when we talk about money market, all these items are given what are the money market instrument. Gradually we will see all this in detail also. So please understand, when we talk about the stock market is not an instrument. Stock market is a place. For example, let us go to a different place. I have vegetables and I have fruits. So vegetables and fruits are what? Instruments, because I'm selling them. If I am selling vegetable, so where I have to sell the vegetable? Either I will sell it online, or I will sell in an actual market, which is called a physical market. So it means that market is one thing, and in the market, what you are selling, that is another thing. So when we talk from the capital market point of view, if you're talking about bonds or share, what is this? This is similar to vegetables and fruits. It means you have to sell these particular things. But the question is, where are you going to sell them? So you sell them on the stock exchanges. So stock exchanges is nothing but, I can say, listen carefully, it's a platform for selling and buying these instruments. What are those instruments? Shares and bond. Now the question is, what is bond? So bond is nothing but company does not want to raise money through share, but the company says we want to borrow money from the public, and after a certain time we will return the money to the public. So when they raise money through an instrument where they want to return money in the future, that instrument is called as what? Bond. If you are taking money from the public temporarily and you will return it back, why somebody would give you money if you don't give them any return? So you will say, just as you keep your money in the bank, you get interest for that. So if you're giving money temporarily to us, if you're borrowing money from the public, we will also pay certain particular interest to the public. And until then, until the maturity of that bond, let us say that the bond is for 10 years. So till the maturity of that particular bond, ultimately that bonds, if they are listed, then the person should not wait for the maturity. That person can sell that particular bond also on the stock exchange. So I will repeat once again. Stock exchange is not an item. Stock market is what? It is a place. It is a trading platform. It is the place buy and sell the share. And what is bond? It is an instrument through which you can raise the capital and people can invest in the bond for the purpose of getting a regular flow of income, which is in the form of interest or debenture. These days, you do not get anything in physical form. Have you ever seen that you're holding a few shares of any particular company in physical form? The answer is no. It means the shares are reflected in digital way. It is reflected in electronic way. Your demat account will tell you that you are holding 100 shares of Reliance Industries. You cannot see them. It just tells you in number. So where this digital transaction is done, or where these particular shares are digitally stored, it is stored in a demat account. In order to open a demat account, you have to go to the depository. So in India, we have principally two depository. One is called CDSL and NSDL. Once you get to a broker, let us say, I'm just taking for example, you are doing a transaction, say like with India Infoline. So India Infoline will ask you that, do you want to open a demat account? You will say, yeah, I don't have a demat account. Please open it. So once you open a demat account, that India Infoline will have a tie-up either with NSDL or with CDSL. There are only two DP, or we can say depository participants in India. Either of this particular will give you a platform to have a demat account. And in future, whenever you purchase the shares are ultimately getting credited to your demat account. Because in practical life, neither the shares will be in your hand, neither the shares will be in the broker's hand. The broker will purchase on your behalf and ultimately it will transfer to your demat account. So that is basically the depository thing. Similarly, when you sell the shares will go out of your demat account and it will get credited to the person's demat account who has bought shares from you. It will get credited to that particular person's demat account. So in short, demat account is nothing but way of electronically holding the shares.
Let's have a quick quiz question, guys. And the question is, making a forecast can be done with regression by using what method? And your options are multiplying coefficients by expected values of x, dividing coefficients by expected values of y's, dividing coefficients by expected values of x, multiplying coefficients by expected values of y's. Please mention your answers in the comment section below.
If you want to make a career in data science, Then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective as it is taught by IIT professors and industry experts.
Okay, so I move to the next part now. And now you can see on this particular slide, financial services. The first is called fund-based services. So what is fund-based services? One is called leasing, mutual funds, housing finance. This is fund-based. Fund-based means all these are nothing but there is a particular fund. Like for example, when we say mutual fund, so it is a collective pool of money that is basically called mutual fund. This is called fund-based services. What is fee-based services? Where there is nothing involvement of a fund, they give you some services and for that they charge you certain fee. The most common example is like broking operation. So in broking, what does the broker does? He does not have any goods to deal with. He will just say, okay, you take my trading platform, do the buying and selling, and for every transaction that you do through me, you will have to pay a certain brokerage fee. So in that case, this is just a fee-based services. Similarly, you can see portfolio management advisory services, portfolio management or advisory service. What does the portfolio manager does? He will charge you a certain fee. So there are two ways. One is called fund-based services. The most common example to understand is like mutual fund. And what happens in mutual fund? It does not charge you advisory fee directly. What does the mutual fund does? Mutual fund will run its operation. It will incur certain expenses. It will make some profit, and the profit will be reflected in the form of NAV. And if you get the higher NAV, you make a profit as compared to the purchase price. That is basically the fund-based process in the services. Moving further, now we know more about this. Already you can see all these things we have discussed earlier, but still now individually, what are these different participants? We will talk about that. So first is issuer. So I'll just have an entire slide here and then we can discuss about it. So first of all, when we talk about issuer, what is the meaning of the issuer? Any person or any entity which is issuing shares or which is issuing bonds, that particular entity is called issuer. So let us say that if Tata Technology tomorrow gives shares to the public, so it has become an issuer. Let us say Government of India raise money through bonds among the public. They say we have bought Power Finance Corporation bonds for 6 years. So who is issuer now? Government of India is the issuer. Let us say the bank says we want some short-term money. There is shortage of deposits in the market. So we want to raise some money through the bonds. So it means that what is the bank? Bank is nothing but the issuer. So in short, we can say that what is the role of the issuer? To raise the capital. Any person can be an issuer. It can be a private company, it can be a public company, it can be government, it can be some individual company. So any particular person can be an issuer. So they will have the responsibilities of issuer are as follows. Obligations of the issuer of security. Like for example, they say we have raised the bond. So for every bond that we have raised, how much interest we will pay? This will become the obligation. If they have raised shares, not the bond, then money raised through the shares, they will be under obligation to pay dividend whenever they make profit. So obligation means as a moral obligation, not a compulsory obligation, but a moral obligation that if the company makes profit, they will pay certain dividend. Reporting financial condition. Whenever a company gets listed on a stock exchange or whenever you issue shares or bonds to the market, ultimately there is a regulatory requirement that every quarter you will have to give a disclosure of your quarterly unaudited result, because results of the company are audited once in a year after the close of the financial year, but every quarter you will have to give a disclosure of unaudited financial result. So apart from that, there can be many disclosure, like for example, who are the directors of the company, who are the auditors of the company. If the company has raised finance, then they have to disclose how they have utilized that particular money. Let us say if I say I am raising 1000 crore and the purpose of raising 1000 crore money is this and this. Ultimately, after a certain period, you have to disclose whether you have utilized the money for that particular purpose or you have spent it somewhere else. So there can be many such things. I'm just discussing 2-3 things. You have to keep on timely reporting about many things which is required as per the regulatory standards of that particular industry. And last is operational activities as required by regulation. Let us say if the company is into certain operation, for example, if the company say like into mining business. So basically in the gone by year or in by gone by quarter, how many tons they have extracted something from the mine, what have they done for the ecological balance or for the environmental clearance purposes, because they've extracted so much of coal. in which market they have sold the coal, whether they have realized all the particular sales in cash or there is something outstanding. If any particular litigation is there with respect to income tax or GST department, what is the outcome of that? So there can be many things which is related to the day-to-day operational activity that too has to be reported, apart from the general thing like what is the profit the company has made, how much loan company has borrowed, whether company has repaid any particular loan. All those particular things they have to show as per the regulatory standards. When we talk about further issues include, already I told you, but you can see here again, issues include government. Issues include investment trust. For example, if you talk about the mutual fund, so mutual fund also issue. What the mutual fund issue? Mutual fund issue units. Mutual fund does not issue shares. What does the mutual fund issue? Unit. Whenever the mutual fund comes with any particular mutual fund for the first time, we do not call it as IPO. We call it as NFO, new public offer, or you can say new fund offer. Normally we say it is a new fund offer. So investment trust is nothing but, in simple words, as a layman, we can understand that we are talking about a mutual fund. And similarly, issues include private corporation, because companies are very, very prominently raising money either through issue of shares or through bonds, etc. And let us go. Issues can be, you can see domestic, international. So domestic means domestic company. If it is international, it can be international company. Let us say that suppose if there is a particular Indian company, an Indian company wants to raise money in USA. You may ask, why in USA? Why not in India? Because right now, let us forget, currently we are in a very exceptional situation. But 2 years back in USA, the interest rates were close to zero. So suppose if you want to raise money in USA, as a private company, you were able to raise money at the rate of 3 to 4%. So if I think from US point of view, if Indian company is raising money in the US market, then it is which issuer coming to the market? International issuer. It's not a domestic issue, it's an international issue. So many times we raise money outside the country also, because the cost of funding is quite less in the outside market. For example, just let us talk about the bullet train project in India. You know that the bullet train project is between Ahmedabad and Mumbai. I think to the best of my knowledge, it is between Ahmedabad and Mumbai. So now for this particular project, there is a lot of capital required, and this particular project is funded by Bank of Japan, or you can say by Government of Japan. More appropriate would be by Government of Japan for another 50 years. You know what is the interest rate? It is 0.5%. Not 1% also, it is just 0.5%. So it means we have raised this capital from an outside country. One government has raised capital from another government at 0.5%. So what kind of issue this is? This is an international issue, because it is not within the country, it is outside the country. So this is an international issue. I hope the point is clear. When we talk about the demand side, so when we talk about the sell assets to get financing. So sell assets means what? If I sell shares in my company to the public, what I'm doing? I'm selling the asset. Till now, I had the complete ownership in my company. But if I sold 10% stake in my company, I'm selling the asset. Why? Because I'm having deficit funds. What is deficit fund? I'm having shortage of fund. I think that my company should grow, but for growing that particular company, some funds are required. What I will do, I will sell certain stake in my company. One very interesting example I would like to share. I hope if you are aware a little bit about the news, you will able to recollect it very nicely. During COVID time, when all the companies were getting slowly into problem because businesses were closed down, there was one particular big company in India, Reliance Industry, which actually completely repaid its debt. It was carrying a 1 lakh, you can say 1 lakh crore of debt in its books, and it ultimately paid that particular debt when the COVID started. When the COVID was first wave of COVID, when it came, I guess it was March 2020, and everyone was in problem. But this company ultimately became completely debt free at that time.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.
Basically, Reliance Industries ultimately took a loan of 1 lakh crore from the market for setting up a company's infrastructure for Reliance Jio. You know that Reliance Jio was a telecom company, that for that reason it took it. Now the question is that they wanted to repay that debt. If they don't repay that debt, they will carry the interest portion. If for 1 lakh crore, they will have to keep making interest payment, which will be in crores of rupees, which will reduce the profitability. So they sold a certain percentage of stake in this particular company in favor of, if you remember now, to Facebook owner. You know who is the Facebook owner. So to Facebook owner, basically they sold a portion of Reliance Industry, and whatever valuation they got, based upon that particular valuation, they ultimately were able to repay the loan of Reliance Industry. So this is the point that I'm telling. The company sold its asset. What was the asset? The ownership in the company, a very minor ownership in the company to an outsider, so that ultimately they get completely rid of that loan. Whether the management is still having ownership, yes, they are the maximum shareholder. They are the biggest shareholder in Reliance Industry. So it hardly makes difference for the day-to-day running of the businesses. They are still the biggest owner of the company, but ultimately today they are zero debt company. On the contrary, you can see that Adani has started piling up the debt. They are borrowing money. I think their borrowed money is in excess of 2 lakh crore. And today you see what is the share price effect. Whether it is because of Heidenberg or for whatever reason, 70% of the shares value have been wiped out. So the point is, ultimately, sometimes it makes sense that you sell your asset and get out of the loan cycle. You repay the loan so that you become quite light in terms of your payment obligation. That is the basic point that I wanted to discuss here. Let us say about the investor. Do you know what is investor? When we say any particular investor is buying shares of any particular company, what is the intention in his mind? So there can be only two intention. Either basically, if he's buying a particular bond of a company, then he just want to get interest income. So basically, he has only interest income intention. He just want to get a fixed interest. Somebody may argue, if interest is only the objective, then he can park the money in bank deposits also. In bank deposit, you will get lesser interest rate as compared to if you give your money to the company which is raising it in the form of bond. So suppose, if example, I'm not saying that exactly this is the interest rate. In today's scenario, if a bank is giving you 6% interest for 1 year fixed deposit, similarly, if you have there is another bond in the market, it can give you from 8% to 12% return. It depends upon the company profile, whether the company is good or bad. If the company financials are bad, it will have to pay more interest rate. If the company's financials is good, it will pay you less interest rate. That is a basic funda. If the company is very good, they will pay you less interest. If company is very bad, then it will have to get more interest to get the finance available. The second objective of the investor is, when the investor buys shares of a company, so there can be again two objective. Buying the shares of a company, two objective. One is get the shares in the IPO and just sell it for to make some quick profit. That can be one objective. Another objective is, if you want to create wealth over a period of time, which technically we call it as capital gain, then you will have to buy the shares of good company and hold it for considerable amount of time, and you will get sufficient wealth. So basically, if we go by the history, the maximum wealth is created in the equity market if you get good company shares and you hold it for very long term. If you don't hold it for long term, then you cannot create the wealth. So for creation of wealth, it is very important that you create for very long term. Somebody may say, if I keep my money in bank fixed deposit for very long term, then can I create wealth? No, in keeping money in bank deposit can only create interest income. It cannot create wealth. So what is the mean difference between wealth creation and between interest income? Interest income would be a fixed amount of 6%, 7%, 8%, 10%. But when we say wealth creation, it will not grow in percentage, it will grow in times, number of times. That my my investment of 10 lakh has multiplied by 5 times, 4 times, but not suddenly. It will multiply over a period of time because of the stock market factor. So that is the basic objective of the investor. You can see what are the goal are basically the capital gain, how to make a investment in any company. So basically, you have to rely on the fundamental analysis. There are a lot of fundamental analysis factor, like what is the price to earning multiple, what is price to book value, that we will see in a separate chapter. So based upon the fundamental analysis, you try to figure out whether a company shares is undervalued or it is overvalued. If it is undervalued, a very common thing, you will just buy the share to make some profit or capital gain out of it. If it is overvalued, you will not buy that particular company share. So that is a simple thing. Next, When we talk about market participant, the was one thing given is, unlike speculation, which is often short-term and active in character, buy and hold investing is passive over the long run. So there are two methods. One is like continuous churning the portfolio, buying and selling. So who does this activity frequently, buying and selling? Trader. Trader means what? Any particular person who has entered this capital market with the intention of doing some speculative activity. So these people are called trader. And there's another person who is an investor. So he bought some good multinational company stock or good blue chip company stock, say like Reliance or Tata or similar like that, and holding for 5 year, 10 year. So if this company will grow, and if you are an investor in this company, obviously your wealth will also grow. So it is like basically you are doing a kind of a transaction with Mr. Ambani if you are holding Reliance Industry share. It means that if the fortunes of Mr. Ambani will change in favor, or will improve for better, ultimately you are also owner in the company because you have bought shares in that company, so your fortune will also improve. Now how much it will improve, it depends how much you have invested in the company. If you have invested a significant chunk, the wealth will also grow significantly. If you have invested just very few number of shares, 5 share, 10 share, to that extent your wealth will grow. So it all depends what amount of participation you have done into the company. Next point you can see, they largely base the investment through fundamental analysis, already that we have seen. And the third is buy and hold approach, as its name implies, holds that investors will purchase stock ownership in a firm and hold on to these stocks for an extremely long period of time, typically measured in year. So whenever we hold investment, it is for n number of years. I have seen in my circle, particularly in my friend circle or in my relative circle, that people are holding shares since last 20, 30 years. Company shares like Hindustan Unilever, ITC, GlaxoSmithKline, Procter and Gamble, Nestle, Colgate Palmolive, Infosys, Wipro, TCS, Bata, all these particular company shares have grown over a period of time like anything. I personally, I can witness 2, 3 company shares. Like for example, I have seen Titan. I hope everybody knows Titan. Titan share I personally bought when I was in college days around 25 rupee. And I guess today's that particular share price is around 2000 rupee. Might be it is like in 10, 15 years. I don't know the exact number here. So this is like from 30 rupees stock, it has grown to 2000 rupee. This is not income generation. This is called wealth generation. But suppose if I would have invested in FD, then it would not give me this kind of a phenomenal return. It will only give me a steady income. So it depends. You want a steady income or you want to multiply your wealth. Accordingly, you will take an exposure to the relevant asset class. Moving further, when we talk about the regulator, so you know what is the role of the regulator. So I'm not going as per line by line, but basic objective is there should be smoothness in the operations of all the companies which are operating in that segment. So just for example, let us say, I'll give my live example. Suppose few years back, there was one X company and I did not get the dividend from that particular company. So I wrote a mail to that particular company that you have declared dividend in this month. Now I'm 4 months away from that particular time period and still I have not received the dividend in my bank account. I sent the mail, no reply. I sent a follow-up email, reminder email, still I got no reply. Then I went on the SEBI's website and I posted my grievance that I am not getting the dividend and no reply from the company management with regards to non-payment of dividend. Again, in next 15 days, I just got a reply to my email also, and the dividend was also credited to my bank account. The point that I'm trying to make is that because of the regulator, the investor can feel comfortable that ultimately in the market, if anything is happening not as per the practices or as per the norms or as per the rules and regulations, then regulator will come into picture and it will take care. So when we talk from banking point of view, basically the regulator is RBI, Reserve Bank of India. When we talk from the capital market point of view, the regulator is SEBI, Securities Exchange Board of India. Let us say you are buying an insurance policy. So you have this particular doubt in mind that whether at the time of claim, whether the company will pay the claim or not, insurance claim will be settled or not. So if you have done everything perfectly from your side, you have not done anything wrong. If your claim is genuine claim and you have paid the premiums in time, then the company is bound to pay the claim. If it does not do that, then anyone can go to the regulator and regulator will take necessary action against that particular insurance company. So for every sector, real estate, pension fund, mutual funds, capital market, banks, foreign currency, commodity. Every participant or every activity of the capital market is regulated by something or the other. And that gives a great confidence to the investing public that nothing wrong is going to happen with their hard-earned money. So that is the basic thing about that. So I could say in simple word, investor protection, proper rules and regulation, compliances, proper transparency, disclosure, good code of conduct. All these are very important when it comes to the regulatory part. Moving further, custodian bank already we discussed. So something here it is given in simple word. You can just read it out, but I will just explain in my simple word. So custodian banks usually are normal banks only, but sometimes it can happen that actually they are not into banking activity and they are still acting as a custodian. But usually if you see, for example, Citibank or say like SoftBank, these particular banks, they have commercial operation also, and they have a separate custodian work also. So now you know what is custodian. Like they are basically safekeeping the assets on behalf of some entity. Somebody bought the share, and instead of holding the shares with themselves, they have kept it with the custodian. So this has become the custodian. So custodian is that. So you can see on the right hand side, assets held in such a manner are typically owned by large institutional firm. So like you and I, if we are buying share, we are not keeping our shares with the custodian. We are keeping our shares in a demat account. But if it is a very big institution, say like mutual fund, pension fund, some sovereign fund, or let us say foreign institution investor, then they don't hold shares with them or in their individual demat account. They appoint a specific custodian, and the role of that particular custodian will be to hold these particular assets with utmost safety. And whenever it is required, then they will transfer it to the relevant person. So this is what examples are also given, like banks, insurance company, mutual fund, hedge funds, and pension fund. So that is about now you can see on the screen brokers dealer. So just a brief about the brokers and dealer. Who are the brokers and the dealers? We have discussed enormous time. Basically, an entity which basically accepts order on behalf of the buyer and seller, and they give the platform to transact through their particular trading platform. So, just a simple example: I opened an account, let us say with Anand Rathi Stockbroker. So I will ask Anand Rathi Stockbroker either by calling, or they will give me an online trading platform that I want to buy certain quantity of certain company share, or I want to sell certain quantity of certain company share. This a particular activity of buying and selling, which is done through a particular broker. So broker will charge me a certain fee. Why? Because this broker is ultimately affiliated with a particular stock exchange. It is registered on a stock exchange, and it is basically a broker of that particular exchange, and they have to pay a certain fee to that particular stock exchange. It is not that anyone can become a broker. There are certain eligibility norm. You have to become a broker. For that, you have to pay some annual fee. And now this particular broker has set up a lot of infrastructure, appointed employee, have a lot of surveillance mechanism, and he's accepting orders from the public. So in order to recover all these costs and to make a certain profit, the broker will charge you a certain brokerage. These days, the brokerages in India are very, very competitive. But earlier there was brokerage as high as 2% of the transaction volume. So suppose if I traded say like for 1 lakh shares, not 1 lakh quantity, I'm saying 1 lakh value of share. So I will have to pay 2% of 1 lakh as a brokerage in olden days. Means I'm talking about when things were not online, when people used to transact physically by outcry. You can, if you have watched a movie called Guru, or in case if you have watched a particular web series 1992 Scam, which is available on Sony Live, then you can just understand how the transaction used to happen in those days on the floor of the stock exchange. People used to shout and say that this particular company shares like 1000 rupee, 500 rupee. If another person want to buy at higher price, then he will shout at a higher price. So that way it used to happen in those days. But now everything is basically electronically. And because of COVID, now many people have even started doing online trading or online investing. Instead of asking the broker by phone calling, now they have started placing the order themselves by going online and ultimately logging in through the account and doing the transaction for themselves. So this is something about the broker and dealer. See with some pictorial presentation what is that particular thing. Here there is a client. The client goes to the broker, and the broker ultimately places the order, and the securities are traded. Now there is one concept called dealer or principal. What is a dealer? Dealer is nothing but a person who places your order into the system. Basically, when you say buy certain share or sell certain share, so this activity is done by certain person. That particular person is called as a dealer. that person will be called as a dealer. Technically, we call it as a dealer. So this is the meaning of the entire broker, agent, or a dealer activity. Yeah, you can say principal, but most oftenly in common language, we don't say principal, we say dealer. Similarly, here you can see broker and agent, but usually we don't say agent. Might be for our understanding, we will say agent. Normally, you will call in the entire India brokers only. Broker, sub broker. If there is another broker below a broker, we will call it as a sub broker. But there is nothing called agent. It is for understanding given. What is broker? Broker is nothing like an agent. It acts as an agent between the two entities, between the stock exchange and between the buyer and the seller. That is why that word agent is mentioned. But in day-to-day life, we use the word broker only. The next point you can see here, again through diagrams given, regulatory bodies is there. Let us assume that the regulatory body for stock market is SEBI, because for capital market it is SEBI, Securities Exchange Board of India. Then we have exchange. With exchange, brokers are connected, and ultimately the investor is connected through the broker. So ultimately, whenever the investor wants to trade or invest in any company, he will not directly go to the exchange. He will go through the broker. The broker act as an intermediary or as an agent, and at the broker level, there will be a dealer who will place your order if you are doing an offline transaction. If you want to do an online transaction, you do not want to take help of the broker, means you want to use the platform of the broker, but you do not want to call him and place the order. Then you will have your login credential. You can just place your login ID password and directly you can do the transaction yourself. In that case, one particular person is eliminated, and which is that person? It is called dealer, because dealer work is what? To place order on behalf of the client. That activity is placed. It is just like if you want to do the transaction in bank, either you can call the bank or you can visit the branch. That is called offline banking. But let us say if you're doing net banking, in that particular case, all the banking persons are eliminated, but you are using the platform of the bank. When you're doing internet banking, it is nothing but, suppose if you have an account with State Bank of India, you're using the platform of State Bank of India portal, but ultimately all the intermediaries within the bank, like cashier or say like any other person, that gets eliminated because you yourself are doing that particular transaction. The same thing happens in this particular trading account. Either you can do online or offline. Certain brokers will charge you more brokerage if you do an offline transaction, because in an offline transaction, you are taking help of a broker. So their resources are getting used because you call them. So if you call them, then whatever calls are made by the client, that has to be recorded and stored. So that has a cost. If you're calling him, then that particular dealer has to place the order. So there is a salary of the dealer. So if in certain cases, brokers will charge you more brokerage if you place order offline, but if you're doing on your own, then the brokerage will be far competitive in nature, because infrastructure is once created, online infrastructure, you are utilizing it, you are not taking any help of the broker's cost. So that is the reason of that. So this is a basic understanding. You can see here, buyer, whether if it is a buyer, he's also going to the broker. If it is seller, he's also going through the broker. And ultimately, whether it is a buyer's order or seller's order, both these orders ultimately goes to the stock exchange. Normally, it is said in a very lighter manner that whether the client makes profit or not, that is immaterial, but broker always makes profit. For the simple reason, once you have bought the share, you will sell the share. Now, whether you make profit or you make a loss, but the brokerage of the broker is always fixed. So it means the broker is always in a very good situation. He is not in a situation to make loss. He's in a situation to make profit only because he's getting a commission. So not only the stockbroker, in any business, whenever there is an intermediary whose work is just to connect to someone and to get a commission, that particular person has nothing to lose. That person always makes some money only. That is the basically role of the broker. Moving further. Now you can see another thing, which is depository. Already I explained you, but more detailed discussion is there about the depository part. So if you remember, I told you, you can see here down, this is uncertificated or certificated, basically into dematerialized form. In simple word, whatever shares were there earlier in paper form, in physical form, that has been converted into electronic form, and that is nothing what we call it as dematerialized. So this is like investors have their securities in the depository. Depository is nothing but a place where you open your demat account. In India, we have two prominent depository, which is called CDSL and NSDL. I don't know about NSDL, but CDSL is already listed on the stock exchange also. And below it is mentioned here, the transfer of ownership through a book entry rather than the transfer of physical certificate. So here you do not actually physically transfer any certificate. Whenever shares are credited to your account, you get a particular book entry. That is, something is visible in your particular statement of account that you got this much of shares credited to your account. Similarly, whenever the shares move out of your account, you will get a SMS that the from so and so shares have been debited from your account. Just like in bank, whenever it happens that you have made a payment through check to someone, and whenever that particular check hits your account, you get a message that your account is debited by this when this much. So you cannot see the money in your bank account. Can you see the money that this is a currency note? No. But the money is there in electronic form. Money you can, whenever you're doing internet banking, etc., you can see the money in electronic form. The same thing is here. If unless and until you want to convert this particular share into actual physical form, so far that particular shares will remain in digital form only. So suppose if you want to convert the share into physical form, which no one actually does, practically it is not viable, then that process is called as rematerialization, because again you are converting that into physical material. So we call that as rematerialization. I have personally never seen in my life that any person is doing rematerialization, but I have seen that all the people who were holding physical certificate, they have get it done a dematerialized, that is converted into the digital certificate. You can see the only difference here is investor A, investor B, investor C. What happened? Once you sell the security to another investor, the shares or the securities will move from the investor A demat account and it will go to the investor B account. If tomorrow investor B sells it, it will go from investor B to investor C account without physical traveling. It will get digitally transferred from one particular bank account, from one particular depository account to another depository account, or from one demat account to another demat account. That is the meaning of this particular part. So you can see at the bottom, you can read something. It enables brokers and financial institutions to keep their securities in one place. This is only the one important thing. Whatever securities are there, you are not holding that securities with yourself. You are not holding those securities with the broker, but that particular security is kept with another independent institution, which is a depository, and that depository is giving you this demat services and your shares are held there. So let us say that suppose if I'm having my shares in a particular CDSL account, and let us say tomorrow something happens to a particular broker, that particular broker is problem. So whether you will suffer because of those particular problem? No. Why? Because your shares are not with the broker. Your shares are separately in a different demat account. So even if the broker have any particular problem, you will not feel the pinch of that particular transaction because your shares are now in safe custody. So it is like just we keep with custodian. This is not called custodian, but it is acting like a custodian only. Demat account is nothing but it acts like a custodian only. So your assets are completely safe there. Whether the like capital market, like when we say about capital market is regulated by SEBI, so whether these demat accounts are also regulated by SEBI, answer is yes. Every particular entity which comes within the domain of capital market, that's get regulated by SEBI. For example, we studied registrar and transfer agent. Regulated by SEBI, answer is yes. Depository regulated by SEBI, the answer is yes. Brokers regulated by SEBI, yes. Mutual funds regulated by SEBI, yes. Stock exchanges regulated by SEBI, yes. It means all these intermediaries or participants which are connected directly or indirectly with the capital market activity, they will be ultimately regulated by the SEBI. There will be certain things which can be regulated by SEBI also and which can be regulated by RBI combined also. For example, if it is an international mutual fund. What do you mean by international mutual fund? A mutual fund which is collecting money from Indian public but not investing in India. It is investing abroad. At the time of offer, they have made it very clear that whatever money we accumulate in India or get it from the public in India, we will invest in the US market. This is a fund which is dedicated for the US NASDAQ market. So it means you will have to invest in foreign currency, and foreign currency is a subject matter of RBI. So in this particular case, the mutual fund is subject matter of SEBI, but currency is a subject matter of RBI. So two regulatory bodies will come into picture, RBI plus SEBI. So there will be certain instances in day-to-day life where not single regulatory body will control, but there can be two regulatory bodies which are controlling. Let us take another example. I hope that would be quite interesting to you. There is one particular company which is into real estate business and it is listed on the stock exchange. So as far as the stock exchange part is concerned, regulated by SEBI, but since it is the real estate company, let us say if it is Parshvanat Developers or if it is Macrotech or if people maximum are from South. So I hope you must be knowing Prestige. The Prestige is there, DLF is there, Hiranandani is there, Brigade Enterprises there very much in Bangalore. So all these particular company, since they are dealing in real estate, apart from SEBI, they will also be governed by another regulator which is for the real estate, and that is called Real Estate Regulatory Authority, RERA. In short, we call it as RERA. So sometimes it will happen depending upon the nature of business transaction. Multiple regulators can also come into the picture. So now we have clearing agent. What is clearing agent? You know already. I have explained you, but just a basic idea. Suppose whenever we do a transaction, there are two possibilities. Just you can see below this particular blue line, transactions undertaken may be executed on a futures exchange or a security exchange. For your understanding as of now, just understand either you can do the transaction on a stock exchange. For example, I want to sell, say like a Reliance Industry share, and I want to sell it on the stock exchange. So this is the first part. The second part is over the counter market. Now, what is this over the counter? I am not selling on the stock exchange. You wanted to purchase Reliance share. You are one of my good friend, and I also want to sell it. I say, why to go and sell it on the stock exchange? Because ultimately there I will require 1 day to get the price. Broker is involved, so I'll have to pay the brokerage. I'll sell it directly to you, and the shares I'll transfer from my account to your account. So this kind of a transaction, which is over the counter, two things you have to keep in mind. First of all, this is a off market transaction. I'm not saying offline and online. Don't get confused with this. Off market. What do you mean by off market? You have not routed this transaction through the stock market, but you have initiated this transaction directly with the other party. So this transaction is called off market transaction. Whether the shares will be similarly transferred, yes. While transferring the share, you have to fill up a separate slip, which will be for off market transaction, and hand it over to your depository. Based upon that particular slip, the depository will transfer the shares from your account to the buyer's account, whose name and details you have mentioned in that particular slip. So this is called a basically off-market transaction. Now, one of the disadvantage of the off-market transaction is that there can be a possibility of counterparty risk. What is counterparty risk? You said, I'm selling the shares to you, you make me the payment. The other party says, okay, give me 2 days time. You give the shares to me, and I'll give you the payment on this coming Friday. On the coming Friday, he does not give payment. Can I take any legal remedy against this person? Answer is no. And if at all it is there, it is a very, very long consuming process. But let us say if you would have done this transaction on the stock exchange, and might be on the stock exchange, some X party has purchased those shares. And even if that particular party has defaulted on the payment, still you will get the payment, because stock exchange is ultimately acting as a settlement platform also, which means that there is a separate fund which is called settlement guarantee fund. What it is called? Settlement guarantee fund. So even if one of the party defaults in the transaction, it is the responsibility of the stock exchange to honor the commitment through the money available in the settlement guarantee fund. Question is, from where do you get the settlement guarantee fund? Every transaction which you do, and when you see the contract note, on the contract note, there is a particular charge which is called exchange levy. You will find that particular thing in your contract, exchange levy. So within your contract, there is a brokerage, there is a tax called security transaction tax, there is another tax which is called stamp duty, there is one particular thing which is called exchange levy, which is very, very minor amount. In lakhs of rupees, you will find 1 rupee or 2 rupee of exchange levy. So this 1 rupee, 2 rupee, which keeps on getting accumulated, that goes into this particular fund. And if any of the party by chance defaults, normally it won't happen that anyone is defaulting, but by chance in the very remotest activity, if it happens, in that particular situation, the funds will be settled. So this is called the basic difference between the doing transaction at the stock exchange and the off-market transaction, which is also known as over-the-counter transactions. Over-the-counter means between the two person mutually, where the risk technically is known as a counterparty risk. Remember this particular word, the risk is nothing but the counterparty risk. Now you can see this particular slide and just understand the flow of diagram. So what is the clearing? You can just understand the buyer ultimately buys the security. If he's buying the security, he has to give the payment. Who is going to give the payment? Seller, because seller is ultimately selling the shares, so seller has to receive the payment. So buyer buy the security, buyer gives the payment. Now buyer, when it gives the payment through the broker directly does not reaches the end customer. It first goes to the clearing agent. So there are certain clearing houses. The payment will go to the clearing house. From that particular clearing house, the payment will ultimately go to the seller, and the seller will sell the security. So this security will go to the clearing house, and from this particular clearing house, the security will be delivered to the buyer. So in simple word, in any particular transaction, two things will happen. I will deliver the good, and for delivery of that goods, I need the payment. So both the transaction, that is delivery of money and delivery of good, it does not happen directly between the party. If it is happening between the party, obviously, it is called a over the counter transaction. But since this is through the exchange, ultimately both these things will go to the clearing house, and through the clearing house, the things will be transferred to the corresponding party. So if I am the seller, I have to deliver the security, and if I am the basically delivering the security, I have to receive the money. If I am a buyer, I am supposed to receive the security, I have to pay the money. So whatever you have to do, the discharge of obligation is done through the clearing house. Whether it is stock market, whether it is some other market, whether it is a banking transaction, in all this particular activity, there is a particular concern which is called clearing house. Only when there will be modern systems of finance through blockchain technology, at that time this clearing house mechanism gets completely eliminated. Unnecessary confusion will come up, but in future you will find that clearing house requirement will get completely redundant. It will be completely eliminated. But as of now, you have that clearing house mechanism. I can simply tell you what is the role of the clearing house: verification of the transaction and accordingly fulfilling the obligation. So what is verification of the transaction? If I sold the shares, let us say 100 Reliance Industry, so then ultimately the clearing house will check whether actually it has received 100 shares of Reliance Industry from Mr. X. If it is received, it will say, yeah, one part of the transaction is done. This one part of the transaction technically is known as one leg of the transaction. We have legs to walk now. So in securities market, we say that this is one leg of the transaction. So one leg of the transaction is over. Now, what is the second leg of the transaction? Somebody else has bought this particular share, so he has to give the payment. So the clearing house will check whether we have received the payment from that particular person. If the person has given that particular payment, then this security will be transferred to the buyer. This is called the role of the clearing house. This is not the role of the broker. What is the role of the broker? Broker only provides you the platform for doing the transaction. But once you have done the transaction, then this settlement of transaction takes place through the clearing house. So you have to be very clear what are the two different roles between the broker as well as between the clearing house. No, a clearing house basically is nothing. A clearing house, which is basically, I think, national clearing house, something, I don't know the precise name. So there are not multiple entity. For example, if we have brokers, there are multiple broker. But when we talk about a central bank, we have just one RBI. So similarly, when we talk about clearing house, there is not multiple clearing houses. There is one national clearing house or something like that. That single clearing house for the capital market will take take care of the entire settlement and clearing mechanism. So not multiple clearing houses would be there, just like brokers.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.
Everybody wants to have a flourishing career in investment banking, right? So now we discuss about market capitalization. Let us say that you are facing a particular interview, and the interviewer asks you, okay, your investment banking module is done. Please explain us in simple word, what do you understand by market capitalization? So we want to keep things very simple, which the other person understand, and at the same time, we also do not land in problem. One thing should be very clear: the moment you try to create a lot of complex word and complex terminology, rather than simplifying the thing, the problem of getting into a problem is more. Rather than if you keep things very simple and try to explain other person that this is the meaning of this particular thing, the problem will not be there for you. So I hope you are clear with this thing, not only for investment banking, for anything in life. Always try to explain in very simple terms. Suppose if you get a numerical question in the assessment, that please explain about market cap. How do you write an answer? First, you write an answer. Market capitalization means this and this. Second step, you write the answer. This is the formula for market cap. Third thing, you write a particular thing giving examples of market cap, that these are different companies and this is large cap, this is mid cap, this is small cap. A person who is evaluating answer, he will give you full mark. So you should not matlab, write any unnecessary thing. Very crystal clear. Meaning, basically formula, its definition, and secondly, basically its what to say example. Definition need not be as per the standard that you just ultimately memorize the definition and write it there. What you understand, you write that definition. So when we say what is the value of the company, that is nothing but market capitalization. So in simple words, if I say that today a Reliance Industries market cap is say like 8 lakh crores. So what I'm talking about, I'm talking about the value of the company. So value of the company expressed in terms of stock market prices, because ultimately value of the company, how do you determine? It is based upon the stock market. If let us suppose there is X company not listed on the stock exchange, and but basically we do not have any stock market price, can we ascertain the value of that company so easily? Answer is no. In that case, there would be some alternative way, or you will have to find some authorized valuer or expert valuer or a chartered accountant, and you will, based upon certain parameter, then you'll have to figure out the value, and that value can also be questionable. One person will say I accept this value, another person will say I will not accept that value. But when any particular company is listed on a stock exchange, there is no question of valuation, because whatever price the stock market is ready to accept, that becomes the value of that company. So in short, to cut the long story short, what is the meaning of the market cap? It is nothing but the value of a company. Why do we determine the value of the company? At any given point of time, if somebody wants to buy shares or buy a company, or if some management want to sell a particular company, how would you figure out what is the valuation of the company? Based upon the market cap. So when we say market capitalization, suppose if I say my company, I want to sell it today, and somebody says, what is the share price of your company? I say it's 800 rupee. Do you think I'm going to sell my company at 800 rupee? Answer is no. Why? Because there's one more parameter. How many shares I'm selling? So suppose if my company have 1 crore share, so 800 rupees into 1 crore share, whatever answer I get, that becomes the market value of my company. So if you remember just this much, it's market value. So then even you don't have to remember the formula, because you know simply market price cannot be the value of the company. That is one of the determinant of the value of the company. There are many companies, even suppose it is Reliance Industries and the price is 2,500. Can we say Reliance Industries value is 2,500? No, it's in crores and crores. How would you get that crore? By multiplying with the number of shares. So this is there. Just a very recent example. If you are abreast with the market, Mr. Adani just said yesterday that we are going to sell a significant stake in Ambuja Cement to retire our debts. They want to repay the debts in the market, and they have a stake in Ambuja Cement also. So they want to sell a good amount of stake in Ambuja Cement. Now, obviously, they will get some value out of it. So what they are going to do, they are going to just whatever ownership stake now currently Adani Group has, they will offload that particular stake in favor of some another investor, get that money from them, and ultimately give it to the basically banks to repay the loan. This is the meaning of that particular thing. When apart from this, and apart from judging the market value, what is the other reason that we go for market cap? From investment point of view, particularly in the context of mutual fund industry, let us say as an investor, I want to invest only in big companies, that is in large cap company. So I will invest in a large cap mutual fund. So the question is, what is the meaning of the large cap mutual fund? In general, we feel that all the companies which are very big in nature, by size, by amount, by business, by profit, those particular companies are considered to be large cap. So if a mutual fund invests in such large company, it becomes a large cap fund. If the mutual fund invests in mid cap companies, that is medium sized company, it become a mid cap fund. And if the mutual fund invests in very small company, then it become a small cap. But the question is, I might say that say Ultratech is a large cap. Another person can question that it's not large cap, it's basically a mid cap company. So different mutual funds will have a different opinion about different companies as large cap or mid cap. To address that particular question, in India, as per SEBI, we have a very clear demarcation what is large cap, small cap, and mid cap. So just you have to remember, even from examination and practical point of view, companies whose market cap is among the top 100 company. Like currently, I believe that the top company in India is Reliance Industry, which has more than 8 lakh crore of market cap. Exactly, I don't know. So this is number one. From number one, basically, when we see companies up till number 100, from number one to number 100, whatever companies are there in terms of market cap, those are considered as basically large cap company. I hope everyone is clear with this. So I was explaining you that basically large cap companies would be which company? Companies ranging from number one to number 100, that is large cap company. Companies in market cap from 101 number to 250 number, these are considered to be mid cap company, and all the companies beyond 250 in terms of market cap will be basically considered as small cap, or you can say mini cap, micro cap, whatever you want to say, those will be those company. So I hope the idea is clear to all of you. What is the segregation criteria? From 1 to basically 100 large cap, 101 to 250 mid cap, and 251 onward all small cap and others. This is the basically criteria. You can just see on the screen, few names are given to you, both from Indian market and the US market. So these are basically large cap, mid cap, small cap. So right now you can see in large cap, all these particular US companies are listed. But if you want to know what are the Indian large cap, mostly I hope that you can also figure it out, like Reliance Industry, Tata Steel, State Bank of India, ICICI Bank, ITC Limited, Hindustan Unilever. All these big companies are basically coming in the category of large cap. Mid cap, you can see right now here Hindustan Unilever is mentioned in mid cap, but now it is now more a mid cap because share price have increased, etc. So now it has become almost a large cap. Of course, Edelweiss is there. Edelweiss is a mid cap. So these are certain mid caps. So just for an example, it is given. You can just try to understand. If you just want to know that whether a specific company in India is large cap or mid cap, just try to figure out within top 100 companies it is coming, it's a large cap, otherwise it's a mid cap or a small cap. Now we come to this particular slide and we see what are the ways of raising capital. Few things would be different, rest all things are already known. So first we see among the rights, among the issues, we see first upon the public, then we will go to the rights issue. First we see the public. Within the public you will see unlisted companies and listed company. Once a company is unlisted, usually it is called a private company. If the unlisted company wants to tap the capital market through the primary market route, that is by bringing an IPO, you can see the arrow, it is telling you that the first step is to bring an initial public offer. So once the initial public offer comes, and assume that initial public offer becomes successful in the market, it simply means that now this company will be listed and it will become a public company. So please remember, public company means what? Companies which get listed in the stock exchange, that will become a public company. And it is important that for getting listed, for the first time you have to bring an IPO. There is no other alternative to get it listed. For the first time you have to bring an IPO. So you can see in the IPO, it is given fresh issue. Now then there is second word, offer for sale. And two times you can see the offer for sale word is coming here also, here also. I'll just give you the meaning of the word offer for sale. Sometimes offer for sale is also abbreviated as OFS. Instead of writing offer for sale, many times you will hear this particular word, offer for sale. What is the meaning of the word offer for sale? When the promoter of the company wants to sell his own individual holding in the company to an outsider, that activity is called offer for sale. How would you distinguish between IPO and offer for sale? Let us say that if I say total authorized capital of the company is so much, and out of that authorized capital, let us say I have issued 10 lakh shares to the public. So this is basically of the company only, but this is not from the promoter quota. This is from the authorized capital that I've issued public. But let us say once the company gets listed, and after that, the promoter themselves want to reduce certain stakeholding in their own company for any reason. They don't want to continue the business, or they want to basically want to some get cash so that ultimately they can invest some other business, or might be there are disputes between the brothers and one of the brother wants to leave the company. So whatever reason is there, if the promoter is selling its own stake in the company, then that particular activity is known as offer for sale. The word itself tells you it's an offer for sale. We are selling our own stake, and this is an offer if you want to accept it. Coming to the second type, when this was the unlisted company, if they want to come to the market, they bring an IPO. But if the company is listed and again second time they want to bring an IPO, so then it is not called IPO, it is called further public offering, or sometimes we call it as follow-on public offer. So whether you call by this name or that name, in both the case, ultimately it is FPO. So what is the meaning of the word FPO? It is follow-on public offer. So I hope it is clear. When the company hits to the market for the first time, basically we call it as initial public offer. When the company is already listed, let us say for example, NTPC is there. NTPC is a public entity. Next year, suppose they feel we want to again sell 5% stake and we want to basically raise capital from the public. Now this is not an IPO, this is an FPO. Last year, LIC was listed for the first time. But if you are aware, LIC did not sell much of the stake in the company. I think only 5 or 10% of the shares have been sold to the public. So suppose if next year, again, government thinks that we want to sell more stake of LIC to the public, then this time if they bring an IPO in the market, actually it's not an IPO. Now it will be called as an FPO, because second time when you come to the market, it is called follow-on public offer. First time it is called an IPO. And if the promoter himself wants to sell his own stake in the company, then it is called offer for sale. This is the meaning of the category public issue. These are the things, how do we raise money from the public. Chalo, I'll put it another way. Might be offer for sale is getting little complicated. I ask another way. Whether a company can sell shares to the public without bringing an IPO. So till now, it was not possible because we have not discussed in the class so far. So obviously your answer is correct. But there is also one way that before an IPO, you can even give a pre-IPO allotment to people. It is called pre-IPO allotment, because you know that in IPO, the price is fixed. But in pre-IPO, a price is something voluntarily decided by the company. And the company says that we are offering certain shares to the public. If people want to subscribe, you can subscribe. But the listing benefit will not be there, because so far the company has not brought the IPO, so there is no listing. So which people will subscribe to the shares of this company? So suppose if the public feel that in pre-IPO allotment, whatever is the price, whenever the IPO will come, it will be having a greater price than that. And actually when it get listed, it will be far, far greater than that. In that particular situation, people may go for pre-IPO allotment also. One of the example currently is basically National Stock Exchange of India. So National Stock Exchange of India already bought some pre-IPO allotment. I don't know who have subscribed and what was the modus of that. And I think in a year or two, officially they are going to bring an IPO. So these people who got the shares in pre-IPO allotment, when they actually sell it on secondary market, their benefit would be greater, their profits would be greater, because they might have got this particular share at a lower price. One of my friend got pre-IPO allotment in one of the bank, Ratnakar Bank. I hope you must be knowing Ratnakar Bank. In short, it is called RBL, Ratnakar Bank Limited. So one of my friend, when we were very, very young, say like 15 years back, we were just discussing about the share market. So he told, I'm holding the shares of Ratnakar Bank. It was a very fancy at that point of time. So he got that particular shares at Ratnakar Bank Limited in pre-IPO allotment. So right now, not in the slide, for practical reason, not that important, but just for knowledge sake, I have discussed with you that while raising finance, one of the way could be that before pre-IPO allotment also possible, but only disadvantage is investor who buy in pre-IPO allotment, they cannot sell that particular share on the stock exchange because listing is not there. In that case, if they want to sell the share, only alternative available is they will have to find out some another person in the market who is ready to buy the shares from him. So suppose if I have a pre-IPO allotment share, and if I convince one of you that you buy this share from me, you will make good profit. And if you're convinced, then I can sell it directly to you. But stock exchange transaction not possible unless the IPO comes into the market. Now we come to the next part, that is rights. Just beside the public, you can see the word rights. What is the rights issue? Rights issue is nothing but company after raising capital, that is bringing in the IPO, wants to further raise capital, but not through an FPO, but through the rights issue. So rights issue is basically targeted towards the existing shareholder. When we talk about the FPO, it is to the general public. When we talk to the IPO, it is for the general public. But when we talk about the rights issue, The rights issue is always for the existing shareholder. So suppose if a company is having 10 lakh shareholder and the company decides that we want to bring a basically rights issue. So the company will give this particular right to subscribe the share only to the existing shareholder. Now, obviously, since we are giving to the existing shareholder, whatever is the current market price of that particular share, the company will offer this right at a discounted price. That discount can vary from company to company. Some company can give you a 30% discount, some can give you a 25% discount, but they will give you at a discount. Why a discount? Because if you are getting a discount, then only you will be having an incentive to purchase the right share. Otherwise, you will say if it is at the market price, why should I purchase from the company directly? I can go to the stock exchange and I can purchase there. So that is one thing. And second thing, since we are giving this right to our existing shareholder, so company feel this is one of the way of giving a certain reward to the shareholder, that sell them shares at a discounted price, so that after that, if they want to sell it at the exchange, again they can get certain benefits. So this concept is called as a rights issue. What is the main point that you have to remember? Right shares are given only to the existing shareholders of the company, but not to the new shareholder. Second important point in right shareholder, with every right that you give to your existing shareholder, you also give one more right to the right shareholder. That suppose if I'm a shareholder in a company and I got the rights issue, let us say it is Reliance Industry, I got the rights issue. That current market price of Reliance is 2,500 and Reliance is giving me rights issue at the rate of 2,000. Now it is not necessary that after getting a discount, I may still be ready to purchase the share. Just a simple example, I don't have money. So even at 2000, I'm not ready to buy the share. Or might be I do not want to invest in equity market currently. So I do not want to invest in 2000 only. In that case, I get one more right, and that right is I can sell this right to another person. That another person may not be completely a shareholder of the company. So I'm repeating once again, I got the right to purchase the shares of the company at 2000 rupee. I do not want to exercise this right because I have my own limitations, I have my own restriction, but I have one right. I can sell this particular right to another person. So obviously, at that time, I will sell it at some higher price. Might be suppose if it is 2000, I will ask some another person, do you want this right? He will say yes. At what price? I will say 2050. Other person will feel okay. I am still getting a discount of 450 rupee. Current price is 2500. I will feel I did not exercise the right, but at least I got 50 rupees by selling my right to another person. So this way also people will make the profit. This concept is called as right of renouncing the share or right of renunciation. I'm renouncing my rights in favor of another person. That is called basically the right of renunciation. I hope everyone is clear with the rights concept. Okay, I move to the last part, private placement. What is private placement? As the name suggests, company will basically go directly to hunt a particular investor. That is called private placement. It means neither IPO nor FPO nor rights issue nor offer for sale. Let us say that we identified a small entity or a small institution and we sell and we tell them we will sell you 10,000 share at an agreed price. You give money to our company and you place take 10,000 shares. So other company is not purchasing shares from us in IPO, nor it is purchasing from the stock exchange. It is directly purchasing from the company. There can be many reasons for doing this. Might be we will give them a slight discount to the market price. Might be we do not have that much of floating stock in the market and other entity is ready to buy 10,000 shares in a market, which we alone can supply 10,000 at any given point of time, because 10,000 of stock, if the other person wants to purchase from the market, that quantity might not be available for that particular company. So for this reason, we may directly sell to another company and get set amount, get some capital from that other person. That is called basically the private placement. So private placement, I hope the point is clear. You can see listed companies can do two more things. One is called preferential issue. It means that only for certain preferential investors we are issuing shares. We are not issuing these shares to everyone. Only for certain preferential investor we are issuing these shares. And just similar to that, there is category called qualified institutional placement. The QIP, in short, we call this as QIP. The name itself suggests there are certain institution in the market and we are selling this particular share only to those particular institution. It could be a mutual fund, it could be insurance company, it could be a wealth fund, it could be sovereign fund, it could be a pension fund, it could be some government owned fund of a foreign country. Whatever institution is there, ultimately we are selling to them. The biggest advantage of doing a QIP is there. In case of a QIP, you do not have to take any pre-approvals from the SEBI. You can directly figure out the QIP and you can directly sell it to the QIP. You just have to inform the SEBI, but there is no approvals which have to be taken. For example, in case of IPO and FPO, whatever price is there, at that price, if you want to bring a IPO or FPO, you have to take a prior approval from the SEBI, and if it approves it, then only you bring it to that. So you can say that all these things like private placement, preferential issue, and qualified institutional placement, all are like similar kind of thing, which is like private kind of an activity where public is not involved. Directly the company is privately engaging with them and getting the funds from them. Bulk transactions will happen. This transaction will not be for 100, 200, 500 share. This transaction will happen in lakhs and crores only. So these are the certain ways through which you raise the capital from the equity market. This is all about the equity market. So now just a basic thing is given. IPO. IPO is a initial public offering or a stock market launch when shares of an unlisted company are sold to the general public for the first time. I hope that by and large we have studied this many times, so I won't repeat it again. When a company listed security on a stock exchange, the money paid by the investing public for the newly issued shares goes directly to the company. So I hope the flow of money is very clear. Investors' money or the shareholders' money directly goes from the shareholders' pockets, basically to the you can say company, but only the route is IPO, that is through a proper platform, and ultimately these shares get listed in the stock exchange, which is also known as a secondary market. I hope you can recall all that. So this is called as a secondary market. Moving further, what is the goal of an IPO? The goal of an IPO is to raise fund, and I will call this particular fund as a long-term fund. When we take money through an IPO, it's not for short term, it is for very, very long term. The second is what are the business need? So the functions of an IPO are expansion, capitalization, and diversification. In simple word, that suppose if I feel I want to expand my business, today I'm manufacturing 100 car, tomorrow I want to manufacture 200 car, double the capacity. From where will I bring the money? So one of the way of bringing the money is to borrow from the bank, and the other way to raise the money is basically to dilute your stake in the company and bring an IPO in the market and raise the money from the public. So that is called expansion. Diversification. What do you mean by diversification? Ultimately, currently you are into only one segment of business. For example, let us say we are talking about ITC. So initially, ITC used to just manufacture cigarette. Gradually, it moved into the FMCG business. Then it moved into the chemical, paper, agarbatti, that is basically incense stick, then the match stick, etc. So basically, this is called diversification. Whenever the company goes for diversification, they need more and more money, and ultimately they raise money. The classical example in today's environment is Adani. So Adani started with one of the company, then they went into the ports, then into green energy, then into total gas, and the latest business that entered, which is listed companies, is called Adani Wilmar. So it got into the edible oil business market also, and finally this edible oil business market, they have the dream to completely convert into a FMCG company. So ultimately they compete with Procter Gamble, Reliance, Jyoti Laboratory, Bajaj Consumer Care, Dabur, etc. That is their basic intention. So I hope the point is clear. Further, it is given IPOs are used by companies to raise capital for expansion or modernization and to provide an exit route for private investment. For an equity IPO, it provides capital for various corporate purposes. So I will not read line by line. I hope it is clear. I'll just give an example of exit also. We discussed in the previous example when we discussed about the venture capital. So whenever a company is not able to raise fund because the market conditions are not good or because the company is making too much of losses, at that time, we basically take money from venture capitalists. And venture capitalists say that, okay, we will pump money in your company, but ultimately we want shares of your company in good quantity at a discounted price. So might be suppose we issued them shares at 10 rupees, that is at par, and tomorrow they want to exit the company. So after 3 to 4 years, when actually the company become profitable, at that point of time, basically we give them an exit opportunity by listing the shares in the market. Might be the 10 rupee share by that time have become 100 rupee share. So these people are very happy that within 4 years the capital have multiplied 10 time, 8 time, 9 time, whatever the case may be, and they got an exit route. So one of the reason of listing a company is also to provide an exit route to the initial investor, to the investors who started the company or who helped the company in the initial stages. We want to provide the exit route to them also. So this is there. And last point given is a company selling common share is never required to repay the capital to its public investor except in certain circumstances. So whenever the company brings IPO, so whatever this equity capital comes to the company, I've told you in the first lecture, first day also, this money is not required to be returned back to the shareholder. But suppose if we take money in the form of bonds or debenture, or we borrow money from the bank, under all circumstances, after a certain time, we have to repay the money back. So basically, there is no compulsion of returning the money back. That is also one of the attractive features of raising money through the IPO. So these are the certain goals and reason why we raise money through an IPO. The IPO process for Indian market takes place in the following step. So first of all, qualification for listing IPO. It means the SEBI will tell that what are the qualifications. So there will be many qualifications technically. Basically, there should be profit for so many years. This should be the revenue. This should be the track record. These many documents should have been filed. So many years have passed since the company has been created. So there are a lot of technical parameters which have to be compared, which is called qualification. In life, for anything, suppose if there is a particular post for an investment banker, so what would be there? This is a qualification to get selected as an investment banker. Similarly, the company wants to bring an IPO in the market, there are certain qualification which has to be fulfilled. The second is appointment of IPO participant. What is IPO participant? IPO participant means that once we decide to bring an IPO, we have to appoint merchant banker or some book runner or underwriter by these particular name, who are ultimately going to help the company to launch a successful IPO. That is basically called IPO participant, including the bank also, because in an IPO it is also important that you maintain a separate account which is called escrow account. We will study that later also. So escrow account is nothing but whenever you get money from the public, we are not going to put that particular money in individual's bank account or in promoter's bank account. That particular money will be kept very much separately, and that particular account is called as an escrow account. So this is all nothing but IPO participant, appointing a separate bank, appointing a merchant banker, book runner, lead runner, underwriter. All these particular activities are called appointing the IPO participant. Registration of the document, I told you earlier also, repeating once again, whenever you are bringing an IPO, lot of documents you have to file with the regulatory body like SEBI, like Ministry of Corporate Affairs, Department of Company Affairs, and if you are belonging to any specific sector, then whatever is the sector within that particular sector also. So for example, if a bank is bringing an IPO, then you will have to file certain documents with RBI also. If insurance company is bringing an IPO, then you'll have to file with IRD also. So to whichever sector you belong, you will have to file the document there also. So that is another part. Determine the price of the issue. At what price do you want to bring your IPO? 100 rupee, 110 rupee. You have to justify what is the reason of that particular price. You have to put that justification before the SEBI. SEBI will completely examine that really whatever price you are saying, whether it is justified or not, or whether ultimately it will result into losses for the individual shareholder. If the SEBI feel, yeah, this price is justified based upon your logic, then they will say, okay, you can bring this particular IPO at that particular price. And finally is allocation of the share. Ultimately, to whom we are not saying allotment. Please don't confuse with allotment. We are saying allocation of the share. So allocation of the share means that to the retail shareholder, how much percentage of shares we will give a lot. That is called allocation. Let us say if the company say out of the total IPO size, 10% is reserved for retail shareholder. 20% is reserved for qualified institutional placement, 10% is reserved for mutual fund, 10% is reserved for financial institution, 10-15% reserved for foreign institution investor. So this is basically we are saying what would be the allocation of the share category, means percentage of allotment applicable for different categories of investor that will be clearly mentioned. So this is the basic IPO process. Next part.
Let's have a quick quiz question, guys. And the question is, what type of variable can be used to capture fixed effects? And your options are random variables, dummy variables, continuous variables, or all of the above. Please mention your answers in the comment section below.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective as it is taught by IIT professors and industry experts.
Now, who is a lead manager? So many of the things are given here. I'll try to summarize and briefly discuss here. These are nothing but independent financial institution which the company will have to appoint before ultimately go for the IPO. What would be the role of the lead manager? The lead manager can do many things. It can do the IPO processing. They can do the promotion and publicity for the company. They can basically help in collecting the funds from the public. They can go and get the stock exchange agreement, because ultimately after the IPO is done, ultimately it has to get listed. Basically, they can help in appointing the underwriter. So all this particular activity is nothing but we call it as a lead manager, because they're leading that IPO. That is why we call it them as a lead manager. So this is a pre-issue process. This is not a post-issue process. This is a pre-issue process. It means before bringing an IPO, we have to do a lot of things. We also have to finalize the date, that what would be the date on which the IPO will open, what is the date on which the IPO will ultimately close down. Finally, what would be the issue price? It can also be situation that, let us say we decided 800 should be the share price for the company, and SEBI has also given an approval. But based upon the market condition, we feel that if we bring the IPO at 800, it may not be subscribed. So we feel, let us put it 750. SEBI will have no problem, because SEBI has given you the approval for 800. You are bringing at 750, so you can bring at 750. So to decide what would be the price, to decide what should be the timing of the IPO. And sometimes it happens that if the market is very sluggish or very bearish, and if you try to bring an IPO at that time, you will meet with a failure. But let us say that if you try to bring IPO when the market is very, very flamboyant, when the market is very, very euphoric in nature, at that time it will be very, very successful. So the timing of the IPO, the amount of the IPO, what is the opening date, what is the closing date, who would be the merchant banker, how to do the promotion and the publicity, ultimately, basically what should be the pricing of that particular thing, and many other business plan, etc. All this will be decided by the lead manager. So this is the role of the lead manager. Let me see what is the further given. Post-issue activity, including management of escrow account. Now, I hope you understand what is the meaning of the escrow account. The money which we get from the IPO, we keep it separately in a different bank account. It is not with the individual companies or the promoters bank account. That account is called escrow account. So these are all post-issue activity. When the issue is subscribed and the money comes from the public, we have to keep it in a separate bank account. That is called an escrow account. Then whatever allocation is happening means now we have to allot the share. So allotment of share is also a very big process that will also be done with that particular part. Let us say there is an oversubscription. It means we cannot allot shares to everyone. Then there will be certain mechanism of allotment of share. For example, we may say as per lottery method, means we will, as per the lottery method, we will allot the share, or we will go as per the pro rata allotment. What is pro rata allotment? That all people who have basically subscribed for any number of share, we will issue them only 50% share. So it means pro rata. So if somebody is applied for 10 share, he will get 5 share. If somebody is applied for 10,000 share, he will get 5,000 share. This is called pro rata allotment. So when this pro rata allotment or lottery method of allotment will happen, when there is oversubscription and it is not possible to allot shares to all the public, so we will have to employ a certain method. This particular method decision is also a post-issue activity. Once that is done, then we will have to finally allot the share and credit to the individual demat account. There were earlier days when we used to share the share certificate, but now there is no physical share certificate system in the market. So we will have to credit the shares in the individual demat account. So this is one part. And those people to whom we have not allotted the share, means we have rejected the share because it's a pro rata allotment because of oversubscription. Ultimately, we have to refund the money back to them. So the money will also be refunded to them. All this particular activity is related to the issue process, which is done by the lead manager. And the last point you can see, write the red herring prospectus and get it approved by SEBI. So what is red herring prospectus? Just like when you take an admission to a college or a school, you first read the prospectus. What the prospectus tells you, what is the college all about? what kind of academic activities are done, who is the head of the college, how many college branches are there, etc., etc. Similarly, when red herring prospectus is filed, it is an information to the SEBI that ultimately what is the company all about, what is the intention of raising the money, after the money comes, how the money will be utilized by the company. All that thing is maintained in the prospectus. It is technically known as a red herring prospectus. Instead of calling it as prospectus, it is called as red herring prospectus. And finally, you have to get an approval from the SEBI. If it is approved, then finally you can go and bring the IPO. So this is all about the lead manager part. Good evening, everyone. Okay, so now we move forward, and now you can see types of bonds on collateral basis. People who don't have any idea what is collateral, just you can say collateral is nothing but security. So for example, if company or government of India or any other particular entity, if somebody is borrowing money from someone, obviously the person who is lending money will say, you provide me some security. Security for what? That tomorrow, if the company is defaulting or if the company gets into some financial trouble, then how would I get my money back? So might be the company could say that, okay, my assets are secured against this, or my land is secured against this. Anything you can secure against any particular thing. So this is called basically collateral. So collateral is nothing but it is a technical word. In simple language, if you want to understand what is collateral, it is basically secured. So even suppose as an individual, suppose if I go to the bank and I say that I want to take a home loan. So while taking a home loan, you have to provide some collateral. And what is the collateral? Your house itself. Basically, you will say that I'm mortgaging my house to the bank, and the bank will ultimately give you certain percentage of the value of the house as a loan. They will not give you 100%. They will give you 85%, 90%, whatever they determine to be appropriate. That much of value of the house will be given to you. So can we say that this is a collateralized loan? Of course, because you have given the collateral as a home to the bank in order to get a home loan. Let us say that if you talk about a credit card, so if you take a credit card, can we say it is a collateralized loan? Answer is no, because for credit card, ultimately tomorrow, if you default, at the most, they can send some recovery officer, they can send you some notice, your basically CIBIL score can spoil, but ultimately you do not have any security with the bank, that ultimately bank can sell your security in the market and they can recover the loan. So in this context, when we're talking from bonds point of view, that was only for the explanation part, but now let us come at the corporate level, at the company level. Similarly, when company are also basically raising bond, the bonds can be of different type. One can be on collateral basis, other category of bonds we are going to discuss in the coming slide. So simply secured bonds means that any bonds which are issued against the assets of the company, that particular bonds are called collateralized bonds or secured bond. So what does it happen? Let us say a company becomes bankrupt. Bankrupt means what? It has been declared insolvent. That now onward, the company is not in a position to have good amount of money to fulfill all its financial obligation. So obviously, when a company goes into bankruptcy, all those people who want to get money from that particular company will basically put their demand. So suppose it could be employees of the company, they want their salary. There would be banks who have given loans to them, they want the money back. There are equity shareholders who have invested in that company, they want their money back. There is certain government money in the form of GST or income tax, they want their money. And similarly, there are certain investors who have invested in the company bonds, they also want their money back. So whether these bondholders will get the money or not, it depends upon one primary thing, whether these particular bonds are secured or not. If it is secured, it means that at the time of the default, ultimately all the assets of the company will be sold in the market through the process of auction, and whatever money is realized by the auction process, ultimately it will be distributed among those people who are demanding that money. So there is a procedure as per the Companies Act that who will be given first priority to get the amount. But obviously, since these are secured creditor, these are the secured people, their loan is secured against certain particular assets of the company, they will get good amount of preference at the time of liquidation of the company. So let us not go beyond that. Just understand that what is the meaning of the secured loan. It simply means that in the event of a default, you can recover the company from the you can recover the money from the company if it is secured. Just if you come down and you can see unsecured. So what does it mean? Now your stage is very, very large. After distributing money to all the people who are secured, If still money is left out, then only the unsecured people will get the money, otherwise you will not get the money. Obviously, since you're carrying more amount of risk, because your risk is now very very high, ultimately to carry such high amount of risk, you will be compensated more in the form of higher interest rate. So in other words, we can say that secured bonds will carry lesser interest rate as compared to unsecured bond, or in other words, we can say unsecured bonds will carry higher interest rate as compared to the secured bond, because the risk in case of unsecured bond is higher as compared to the secured bond. So this is just the basic meaning of the secured and the unsecured. So we go to the next part now, corporate bond. So what is corporate bond? In simple word, all the bonds which are issued by the corporates are basically corporate bond. In US market, we may use even in the context of private company and public company, but in Indian context, as I said, that usually issued by government, it is called government bonds, or you can say corporate bond. Now let us basically understand whether these particular corporate bonds, which comes with a specific maturity date, whether they are listed on the stock exchanges. Indian market is not that much mature, but US market is considered to be a financially mature market, and that is the reason that most of the bonds in US market will be listed. I'm repeating that most of the bonds in the US market are listed, or they are available on ECN. You can see that word ECN. ECN is nothing but the full form of ECN is Electronic Communication Network. So just like we say terminal, they have their electronic communication network. For example, you must have heard Bloomberg terminal. Bloomberg is a very popular terminal in the US where all the securities, including equity and debt, are listed, and you can find the codes of those particular security on the Bloomberg terminal. So in short, we can say that bonds in the US market are basically listed on the stock exchanges. The last point is the coupon in bracket already mentioned. Interest payment is usually taxable. So one question should come to everybody's mind, that whatever interest we are receiving from the bond, whether it is taxable like any other income or it has some tax exemption. So usually it is taxable. But in India, if government says that this is a tax-free bond, I'm repeating that government says it's a tax-free bond. So then you have to understand that what they are talking about, the tax-free bond. Usually when they say tax-free bond, it means that the interest that you will receive from these particular bond will be basically tax-free. So it is basically to attract people. When people come to understand that, okay, this is a bond which is giving me tax-free interest, it means I do not have to pay any taxes. Obviously, my return in certain sense is higher. If I invest in other bond whose interest is taxable, post taxation means after paying tax to the government, my effective return will fall. But in this particular situation, I'm going to get a better return. So people will usually prefer for the tax-free bond. Tax-free bonds, as the name suggests, it is bond, are usually offered by government of India from time to time. Private companies will not offer tax-free bond because that particular permission is not given to them that you can issue the tax-free bond. So I hope the point is clear. Usually what happens, usually means most of the time, basically the interest receivable from the bonds or the debentures of the company is completely taxable as per your slab rate. Whatever slab rate you fall, if you are in 10%, you have to pay at the rate of 10%, 20, so 20%. That way it is basically taxable. The other part is given, the US corporate bond market has daily trading volume of $26.3 billion. Just for your knowledge, it is given. You don't have to remember. The point that this figure tells you is that it's a very very big market. Like in India, we talk that equity market is very big, but in USA, equity and the bond market both are very very big, and there is a lot of activities and trading happening on a daily basis in the bond market also. In India, we do not have that size of a bond market, but slowly we are catching up, because you know that many people, many entities are getting listed, and there is a lot of infrastructure improvement happening in the country. So a lot of companies require a lot of capital, including government of India, and that is why we are now trying to even rev up, or we are trying to increase the depth of the bond market in India also. So this is something about the corporate bonds. We move to the next part now, and we go to the government bond. So I have deliberately tried to highlight certain things with the red color because everything is in para form. So at least I wanted to highlight the important part. What is government bond? In simple word, any bond which is issued by government is a government bond. That is very simple to understand. But now most important part, they are also known as sovereign bond. You can see that I have underlined with the red color, or I've painted colored that with the red. Uh, Basically, these are also called sovereign bond. Now, what do we exactly mean by sovereign word or by the government bond? In simple word, that when it is backed by sovereign guarantee, it means it is backed by the government of any country. Usually, it is assumed that these particular bonds are not going to default. So yesterday, if you remember, at the close of the session, I discussed one terminology called default risk. And I told you that sometimes we call default risk and sometimes we call that particular word as credit risk, which is means chances of default in terms of repayment of the capital. So I was talking about what is default risk. I hope that is clear. So in terms of government bond, basically it is backed by the sovereign guarantee and the chances of default are almost nil. Now you will say almost nil, can't we say completely nil? No, we cannot say completely nil, because if the government itself is in a financial crisis, for example, just few years back we have seen the problem in Zimbabwe, we have seen the problem in Venezuela, recently we have seen the problem in Sri Lanka, sometimes we are also seeing the problem in Pakistan. So in this particular situation there can be a chance that even government may default, but usually good government having a good economy, good tax collection, and usually a stable currency environment, in that particular situation we generally assume that the bonds that are issued by government is backed by sovereign guarantee, which means there is almost a zero default risk. I was talking about that basically in case of a government security there's no default risk, and that is why we also say whatever rate the government is offering on their security, it is also known as a risk-free rate. We also call it as a risk-free rate because this is a rate which you are getting for not taking any kind of a risk. We also call risk-free rate. When this risk-free rate is useful, there are certain mathematical model which are required to compute the expected share price as per the CAPM model, etc. When required, we will discuss that. So basically, whenever there are certain model and where you have to use a risk-free rate in the formula. So the question is, from where do we get the risk-free rate? So all the government security which is offering basically certain rate on their security, that particular rate is nothing as termed as a risk-free rate. This is the meaning of the risk-free rate. So you can see that basically sovereign bonds usually refer to bond issued to raise capital from the foreign country. So this is all something which is given. Now last point, you can just see for general knowledge point of view, government bonds are also known by many names depending on which government issue them. For example, UK bonds means if the UK government is issuing the bond, it is known as gilts. We call them as gilts. If German bonds are issued, it is called as bunds, BUNDS bunds. US bonds are usually classified as T-bill. In India also we have the T-bill. T-bill is sometimes classified as Treasury Bill, which is issued by the RBI or any central bank. So in US we call them as T-bills or T-note and T-bond, while Indian bonds are usually known as G-SECs. So G stand for government and this SECS full form would be securities. So G for government or SEC for security. So in simple term, if I say that what are the different names for the government security, you can simply say it can also be called GSEC, it can be government security, it can be gilt, it can be bund, it can be T-bill. All these are different names given to the same thing in different kind of a country. Even in India, we have the Treasury Bill. So nothing like we cannot say Treasury Bill in India. And this is something that. So only two things you have to remember in this thing. The main thing that you have to remember, all the government bonds which are issued by a stable government with stable currency are considered to be completely free from default risk because it is backed by the sovereign guarantee, number one. And number two, the interest rate that is offered by the government security, it is considered to be a risk-free rate. That rate is called considered as a risk-free rate. One more important point you have to additionally understand, which is not here in the slide, the interest rate provided by any government will be the lowest interest rate as compared to any other bonds in the market. Now the question is why? Because there is a one basic principle of financial management that higher the risk, higher the return, lower the risk, lower the return. Since we know in government security, the risk is almost zero. We say risk-free return. And that is why the interest rate offered by government security will also be the least among other bonds and debentures in the market. So this is something about the government security. Let us move forward and discuss other things. Now we come to the next part, that is basically zero coupon bond. Now, you know what is the meaning of the coupon. Coupon is nothing but interest. So suppose if I say zero coupon bond, and if I ask you what do we mean by that, obviously you will say you are saying zero interest bond. So is it zero interest bond? The answer is yes. We are talking about zero interest bond. Now, how does it happen? Who issues such kind of bond? If it is a zero interest bond, then why people will subscribe to such bond? Let us understand with an example. Let us say in India, a big power company, say like NTPC, thought to set up a power plant in a particular state. And let us say it is a very giant power plant. It is going to cater a lot of electricity development in days to come. For that particular power plant, it was estimated that 25,000 crores of rupees would be required. So NTPC thought, let us raise this money from the market. Now for raising this money, again, it was anticipated that once we start construction of a power plant, it will take minimum 4 to 5 years for the plant to be fully operational. With before 5 years, it will not be operational. So suppose if NTPC today borrows funds from the market, let us say at 6, 7, 8%, whatever be the interest rate, they will have to start paying interest from day one. But actually, the plant will become operational in the 5th or the 6th year. So how can they pay interest today when they do not have any cash flow, when they do not have any business, they are not going to get any profit? It means that they will be paying interest out of the public money only, that whatever money they have gathered from the public, they will have to pay interest out of that money only. So this is something not genuine, not fair. So in order to avoid this kind of a situation, basically what the NTPC will do, they will say that we will issue zero coupon bond. Zero coupon bonds means what? We are not going to give you any interest on this bond, and ultimately at the maturity you will get the money. Now how does it operate? Why the people would invest? So simply it means that suppose today NTPC says that today we are issuing a bond, say like for 5,000 rupee. So they will say after 10 years, when this bond will mature, you will get, instead of 5,000 rupee, basically 12,000 rupee. So basically today we are not paying any interest for 10 years, but after 10 years, today you have purchased this bond from us at 5,000. After 10 years, when you come back to us, that is to NTPC, and you surrender that bond because it has matured now, NTPC will give you how much rupees? 12,000 rupee. So indirectly you can understand the difference between 12,000 and 5,000, 7,000 is nothing but attributed to interest. But the only difference is that instead of paying 7,000 interest throughout the period, they are paying at the end of basically 10 years. So first of all, from NTPC point of view, let us talk. NTPC till 5 years, no particular business has started. In 6th year, they started the power production. Might be in 7th year, they started becoming slowly profitable. And 8th and 9th year onward, they are in a very comfortable position. And now they can distribute interest payment easily at the end of the 10th year. That means against 5,000, now they are in a position to give 10,000 at the end of 10 years. The figures that I've quoted is just for example. So don't understand that in money gets doubled in 10 years. That is not the intention to tell that in how many years the money gets doubled. The intention to tell is only this, that during the bond maturity time period or the bond tenor, you do not get any fixed interest every year, but the interest is getting accumulated into the purchase price of the bond, and ultimately entire amount is paid at the maturity of the bond. That is the intention to say. Technically, if you have to use the definition, as per the definition, we will describe or we will define this zero maturity bond as, or zero coupon bond as, that this is a bond which is issued at a discount to its maturity value. I'm repeating, we are issuing the bond at a discount to its maturity value. What is the maturity value? 10,000. At what price we are issuing today? 5,000. It means it is issued at a discount to its maturity value. This is the technical definition. If you understand the technical definition, well. If you don't understand that, at least understand what is the purpose of the zero coupon bond. So with this concept, one thing should come to mind, that which kind of entity will issue zero coupon bond? Those entity where the gestation period of any particular production facility to come is very big. In this particular case, it is 5 years or plus more than that. So company is not in a position to make the payment of interest. So that is why they have come up with the zero coupon bond. If we understand this from investors' point of view, which kind of investors are going to subscribe this kind of a bond? So those investors who are not in need of any regular payment year by year, means they have not retired, they might be having some other alternative source of of income. So they say it is okay, even if the money is with them, after 10 years, we'll get lump sum amount. Instead of 5,000, we'll get 10,000, or instead of 5 lakh, we'll get 10 lakh. So those are happy investor. These kind of investors will be investing in such kind of bond. Whether zero coupon bonds can be issued by anyone, it is generally seen that zero coupon bonds are basically issued by public sector company. Right now, I have described NTPC. NTPC is a government owned company, or we can say public sector undertaking. So mostly public sector undertakings with heavy gestation period, with lot of capital requirement. These are called capital intensive project. These entities will be raising money in the form of zero coupon bond. For the first time in India, during the COVID period, the banks were facing shortages of money, because people who have taken loans from the bank, they were not in a position to repay the loan, because all the businesses were in lockdown state. So people were not getting money from the customer, so they were not able to return money to the bank. So banks were having shortages of money. So that time, for the first time in the Indian history, even banks have issued zero coupon bond. Now you know what is zero coupon bonds. I'll not explain again. So banks were allowed to issue zero coupon bond for a certain period. I don't know what was the period, 5 year, 10 year, but for a certain period, zero coupon bonds were issued. So now who can issue? That becomes secondary. The primary is what is the concept of the zero coupon bond, that should be clear, and who can invest, which kind of people will invest in such a bond, that should be clear. I hope the point is clear to everyone. Okay, so now I move to the next point, that is basically the junk bonds. So what is junk bond? Junk bond is nothing but any particular bond where the chances of default are very, very high. So basically, any particular company which do not have good financial condition, or where the financial conditions have started deteriorating, where the financial conditions have started getting very, very bad day by day, that they are continuously making losses. And in that case, it looks like that in the coming day, they may default on the bond. If it is certain that they will default in the bond, then there is no question that people will subscribe. But if there is just a probability or possibility that a company may default on its bond, such kind of bonds are called as junk bond. So you know the junk food. Well, what is junk food? Junk food is nothing but a food which is not good for health. Similarly, when we talk about the junk bond, it is not good for your financial wealth, which means that if you purchase such kind of a bond, in that particular situation, there can be chances of default. There, it is not that it will default, but there can be chances of default. Since there are chances of default, it means an investor is trying to take some risk in this bond. Obviously, this particular bond is going to pay you very high interest rate. Suppose if in the general market, interest rate of bond is between 8 to 10%, might be this bond will pay you interest in the range of 14%, 15%, 16%, depending that what interest rate it can attract the investor. And that is the reason that we call junk bonds also by another name as high yield bonds. I'm repeating just for your knowledge, junk bonds are also known as high yield bond. Now you know the meaning of the word yield. Yield is nothing but return. So if I say high yield bond, what does it mean? High return bond. And why it is a high return bond? Because you are being compensated for taking higher risk. And that is why these particular companies are offering you higher interest rate. This is what we call as a high interest rate. So you can just read it. I'm reading it line by line also for you. Junk bonds are unsecured bond from issuer with a poor credit rating. Poor credit rating simply means what? That the chances of default of these companies is very high, which affects the probability of repayment of the bond. Whenever the bond is due for maturity, at that time, they may default at the time of repayment. The credit risk on these bonds is high. So I hope now you can correlate the word credit risk with default risk. Yesterday, we have discussed many times. And the last point is the high risk provides a high coupon rate. Since you're taking very high risk, you will get a high coupon rate. And that is the reason we also call zero coupon bonds as a high yield bond. There are few credit rating companies in India. I hope you must have heard these names called CRISIL, CARE, ICRA, and Fitch. Out of the four companies, the three companies are listed on the Indian stock exchanges. That is CRISIL, CARE, ICRA. So whenever a company bond or debenture is issued in the market, they have to get the credit rating done from these credit rating agency. What does a credit rating agency does? They have certain parameter. For example, if they give triple A, I'm repeating, if they give triple A credit rating to a bond, it means that the bond carries highest safety. Triple A is considered to be highest safety. Suppose if there is another bond which is having double A or AA minus or BA plus. So there are certain connotations given, and based upon the connotations you can understand that if a particular connotation indicates what. So if it is AAA, it means it's a very good quality bond. Obviously such bond will offer you very low interest rate. But suppose if it is a very poor quality bond, if it is coming below BB minus or single B, something like that, every different company will have their different way of expressing that. Whether someone will say in A, someone will say in B. So if it is very, very lower kind of a credit rating, just as I explained you now, it means that the company will have to offer higher interest rate to attract the investor, because based upon the credit rating, the customer or the investor is very clear that this bond may have the probability of defaulting. So it is just meaning of that. It is just like, suppose if we are in a college and if we know that somebody's percentage is say like 99%, so we know this is a very high quality student, let us give him scholarship. But suppose if there is a student who has got just 60%, this is a rating of that student. So instead of giving the scholarship, the another college may ask for donation from this particular student. If you want admission, you'll have to give donation. The same thing is here, that based upon this ranking or the credit rating, ultimately if the credit rating of a company is very poor, then they will have to pay very high interest rate. Then only the investors will subscribe to these bonds, and the risk of default will be very high if the credit rating is poor. So better the credit rating, less the chance of default. Poor the credit rating, it means the higher the chances of the default. This is the meaning of that. And now we go to the concept called convertible bond. So simply, just to apply the basic meaning convertible bond, it means that these bonds are to be converted in future. But converted into what? So usually into equity share. So there are different types of bonds or different types of debentures in the market. One of them is convertible bond, that up to certain period they will keep paying you a fixed rate of interest. And after that, instead of returning the money back to the investor, since it's a convertible bond, it will get converted into the equity shares of the company. So that is just simply, already it will be mentioned at the time of purchasing the bond, that at what rate these particular bonds will get converted into equity share, so that you are completely clear. So let us see what is given there. Convertible bond is one that can be converted into a predetermined amount of company's equity at certain times during its life, usually at the discretion of the bondholder. So whenever the bondholder wants to get it converted, the time will be given, like after 3 year, 5 year. If you don't convert after 5 year, then you can convert it after 6 year or 8 year. So whatever time frame is mentioned in the bond agreement, during that time period, if the bondholder wishes that I do not want now fixed interest, I want to get it converted into equity, because the company is very profitable and the equity shares are quoted at a very premium in the market. And if I sell equity shares in the market, I can get more better price than what I'm getting through interest on the bond. In that particular situation, the investor may decide to convert that particular bond into equity share. So just simple as that, conversion of bond into the equity share. That is basically convertible bond. So every company will have their own condition. There is no standard condition that every company will convert one bond into so many shares. Every company will have its own predetermined formula, and that will be mentioned in the bond itself. So if you agree with that, if you're okay, this one bond will get converted into 50 share and you're comfortable, you can purchase it. If you feel, no, this is not a good deal, you cannot purchase it. Even if you purchase it and tomorrow you want, I do not want to convert into equity share, so you cannot convert it. So it's not compulsory that you have to convert it. Convertible means there is option available to the investor that you can convert into equity share. If you feel that I do not want to convert, after a certain maturity period, you can say to the company, I want to return the bonds to the company and I want to get my money back. Till that time, you are going to get fixed rate of interest as you get in any kind of bonds. Convertible debenture, convertible bonds or convertible debenture means that suppose if the company is very new and the company feels that if we just simply raise bond, might be people will not subscribe to a bond. Number one reason, because we are very new in the market. Number two, yeah, that if we are offering interest rate, let us say 8%, others are also offering 8%. So people may go to other entity which are already very well established in the market and buy bonds from them at 8% instead of a bond, because we are not very well known. So we have to give some incentive to the investor. So we will say, you have that option that you get 8% interest every year. And in future, if you like that, if a company is doing well and if our shares are getting very good value in the market, you can convert these bond into debenture also, into shares also. So the investor will feel, yeah, there is a double benefit for 8% interest guaranteed. And secondly, if the company shares really do well, then I'll get a lot of capital appreciation also. So it is kind of basically attracting investor by those companies which are normally not able to raise money at competitive interest rates in the market. So those companies companies will issue convertible debentures or bonds. Now we come to the inflation index bond. So inflation index bonds means that usually issued by government. In India, very limited in nature, but basically we can see that mostly available in the US market. A lot of technical words will be given to you, but please understand first in simple language, and then if you have any question, you can ask. So basically the objective of any particular security which is issued by government for the public is that ultimately interest rates in the economy should be at least equal to the inflation rate, or it should be greater than the inflation rate, because senior citizen or retired people or people who are not having any employment and who are only dependent upon the interest income, if these people do not get that much of income which makes them self-sufficient to fight the inflation, they will be in a very miserable state. So in order to do that, government issues inflation index bond, which means that the interest on this bond is not fixed, but it is floating in the sense that it will be indexed with the inflation rate. So just to keep it very simple, let us say that if it is an inflation index bond, and today assume that inflation is 7%, these bonds will pay you 7% interest rate. Tomorrow, let us say for any reason, inflation sharply goes up from 7% to 12%. Assume for any reason. So obviously this bond will also start paying you 12% interest. For some good reason, inflation drops to 5%. This particular bond will keep you paying you only 5%. So the objective is that any person who purchase inflation index bond, that particular person should get that much of return from the bond, which is sufficient enough to fight out the inflation. Now, if you say that when this particular interest will be reset, so that periodicity, I don't know, but usually you know that at every periodic interval, every country releases their inflation number. And you know that CPI numbers, WPI numbers means consumer price inflation, wholesale price inflation, capital price inflation, all that is released periodically. Usually, if you talk about the US market, every month they get the inflation number. So usually they will adjust it every month. Whether they actually adjust it every month or fortnightly or for 3 months, that knowledge I don't have, so I won't comment upon that. But there is a periodic adjustment based upon the inflation figure which is available in the country. So idea is basically, I hope the point is clear, that usually when we purchase normal bond, interest rate is usually fixed. If I purchase 8% bond for 5-year duration, it means for another 5 years I'll get 8%, whether inflation is at 5% or at 10%. But in inflation index bond, the interest rate will be completely in alignment with the inflation factor, so that people who are completely dependent upon interest income, they will not have to suffer in the inflationary economy. Whenever there is a lot of inflation in the economy, they will not have to suffer. This is called basically inflation index bond. We have in India also, but very less in number. Hardly you will find people investing or trading into that. But when you go to US, there are a lot many there, because you know that social security is very highly available in the US market as compared to the Indian market. So that is why we find that a lot of these bonds are there in the US market. We go to now next point, that is perpetual bond. First concept, what is the meaning of the word perpetual? Perpetual means anything which is infinite, which is forever, which is like a unending. That is called basically perpetual. So suppose if I say that somebody's life is perpetual, it means that particular person is not going to die anytime. He is going to live perpetually, eternally. That is the meaning of the perpetual. Now, in the context of perpetual bond, it means that any person who has purchased a particular perpetual bond, he will keep on getting the interest forever. Forever means what? Till the time that person is in custody of that particular bond, he will be entitled to receive interest on that particular bond, whatever has been originally decided. So suppose if I am holding a perpetual bond today, and let us say I am having a life till 100 year, and I purchase, say, like in today's age, whether I can keep getting the interest till 100 years also, the answer is yes. In between, if I sell this perpetual bond to somebody else, in that particular case, that particular person will become entitled to receive the interest permanently. So in short, we can say that basically perpetual bonds are in infinite existence. Objective of raising the perpetual bond is, like government will usually raise such kind of a bond, that once they get the capital, they'll keep the capital forever. It's a long-term capital, and for that particular capital, we will keep paying you money forever. So it's a kind of a retirement planning also. Some people who want to do the retirement planning, they say that at least lock certain amount in the perpetual bond. So there is one particular thing guarantee that forever you will keep getting a certain interest rate. Usually the interest rates will not change. unless and until some conditions are attached to that particular bond. So this gives you a security that even in future, if interest rates declines in the economy, still you will get a fixed rate of interest, and that too for a very long period of time. So this is called a perpetual bond. One more thing is given here, just for knowledge, it is given here. The British government is often credited with creating the first one way back in 18th century, something of history, not much of my interest. And they were called as consol. Perpetual bonds are of interest to investors because they offer steady, predictable sources of income. So as I told you, since the interest is fixed, you are having a predictable source of income. You do not have to be worried whether interest will come down or it will go up. You don't have to worry that, you know that it's fixed. There are other options also available in the market where you can predict what would be the interest rate for 10, 20 years, even in insurance products also. So this is just one of the product available for the investor. Now we come to the next part, that is basically deferred bonds. So deferred bonds, what is there? Let us say something related to coupon payment. So deferred bonds pay interest only upon maturity. So here we are saying it is, you can just correlate little bit something to zero coupon bond, because you know that in zero coupon bond also it's paid. But actually in zero coupon bond, we don't say that you get the interest on the maturity. It is, we assume that the difference between the redemption price and the purchase price is nothing but coupon payment. It is our assumption. Company does not say that this is the interest, it is just the value increase you get it. But here actually whatever interest payments are getting due or accumulated, it is basically paid at the time of the maturity. That is called deferred bond. The word deferred itself means that something which you want to postpone, that is basically called as deferred. So in this particular situation, if you are basically trying to postpone the interest till the maturity, instead of paying it yearly, you want to give all interest upon maturity, that particular bond will be called as a deferred bond. So let us see what is given here. Deferred bonds pay interest only upon maturity. Unlike most bonds, a deferred bond does not make periodic or coupon payment over its lifetime. Instead, the interest accrues and is paid when the bonds expires or mature. So I hope the point is clear. We'll have one example also below that, but basically the interest will be available only at the time of maturity. Now, for example, ABC Car Wash offers to issue deferred bonds at 6% on $500 for 1 year. So they have to pay interest on only the date of maturity, that is at the end of the year. It means that throughout the year, they will not pay any interest. At the end of 1 year, when the bond is about to mature, at that time, they will pay interest. Now, in this case, this is a question of 1 year. Suppose if a company is issuing for 2 years, obviously it will be for 2 years. But usually when the deferred bonds are issued, it means when the interest will be paid at the time of maturity, they will not be usually of very long duration. Because if you're not getting for very long duration any interest payment, then investors will be little bit wary. They will be little bit susceptible. They will little bit fearful whether I will actually get some interest or not. Because if you keep getting periodic interest, at least you feel my capital is there, but at least in between I'm getting certain interest also. So in case of a deferred bond, you can assume that these particular deferred bonds are usually of short duration, as in this example it is mentioned of 1 year. We'll see further. Unlike most bond, a deferred interest bond does not make periodic or coupon payments over its lifetime. Instead, the interest accrues and is paid out when the bond expire or mature. A deferred interest bond can be a good choice for those looking to save money while accruing more interest than they might receive in a bank savings account or a money market fund. So in simple language, we can say that suppose if you take interest in between, usually what happens, the general people have a very bad habit that whatever interest they get, they usually spend that particular money. The money gets credited into a bank account. Out of that particular bank, they will make certain payment, the expenditures will be paid, but they will not reinvest that particular money. But suppose if this particular interest is accruing with the bond and all the money you will get along with the maturity amount, the chances are that the lump sum amount will remain intact. Usually people don't spend the lump sum amount, but if you get in between dividends or interest, something like that, people have the tendency to mix up with other amount and they spend up. So that is not a good practice. If you want to create more and more money and more wealth over a period of time, then intermediate payments, these are called intermediate payment, that is in between whatever payments you receive, receive, you should also club that particular amount with your original principal, so that ultimately at the maturity you get a sizable chunk. So for those people who have that sound financial planning, who have that level of knowledge, who are comfortable with this kind of planning, they will do that. There can be another set of investor who do not believe in all this. They say that we are completely dependent upon interest income, and unless and until we get every 6 months some interest, how are we going to run a family? Because now we are retired people. Obviously those people will not buy deferred bond, they will buy the normal bond where you keep on getting the coupon payment twice in a year. So that is called semi-annual coupon payment, that is twice in a year. So they will be investing in that kind of a bond. Next, foreign currency bond. So what do we mean? I hope that with the name itself, many people will be able to recollect the understanding what is foreign currency bond. So foreign currency bonds are basically issued by government or companies or corporate, and usually in the foreign currency, to raise capital from a foreign country. What would be the primary objective of raising foreign currency? Very simple reason. If you get something cheap outside your own country, you will go to that country and buy it. So sometimes capital is cheap. What do you mean by capital is cheap? In India, if we want to raise capital, might be we will get at 10%. I have given you example yesterday also in the context of ADR, GDR, that why do companies get listed through ADRs in different country? At that time, we have discussed that accessing cheap capital. So 1.5 years back, I told you yesterday also, I'm repeating the same thing. The capital cost in US market was 0%. So even if any particular bank, after making profit, was making available some money to the Indian corporate were able to get that money at the rate of 2%, 3%, maximum 4%. I'm talking about 1.5 years back, not today. So in that case, if you can borrow money in India, 10%, you can get the same money there at 4%. So straight away from interest point of view, you can have a good saving of 5-6%. And 5-6% means it's in crores and crores of rupee. So that can really change the complete profitability metrics of a particular company. So that is also the reason that usually the government or companies with good credibility standing, any company cannot go and raise money. Very good companies which have a very good reputed brand name and good profitability, and the balance sheet size is very, very strong, these companies will only be able to raise the money in the foreign currency bond. One of the biggest risk in foreign currency bond is that if there is an extreme exchange rate fluctuation, which is adverse for you, in that case, might be you have saved only 6% in terms of interest rate, but might be you can lose on the front of exchange conversion when ultimately you have to repay this money back. Because Indian rupee versus dollar, every few years it keep depreciating a little bit. Right now it is stable since few months, or you can say since 1 year. But if you see over long period of time, there is a tendency that the Indian rupee will keep depreciating against the US dollar. So that factor has to be taken into mind. Again, if somebody takes a currency, then good companies will go for a hedging strategy in the derivatives market, and they will take a forward cover that in case if there is extreme fluctuation in the currency market, then they will take that particular cover. How that happens, that we will not discuss now. If there is a derivative chapter, we will discuss at that point of time. But in short, basically they will protect that particular position by taking a hedging cover in the derivatives market. So this is about the foreign currency bond. You can see in the second point, a foreign currency bond is a type of convertible bond issued in a currency different than the issuer's domestic currency. So sometimes these bonds can again be converted into equity shares also. That is why it's mentioned convertible bond. So might be foreign investor would say, okay, this is very attractive. We are getting at least 3-4% interest rate. And tomorrow, if this company does well, then we can convert this foreign currency into equity. And obviously we'll get the equity shares of that Indian company, and we can sell it on the stock exchange and make good amount of profit. So many companies in India, not one or two, many companies in India in the past have basically raised money through this particular thing. If it is convertible, usually we write the word FCCB, that is foreign currency convertible bond. This is the word which is usually stated there. So this is something about the foreign currency convertible bond. Any other questions you can ask about this? Callable bonds concept got into India for the first time through IDBI. Now, I'm not talking about IDBI Bank. Earlier, there were two separate entities, IDBI and IDBI Bank. So IDBI was like Industrial Development Bank of India, whose work or objective was to provide finance for the industries. And they used to come up with a lot of bonds in the market. So they came up with a particular bond called callable bond. Now, what is the objective of the callable bond? Suppose if they raise a particular bond for 10 years, and they decide that they will pay interest, say like at 12%. I have seen interest in my life in India at the rate of 14% also in the banks. So interest rates were very high once upon a time. Means my grandfather used to basically park money in FD at the rate of 13-14% in the bank. So at that time, suppose if a bond was issued in the market, like say 12% for 10 years, and if the management of IDBI think that in future, that before 10 years, the chances are there that ultimately interest rates in the economy can come down by 2-3%. So it means that if we continue with this bond, even in the market, others will be able to get the amount at 7%, 8%, but we will still continue to pay to our investors at the rate of 11-12%, where we will be losing crores of rupees. So how can we protect this particular thing? So they inserted this particular option called callable bond, which means in the bond, a specific condition was laid down that after a certain interval, if the company is of the opinion that we want to prematurely call this bond, we do not want to maintain this bond for another 10 years, then we will exercise that option. And in that event, investors will have to surrender the bonds to the company even before the duration of 10 years is over. This is called callable bond. So in that particular case, company will retire all, say like 12% bond, assuming that the interest was 12%, and company will now issue fresh bond in the market, because now the fresh interest rate is 8%. So you can easily issue new bonds at 8%. So for rest of the year, you will be able to save crores and crores of money just because of this 3-4% interest rate reduction. So this option of callable is with whom? This is very important. It is with the issuer. This is not the option available to the investor. Investor has committed for 10 years. But if it is a callable bond, please understand, not all bond, only if it is a callable bond. In that case, the issuer will call the bond from the investor before its stated maturity. And what would be the primary reason for calling that? Because the issuer understands that why to pay higher interest rate when we can issue similar kind of bonds in the market at a reduced interest rate, and thereby increase our interest liability. So thereby decrease our interest rate liability. So why to continue with the old bond? In that particular case, these bonds will be issued. So whether these bonds were actually exercised in the India market, yes, we had two examples that comes to my mind. One was by IDBI, and another bond was one of the company called Sardar Sarovar Nigam bond. It was a very, very popular bond at that time. I think it was in 80s or 90s, Sardar Sarovar Nigam bond. So if you ever dig into the history of callable bonds of India, then you will figure out these two companies, they actually exercise this option and prematurely retired the bond. Now we move to the next part, that is basically portable bonds. Exactly opposite to callable bond. Now, what is exactly opposite to callable bond? Portable bonds means that the right is now not with the issuer, but now the right is with the investor. So what does it mean? That before the maturity, for any reason, if the investor feels that I want to surrender my bond for the purpose of redemption, then that particular option can be exercised only if it is a portable bond. So basically you can say, I want the repayment of my capital or of my principal. I do not want to wait for 10 years. Then it can be done in that case. So you can see the last point. It can be done so that the holder can sell it back to a company in case he thinks that the credit worthiness of the issuing company is falling. So if you feel that might be at the time when I invested in the company was looking very good, but now in due course of time, the financial health of the company is coming down. Or even there can be other reason that I need money. I have some financial emergency at home, or might be I have some other alternative option available in the market where I can get better return. Either of the things, if it is happening with the investor, in that situation, the investor can exercise the option and prematurely surrender the bond to the company. So this is called puttable bond. So just remember, callable bonds, who calls it? Company calls it, or we can say issuer calls it. So it is the right available to the issuer. When we talk about the puttable bond, it is the right available to the investor that he wants to put it. Put it means surrender the bond, or you can say submit the bond for the purpose of maturity even before its actual maturity because of certain reasons of the investor. So this is just the difference between the callable and the puttable bond. Curious rates of interest rate. Now, what do we mean by this? So I'm going to explain you a very basic correlation between interest rates and between the bond prices. So we'll try to understand with an example so that you can correlate. I can say directly to you like this also, that relationship between interest rate and bond prices are exactly opposite to each other, which means that if the interest rate goes up, bond prices fall, and when the interest rate goes down, the bond prices rise. This is the general accepted thing which everybody would agree to because it's a proven principle. But how does that happen if you just really want to logically and practically understand? So let me just give you a small example. Let us say I have purchased a particular bond and that bond is paying me 8% interest every year. Now, let us assume that this year RBI governor has increased the interest rate. Interest rate now in the economy is not 8%, but it is 9%. So imagine the situation. What is the situation? Interest rates have gone up in the economy. I am holding a bond which is paying me 8%, but any new bond which will be issued in the market, now it will not be issued at 8%, it will be issued at 9% because interest rates have gone up. It means that my bonds will not be demanded by many people, because if people purchase my bond, ultimately they will get only 8% interest rate. But if people purchase new bonds from the market, they will get 9% interest rate. So because the interest rates have gone up, the demand for my bond, which pays 8%, has gone down. And because the demand has gone down, the price of my bond on the exchange will also start falling. So I hope the point is clear that whenever the interest rate goes up, the prices of the existing bond, I'm not talking about the new bond, the prices of the existing bond will start falling. Let us imagine a reverse situation, that interest rate started falling and I am holding a 8% bond. And let us say RBI governor reduced interest rate. So now going forward, any company which issue bond, they will issue the new bond at 7% interest rate. So it means people, if they buy new bond, they will get 7% every year. But if people purchase bond from me, obviously they will get 8% interest every year. So there will be many people who will be now ready to buy existing bonds from the market, because they know that once we buy those bonds, we will start getting 8% interest rate, because earlier the rate of interest was 8%. So it means that the demand of these bond, means existing bond, is going up. When it is going up? When the interest rates have gone down. So in simple way, we can just conclude that ultimately whenever the interest rate goes up, ultimately the bond prices comes down, and vice versa, means exactly the opposite will happen whenever the interest rates come down. This is the opposite correlation which you have to remember. So that is explained in the second and the third bullet point. You can correlate. Bond markets are bullish. What do we mean by the word bullish? That they tend to go up when interest rates are low or falling. And bond markets are bearish. The word bearish means what? That it starts coming down, means bond prices starts coming down when interest rates are high or rising. So that relation is given to you, but I already explained you the logic that why it happens so. The rationale or the logic behind this particular statement, I've explained you with an example. So I'll just read this example also for you. A government bond is purchased, that is issued on 1st January 2015 with maturity in 5 years. The face value is $1,000 and coupon rate is 6%. Please read it carefully. Payable semi-annually. So 6% is the coupon payment, but 6% will be paid twice in a year. It means 3%, 3%. Don't understand that it will be paid 6% 2 times. 6% is the coupon rate, which is on the principal value of the bond, but it will be paid semi-annually. It means once you will get 3%, other time you will get 3%. Further, it is mentioned, this basically means 3% will be paid twice in a year. It is imperative to know that semi-annual is just the frequency and bond will only pay 6% annually as the coupon rate. So that is what I explained you in clear term, that 6% is always stated as an annual rate. But once you say that it is semi-annual coupon payment, that annual rate will get split into two parts. That is, it will be paid twice in a year, 3%, 3%. So just it is given to you how interest rate and bond prices are quoted with certain particular example. On the next slide, you can just see the relationship expressed in the form of certain flowchart kind of a thing. So you can see whenever the interest rates goes up, what happens? The bond prices come down. And if the bond prices comes down, obviously the return will go up, because now you can purchase the same thing at a lower price. So basically your yield will go up. Yield means what? Return. Always remember, when we talk the word yield, yield is nothing but return. So if anything is becoming cheaper, and if you buy anything now cheaper, obviously your return on that particular thing will go up. So you can just correlate these particular things. Even if you don't relate all the three and you relate two of the thing, that if interest rate goes up, the bond prices come down, that should be sufficient for you, at least for the time being. This should be very much important, because in the complete bond chapter or in the fixed income security, this is one of the very important thing, that when the interest rate goes up, ultimately the bond prices come down. Don't confuse the two things. Bonds are becoming cheaper, so it means now you can get the same rate of interest by paying less price for the bond. So in effect, the return on the bond is increasing. If we correlate interest rate with the stock market, usually it is said that when the interest rate goes up, the stock market prices comes down, for the one simple reason, because the corporates which have borrowed money, that the borrowing cost will go up because of interest rate has gone up. If borrowing cost goes up, obviously the profitability comes down. Obviously the share price has to come down, because share price ultimately is the barometer of the performance of the company. So if the profitability comes down, the share price also come down. There are certain section of people who do not want to spend the money now, but they want to save the money, because they will now get more interest rate. So they will postpone the consumption. I'm not talking about the day-to-day thing, like we'll not purchase milk or vegetable. We are not talking about that. But any big item or significant item or extra quantity we wanted to purchase it, we will try to postpone it, because we understand that right now, instead of getting 5%, we are getting 7% or 8%, which is quite attractive. And in future, we may not get it. So we want to park that money there. Obviously, if your money is not with you, it has gone to the bank in the deposit, you have less money available. So you will spend less money in the economy, and it means spending less means less demand. And whenever there is less demand, the price will come down. And if the price come down, obviously the inflation will come down. So this is one of the reason attributable by the economist. I'm not talking about my opinion. I'm talking from the economist point of view. Reason why ultimately countries increase the interest rate to bring down the inflation. The objective is ultimately to dampen the demand, or to temporarily destroy the demand, so that inflation comes down, and ultimately the objective would be finally to revive the economy. So this is the basic thing. I've given all the correlation. One more thing, we have discussed interest, stock market, interest, bond market, inflation. Now let us see the impact of inflation on basically other things. So for example, if we say interest rate comes down, and if we say the inflation comes down, what is going to be the impact on the rupee, or what is going to be the impact on the currency? So basically, whenever ultimately the interest rates increases, as you know, the stock market goes down. So when there is an anticipation that stock market is coming down, then foreign institution investors who want to invest in India, they do not want to invest, because they understand that market will come down now. So it is not a worthwhile place to invest. So automatically there will be outflow of money from the Indian market, and that outflow is in the nature of US dollars. So if the US dollars goes out of India, it means that the US dollar reserve will decline with RBI. And if the US dollar reserve decline with RBI, it means that the rupee will become weak. If the rupee becomes weak, it means that whatever we are importing, now we will have to pay more price for that. So for example, if we are importing crude, and let us say that the crude price is $100 per barrel, just assuming, I know it is not $100 per barrel. If it is $100 per barrel, and for every $100 till yesterday, we were paying 80 rupee. Now we will have to pay 81 rupee, because ultimately, because of increase in interest rate, ultimately there is exodus or outflow of money from the Indian capital market, and that is creating pressure on the rupee. And because of that, again, we have to import the same oil at more price in terms of rupee. Dollar wise, it is constant, but in rupee terms, we have to pay more. If you're paying more, again, what is going to happen? Whatever crude oil you're purchasing now, that is become basically expensive to you. That is technically called as imported inflation. You are importing inflation from outside India. So that is called imported inflation. So this is basically imported inflation. And again, if there is an imported inflation, the same thing will happen again, basically in the economy. Ultimately, entire cycle will reverse, like inflation goes up, interest rate will have to be high, then inflation to be brought down. So all these things are basically interconnected. So just for your academic interest, I've told you foreign exchange chapter, when we will discuss, there will be some different discussion about the foreign exchange. But right now, I've just given you the hint. In the next slide, we are going to discuss about the current yield and the yield to maturity. So first of all, yield to maturity, a lot of things are given here. You can just read it. I'll just explain again in simple word. And more importantly, I'll take one particular Excel calculation, so that ultimately you understand how do we calculate yield to maturity. Now, you know what is yield. Yield is nothing but return. And when we say yield to maturity, what does it mean? Till maturity, what is your return? that is basically yield to maturity. Now you will say we haven't understood anything till maturity. What is the return? Please understand now in this way that every year you are going to get a certain fixed interest payment, which is called coupon payment. Let us say if it is say like 5%. So every year you will get 5% interest rate. This is your one income, which you will get during the duration of the bond. What for how many years you hold the bond, for that much time you will get that interest. Another important thing is at what price you have purchased the bond and at what price you sell the bond. The difference between the purchase price and the sell price is considered to be the capital gain, and that capital gain is also going to add to your total income. Total income means total yield, and that is why we say it is yield to maturity. So just for example, let us say that I purchased a bond from the market, say like at 950 rupees. We will see one example also. And let us say on maturity, I have given that particular bond again to the company. So the company is going to take the bond from you not at market price, but at the fixed value. And what is the fixed value? The par value, the face value. And usually what is the face value of the bond? It is $1,000. So $1,000 they will take from you, but you purchased from the market at 950. So it means you have made a capital profit, or you can say a capital gain of $50. So $50 of capital gain plus every year whatever coupon payments you have received from the company, that all this together, if we add up, this is a total gain of the investor for holding the bond from the date of purchase till the time of maturity. This concept is nothing what we call it as yield to maturity. It means return till the time of maturity. That is called yield to maturity. So I hope the basic thing, Mani, you can read the lines, but don't focus too much on that part. First, try to understand what I'm trying to say. Yield to maturity is always composed of two important components. One is the regular payment in the form of coupon payment, and second is a one-time gain or loss, which can happen in the form of capital gain or capital loss. There can be a situation where there can be a capital loss also. For example, you purchased a bond at more than 1,000 rupee from the market because you were getting a very high interest rate from the bond. So let us say you purchased at 1100. At maturity, when you give it to the company will not give you 1100. They will pay you only 1,000 because that is a maturity price. So 1100 minus 1,000, 100 rupees is your capital loss. In this case, your yield to maturity will fall. So what is the yield to maturity that we calculate systematically through a particular Excel sheet? Of course, on the next particular slide, you can see formula is also given to you. But in today's world, whatever can be possible to do directly on the Excel, it's no particular requirement that you do through the formula, because ultimately there are two things. Firstly, you have to remember the formula, and second thing, in the formula there is always chances of committing a silly mistake or an error. So you can see the formula. If you wish, you can note the formula. Whatever problem we will do right now, if you want to do the same problem at home using the formula, you can try it, but it hardly makes any difference when you have that particular formula. So I'll just try to explain you through the Excel. Okay, now first I'll just tell you about the data. Just forget about all this particular part. Let me just bring it below. We don't see that particular thing right now. Let us see, this is the basic data. Now, what is the data here? First of all, we are calculating what yield to maturity. You know that what would be the return up to maturity. The payment that is you are going to receive as an investor, it is semi-annual coupon rate. Obviously, in the problem, it will be mentioned semi-annual coupon rate. What is the face value of the bond? 1,000. Even if it is not mentioned, in a country like USA, it is safe to assume that the principal value or the face value of the bond is always $1,000. What is the price? Price means what? I'll make it more clear so that there is no confusion. I'm saying here current market price. So you can say current market price of that particular bond is 950 rupees or $950. We are talking in dollars, so let us say $950. Maturity is basically 10 years. I'm saying maturity is 10 years. And coupon rate, writing for your clarity, coupon rate is nothing but 6%. So if it is 6%, if I ask you basically how many times you are going to receive the payment, so how many times you will receive the payment if the maturity is 10 years? 20 times. So since the payment is semi-annual coupon rate, it means they will pay you 3% interest. How many times? 20 times, because there is total 10 years. So 10 years into 2 times, it becomes 20 times. Why I discuss this part? Because right now, when I'm going to discuss how do we calculate it, at that time it is required. So now I'm now trying to put all these value in the same way as it is required to calculate either on the Excel sheet or it is required to be calculated on a financial calculator. I'm putting this data in that particular value. So first of all, when we say that this is a face value, it means in the future we will receive this particular value. So we say that this is called FV. FV is nothing but future value. Since we are doing for the first time, I'll write it more clearly. Future value. What is the future value? Future value is 1000. Today, I am purchasing this particular bond at 950 rupee. So I will say this is my present value. Usually we say it is PV. So today is the present value, that is 950. I'm purchasing this bond. Whenever we do mathematical calculation of this sort, we put a negative sign before this for simple reason. Since you're purchasing this particular bond, money is flowing out of your pocket. It means we have to put a negative sign, that is minus 950. When we talk about the future value 1000, I have not put a negative sign. Why? Because we will receive that money. It means it will come to my pocket. So I don't have to put a minus sign. So this is very important to understand when to put a minus sign, when not to put it, because that will entirely change your total calculation. Just let me make this particular thing same. Yeah. Now, when we say N is nothing but number of period. Number of period means what? For how many periods you are going to receive the coupon payment. So right now we discuss for 20 periods we will receive the payment. It is not year. It is how many times you are going to receive this transaction amount. It is 20 times. And coupon rate already it is mentioned 6%. So now let us now do the calculation. So what we do, for calculating the yield to maturity, I'm again making it 950. It was just for understanding that I made it 1100. I'm making it 950. Now, for the purpose of calculating YTM, I'm explaining you. By chance, if anybody does not understand, so don't get frightened. I'll explain you once again. For calculating YTM, I type on the Excel sheet is equal to rate. I'm repeating once again, for calculating YTM, which function I'm using? I'm using the function rate. For using any function, I guess everybody knows that on an Excel sheet, you have to start that function with equal to. So I type equal to rate and I put the bracket open. The moment I open the bracket, you can see automatically what are the things you have to put in the bracket that comes there. For example, it is telling you NPER. The first variable you can see there, NPER. I hope everyone can see on the Excel sheet. If you're using your laptop or computer, you can see there also. NPR. What is the NPR? We already calculated, that is 20. Now, the second, after every variable, you have to put a comma. So after NPR, now I'll put a comma. After comma, it is asking you PMT. So now we have not taken here PMT. What is the meaning of the PMT? Any payments which are of regular nature, which are of repeated nature, that is nothing but called as PMT. In this particular situation, what is the repeated thing? It is the interest payment. How many times you will receive the interest payment? 20 times. How much you will receive each time? Each time you are going to receive 3% into 1000. You will say 6% is mentioned. 6% is for the entire year. But for one payment, that is for the half year, it will be half of that. So 3% of 1000 becomes how much? 30. Whether I should put a positive sign or a negative sign? Obviously not a negative sign, because it is an inflow of cash. I will be receiving the interest rate. So simply what I'll do, instead of that PMT, I'll put 30 here. Now we have another variable, which is basically present value. I'll first put comma. After that present value, already I put that minus 950. I'll put it 950. Again, I do comma. It's asking future value. What is the future value given here? 1000. So I put it 1000. The rest other things for the time being, you can ignore. Like type, guess, that is not of use for you as of now. Unnecessary, it will be messed up for you. What I'll do, I'll just close the bracket and I'll press enter on my screen. Now you get 3%. But now this 3% is correct or wrong. For that, you have to understand whether your cells are formatted or not. It means that whether this particular cell is giving you a rounded figure or whether this particular cell is capable of giving you the answer in the decimal figure. So what I will do, I'll again click on this cell. I'll go and click right cell. I'm again going and clicking right click. On the right click, you can see format cell. On the format cell, I'll go and I'll select the number. Under the category, I'll select number. The moment I select number, on the right hand side, I get these many things. I will increase the decimal from 0 to say like 3 digits. I'm making it 3. You can make it 3, 4, whatever you wish. And I press OK. And now you can see the answer is coming 0.033. So far what you were observing, it was 3, but this is now coming 0.033. Now 0.033 is not in percentage. And we want the answer to be in percentage because we are calculating what is the yield. Yield is nothing but return, and return is always expressed in percentage. So what we will do, first we will come down and we will try to convert this into percentage by multiplying by 100. I will say multiply by 100. I did it multiply by 100. You can see the answer is 3.34. Now this 3.34 is not for the entire year because everything that you calculated was for 6 months. And ultimately you want the data for 1 year. So if you want the data for 1 year, simply what you will do, again, you'll go to that particular cell and you will multiply it by 2. So now you get the data. 6.69 comes as your answer. What is the meaning of this 6.69? That if you are holding this bond from today till the maturity, then the effective return you are going to get on this bond till the time of maturity is 6.69%. Try to understand. Even if one of the step is missing, don't worry, I'll explain you that again. But first try to understand the answer. Answer coming is 6.69%. Actually, the coupon rate is 6%, but you are getting more than that. So how come you are getting more than that? Because you purchase the bond at a discount. 50 rupees you are gaining because of the discounted purchase price. You are going to surrender this bond on maturity at 1000 rupee, but you purchased at 950 rupee. So since you are getting 6% not on 1000, but you are getting 6% on 950, it means your overall yield is increasing or your overall return is increasing. That is why instead of 6%, you are getting basically 6.69%. If I give you just a general question without any calculation, let us say that suppose instead of 950, I purchased this bond at 1100, and now I ask you whether my YTM will be more than 6% or my YTM would be less than 6%. Can you tell me orally the answer? Just the answer.
Let's have a quick quiz question, guys. And the question is, which one here is a type of casual forecasting? And your options are multiple regression, exponential smoothing, surveys, or the Delphi method. Please mention your answers in the comment section below.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective as it is taught by IIT professors and industry experts.
I do not want exact calculation. I just want that if you purchase the bond at 1100 instead of 950, now your yield to maturity will be more than 6% or it will be less than 6%. Less than 6%. Why? Because in order to get 6%, you have invested at a higher price. So your effective rate of return will come down. If you purchase something at a low price, it means now you will get 6% on 950, which other people will get at 1000 rupee. It means your return will increase. Let us say that suppose if I say I purchased the bond exactly at 1000, and if I ask you what is the yield to maturity, you'll say, sir, simple, 6% only. Why? Because the purchase price and the redemption price are same thing. So basically you're getting 6% on 1000. So it means it is just the same thing. So you don't have to memorize this thing. Just get into the logical part. What is the logical part? Anything, not only the bond, anything, if you are getting at a cheaper thing, your effective return will increase. Anything, if you pay a higher price to get a return, obviously your return in effect will going to fall. That is the basic meaning of that. So that was the meaning. That was the logical meaning. This was the calculation part that I discussed with you. So I'll just increase the font also in case if it is not visible to you. Yeah, you can see this. This is basically in percentage. 6.69% is the yield to maturity in percentage. Okay, what I'll do, I'll just solve this particular thing for everybody. So I hope these basic data is clear to everyone. Like future value, present value, this is clear to everyone. There is no problem in that. What I do is equal to, I type rate. As I type rate, I open the bracket. Now in the bracket, you can see it is asking the first thing which is mentioned in PER. So what is NPR? You already calculated is 16. How you got 16? Total maturity is 8 year. Semi-annual coupon rate is there. It means 2 times you will receive the payment. So how many times during the life you are going to receive the payment? 8 into 2, that is 16. So I put it here 16. Then put comma. Then it asks you PMT. The moment you put comma, the next variable you will see that it gets highlighted. So currently you will see that PMT is getting highlighted there. So it is asking you PMT. PMT is nothing but the repeated payment that you receive or that you pay. In this case, you are going to receive repeated payment 40. From where you got the 40, 8% is the coupon rate. 8% is on 1000, which comes to 80 rupees. but you are not going to receive entire year payment. You are going to receive 2 times in a year. So if I want to split in 2 times, 80 divided by 2, it comes 40. I will write it here 40. Then you put comma. It asks you present value. What is the present value? The price at which you purchase the bond. At what price you purchase it? 1050. When you purchase something, there is outflow of cash. Outflow of cash has to be denoted in the negative sign. So I put minus 1050. Then I again put a comma. It asks you future value. Future value means in future, what money you will receive. You are going to receive the par value. That is a maturity value. That is 1000 rupee. So I put 1000. And I just simply close the bracket and I press enter. The moment I press enter, I get this particular answer, that is 0.04. But this 0.04 is not correct. Why? Because it is not formatted cell. So I go on this particular cell, I right click, I do the format cell. The moment I do the format cell, you can go on the number category and then you select the decimal and take it 2. And after then you do it okay. The moment you do it okay, you will get this particular thing. So just let me see why it's not coming. Just a moment. Number. I'll just increase it to 3. Okay. So you can see this is the answer that I'm getting 0.03. This is number. I want to convert into percentage. So what I'll do, I'll go here and I just say is equal to this cell into 100. This cell into 100. I get the answer. Something I did wrong. This cell into 100. I get 3.5836. This return is for 6 months and we want the return for annualized return. So basically what we will do, into 2. Why into 2? Because semi-annual coupon, we did all the calculations for half year. Now we want it for the full year. So into 2. This is the answer. So that comes to 7.16. Either you say 7.16 or you say 7.17, one and the same thing. So this was the way you got the answer. We go to the next part, and that is basically the current yield. I just explained current yield in my own word. Current yield simply means that what is the return for the current period, that is for the current year. We are not talking till maturity, we are talking for the current period. So right now it is given, for example, say an investor currently holds a bond whose par value is $100. This is not 1000, this is $100. The bond is currently priced at a discount of 95.92, matured in 30 months, and pays a semi-annual coupon of 5%. So various things are given. Semi-annual coupon, 5% is the total annual interest, but it will be split into 2 parts, that is 2.5, 2.5. And the person got the bond at 95.92, but actual face value of the bond is $100. What is the total maturity time period? 30 months. It means like 2.5 years, but let us say it is 30 months. How do you calculate the yield on the bond? Already the calculation is given to you. First of all, you will calculate 5% into 100. So obviously, if you calculate 5% into 100, it comes to 5 rupee divided by 95.92. Why? Because you are getting this much of earning, not on 100 rupees of investment, but you are getting it on the investment of 95.92. So you divide by 95.92 and you get the answer 5.21%. So basically here what we are doing, we are not taking series of payment. We are not talking about so many years. We are just talking about the current period. Even though in the problem it is mentioned that there is the bond will mature for 30 months. But are you considering 30 months? The answer is no. Why? Because we are just considering the current period. Because the yield is not yield to maturity. The yield is nothing but the current yield. Means the yield in the current period, what is to the investor, that we are going to calculate it. So just for your purpose, let me just frame another question. Let us say par value. I'm just making a little bit of change and I want you to solve that also. Let us say the par value is 100. Let us say market price is say like 102. And let us say I am not giving you the maturity period because anyhow you have to calculate the current yield. I'll just say one rate is say like 6%. Where is the percentage? 6%. Sorry, I wrongly typed 60%. So it is like 6%. And let's say only this much of data is there. I hope this is sufficient. Yeah. Calculate the current yield. Please do not use the rate formula here. The rate formula is applicable for calculating yield to maturity. This is a just simple one-step mathematical step. You do not have to use any formula here. So please calculate current yield. Everyone getting 5.88? Okay, so we can conclude the answer is correct. That is 5.88. Let us say that if I say you purchase the same bond at 100 rupee, what would be the yield? Current yield? It would be 6%. So always remember, when your purchase price is equal to the par value of the bond, the coupon rate itself is the yield, that you do not have to do that any calculation. It means that if you purchase the bond at 100 rupee, So, and if the par value is also 100, obviously the coupon rate will become the yield of the bond. So it will be 6%. No formula is required. No calculation is required. Straight away, you can give the answer that it will be 6%. And one basic rule, if you purchase the bond below the par value, let us say if it is at 95, what would be the answer? You will calculate it. One thing you are sure that it would be greater than 6% because you are getting the same return by paying less price for the bond. So obviously your yield is going to improve. And if you purchase the bond at more than 100 rupee, then whatever is the coupon rate, the yield will be below the coupon rate. This is the basic difference that you have to understand. So whether you calculate yield to maturity or you calculate the current yield, the basic funda will remain the same in both the cases. Only the difference is in current yield, you just calculate yield for the current period. You are not making use of number of period. But when we talk about the YTM, we use a specific function called rate, which basically capture number of periods also. There we have that particular function called NPR. So we calculate the number of periods also there. That is the basic meaning of that. So this was the formula. In case if you want to note it, you can note it. I never advocate remembering the formula for one simple reason. Anything which can be done on the Excel, better not to do through the formula. The moment you type is equal to rate, everything it is going to ask automatically. So you can apply your basic sense like whatever we discuss right now, PV, FV, etc., and you can calculate it. Let's move to the next part. What is dirty price versus clean price? This is the last part of this particular chapter, dirty price versus clean price. Again, I'll try to explain in my simple word. Suppose if I am purchasing some particular bond from the market, let us say on the stock exchange, I'm purchasing a bond in the US market. So whether that particular bond currently have the interest element into that or not, that will determine whether it is a dirty price or the clean price. So for example, we know that this bond will pay interest 2 times in a year. Let us say it is paying interest in the month of July and in the month of January. I am purchasing, let us say, in the month of June. So obviously, if I purchase the bond in the month of June, then I am eligible to receive the interest for the month of July, because in the month of July, the bond is registered in my name since I purchased it in the June. So the price that I'm paying at the time of purchase is called the dirty price because the price includes the interest element also. It means whoever purchases the bond in the month of June or any particular month which is just before the date when the interest payment will be made by the company. So that particular price is not just the price of the bond, but it also includes a component of the interest element, and that price is called as a dirty price. Let us say on 5th of July, the company has paid the interest. And on 6th of July, if I purchase this particular bond, will I be eligible for the interest of this particular quarter or this half year payment? The answer is no, because now 6th of July, I'm not going to receive the interest. The last date to receive the interest was to hold the bond till 5th of July. After that, if somebody purchased the bond, now he will not be eligible to receive the bond for this particular half year. Of course, the next half year, which will be coming in the month of January, that is a different story, but this July month interest is gone. So this particular rate, that is 6th of July onward, which is going to be quoted, that particular rate is called as a clean rate. It's not a dirty rate, it's a clean rate. Why? Because ultimately now the price is not capturing the interest component. It means any person who is willing to purchase this particular bond on 6th of July, he is just paying the price of the bond, but he's not eligible to receive any interest payment. So we call this particular price as a clean price. I'll give you one numerical example. Let us say that the bond is quoted in the market, let us say normally at $960. But suppose it is quoted in the month of June. So let us say it is quoted at $980. Why it is quoted at $980? Because if you purchase this particular bond, you are entitled to receive at 980. It means that you are paying $20 extra to receive that interest. Let us say that on 6th of July, if I want to purchase the same bond, and $20 is the interest payment. Obviously, now on 6th of July, the bond price will not be $980. It will become $960. Why? Because already the $20 is being paid as interest to the customer or to the investor. So why would I pay the same price which I was paying in the month of July? I would not pay that much price. So this is basically called as a clean price. It means once the interest adjustment is done, after that you purchase a bond, then you purchase at a reduced price, which is basically adjusted for the already interest paid, and that price is known as a clean price of the bond. Okay, and here now some additional points are given. Just what additional point is there that I'm just highlighting. when bond prices are quoted on a Bloomberg terminal. I hope you know what is Bloomberg. I already explained you that in the US market, if you want to see the prices, there are different terminal. One is Bloomberg terminal, another is Reuters. This is not the stock exchange. This is we are talking about the terminal. So they are quoted using the clean price. It means when we talk about these specific terminal, on these terminal, the prices are always quoted as a clean price. The clean price is mostly quoted in the US bond market, and the dirty price is mostly quoted in the European bond market. So just for your knowledge, you can understand that you're normally in the US market, it is clean price always quoted. And basically in the European market, always the dirty price. What is the meaning of the dirty price? The price which includes the interest component. What is the meaning of the clean price? Which excludes the interest component. It means any person who purchased the bond at a clean price, he is not eligible to receive the interest because already the prior person, the previous person who has purchased the bond from the market, now he has got that particular interest. So if I purchase the bond after that particular date, it cannot happen that earlier person also got the interest and I will also receive the interest. Only one person can get the interest. So it means I am paying lesser amount for that bond because this is we call it as a clean price. So this is what it is given. Further, it is given last paragraph. In simple terms, if seller of the bond demands the already accrued interest means interest which has become due to be paid on trade date itself, then the bond is said to be having traded at dirty price. So trade date means, as I said, 5th of July, that is called as a trade date. So till 5th of July, if you are purchasing a bond, it means you will be entitled to receive the interest. It means you are paying a dirty price. After 5th of July, let us read what is given there. If the bond seller does not include accrued interest, then the bond is said to be trading at a clean price. So it means after 5th of July, basically any person who is selling the bond, he cannot demand extra price because already interest is received. Other person will not receive the interest. So now the price has excluded the interest component and it has become the clean price. So I hope this is the basic meaning that you have to be clear. You can forget about where it is quoted and what it is quoted. You just remember what is the difference between the dirty price and the clean price. Already we have done all this, but I hope this comparison will help you to make things more clear. Difference between the equity and the bond. So the first thing is equity shareholders are the owners of the company. So let us say that if I purchase equity shares in a company, I told you in the initial lecture, I can basically participate in the meeting of the company and I'm eligible to vote in the matters of the company because I'm an owner. When we talk about the bondholders are never owners of the company, but they are just creditor. Creditor means what? You have lent money to the company for a certain interest payment, and after a certain period, you will demand back your money. That is why you are considered to be the creditor to the company. The second point, return on equity is dividend. I hope you know this very clear. And return on bond is coupon. And you know, coupon is nothing but what we call it as interest payment. Next point, equity has no maturity date. Time and again, we have discussed equity is a very long-term capital. And whenever we raise money in the form of equity, basically it has not to be returned back to the shareholder. That is what we call equity has no maturity date. Only exception is if the company feel that we want to buy back the shares, that we want to reduce the number of shares in the market, then they can go for the buyback. That too, it is not compulsory, and that too, they will not 100% do the buyback. They will only buy back a certain amount of share. There can be one more exception if a company wants to compulsorily delist the shares from the stock exchanges. There are certain companies, particularly the foreign company, which entered into the Indian market. At that time, there was a regulation that you have to get compulsorily listing on the stock exchange. So they got it listed. There was a condition that after a few years you can get the shares delisted. So now they've got the share listed because they feel that if the shares are within the Indian public, the dividend will have to be paid to the Indian company, and we want to restrict the company to a private level also. So after a few years of compliances with the regulatory approval, they have got it delisted. So just few examples like Xerox, you know, the photocopying machine, that is Xerox. Cadbury, Racket and Benckiser. Racket and Benckiser is a company which manufactures the Kiwi polish and the Dettol. The Dettol and Kiwi are the two best brands, which is by Racket Benckiser. So earlier it was known as by Racket and Coleman. So these companies have got delisted. But apart from that, under other circumstances, the company will never return back the money to the shareholder. That is why we say equity has no maturity date. The third, when we talk about bonds, you know that bonds have a maturity date except perpetual bond, because today you have studied perpetual bond, which means it is for infinite period. Whoever holds the bond will continue to get the interest rate, and these bonds will never mature during their lifetime. That is basically perpetual bond. Fourth thing, equity shareholders have voting right. Obviously, bondholders do not have voting right. Equity is traded over an exchange plus OTC. It means I can trade the equity share of any company on the stock exchange also. And let us say if I feel I do not want to do the trade through a broker, I do not want to sell on exchange because it will include brokerage and other taxes. I can say, okay, one of you want to purchase shares from me, and you say yes, I'll directly shares to you. So when we sell any particular thing among each other, that is one person to another person, we know both each other, that transaction is called OTC transaction, or in other words you can say over the counter transaction. Over the counter transaction is not a stock exchange transaction, it is a general transaction between any two people. There is always one specific risk, and that risk is called a counterparty risk. If one of the party default, then you cannot do any particular thing against that particular person. When we talk about the bonds, usually in the US market, bonds are mostly traded on the OTC market. We are not saying that stock exchange there is no trade, but mostly you will find that it is OTC trade. That is because in the bond market, usually very big participants will be actively participating. Say for example, like big institution, pension fund, governments, insurance company. So these companies may have direct transactions with each other, and that is why we see a lot of OTC transactions happening in the bond market in the USA. Last but not the least, at the time of winding up, equity shareholders are paid after bondholder, or in other words, I can say equity shareholders are the last kind of people who will be paid in case if the company become bankrupt and they go for liquidation of the asset. But in case of the bondholder, if you remember, we have studied that part, collateral versus non-collateral. So if the bonds issued to the bondholder are backed by security, it means these are the secured bonds, then in the event of winding up or liquidation of a company, these bonds will get preference. That means over the equity shareholder. It means first we will pay to the bondholder. If you remember, then we will pay to the preference shareholder. And after preference shareholder, if still money is left, then it will be paid to the equity shareholder, which usually will never be the case. If there would have been so much of money that we can pay to everyone, then why the company would default? So practically speaking, the equity shareholders will not get any money at all. Even if the bondholders get the money, that could be also a very big thing. But if you know that the company is already in very bad shape, then you remember that concept. There can be a bond which is a junk bond, and in case of a junk bond, the chances of default are very high, which means even if the company is liquidated, might be still you will not get any money because the company is in very bad shape. So this is just about a general comparison between the equity and the bond. Introduction to foreign exchange and money market. First, we will start with what is money market. If any particular instrument is raised for a period beyond 1 year, means if you are raising capital beyond 1 year, that particular instrument will be called as a capital market instrument. But if you are raising money for maximum 1 year, then that particular instrument is known as a money market instrument. So money or its equivalent can be traded on a money market. Liquidity is a synonym for money. Financial instruments with high liquidity and very short maturities are traded in this area of the financial market. The world's financial system includes money market, a market for borrowing and lending for a very short period of time. In contrast to a stock exchange, the money market is a system rather than a specific location. So two things we have to remember as per this particular slide. Number one, when we talk about money market, exactly it is not a place, but it is a system. In simple word, when we talk about different instrument whose maturity is beyond 1 year, or not beyond 1 year, within 1 year, we say that it is a money market instrument. So it's not a place, it's a system. And second important thing basically that we have to understand is that in contrast to capital market, these are very, very short-term maturities instrument. So when we talk about stock market or when we talk about capital market, the formation of capital or the raising of capital is not for short-term reason, but it is for very, very long-term reason. That is the basic meaning of the money market and the capital market. Going forward, we will see some more features. Governments, major institution, and perhaps even individual frequently turn to money market as a solution to their short-term liquidity demand. So whenever any particular entity have a very short-term liquidity, for example, if any company or a private corporate wants to raise some working capital money and they are not able to raise that money through bank, they can borrow money from bank, but might be they have already exhausted that particular option and they still want to raise some short-term money. So where they will go? They will go into the money market. And in money market, we will have different instrument that we will study very shortly. Those instrument will help either the government or corporate or even the banks to raise money for the purpose of the short term. So when I'm talking short term, we precisely mean that we are talking for period less than 1 year. Let us see what is given in the second paragraph. In this market, funds are offered for short term ranging from 1 day to 1 year. So important point is 1 day to 1 year. When we talk about 1 day, we usually call those instruments as overnight instrument. Either you can call them as short term or very call money instrument. That is, you can call such instrument on a very short notice. So we say notice money or call money instrument, or more precisely, you can say it is overnight instrument when we are issuing for 1 day. Banks and other financial organization as well as the government mostly control this market. So who are the major participants in this market? Banks, financial institution, and usually government. These are the basic people who are participating in this market. A physical money market does not exist. If you want to see that where is this market available, so physical market is no way visible. It is an unofficial network of banks and traders. Instead, money market trading is wholesale and over the counter. So whenever we do trade between two party, like you and me are doing trade with each other, so we are not officially doing any particular transaction on a stock exchange. We are mutually settling the trade between each of us. Such particular transactions are called basically over the counter. And second word mentioned is money market trading is usually wholesale. So what do we mean by wholesale? Trading happens in bulk quantity, and bulk quantities basically who does it? Not the retail investor, but usually the institutional investor. When we talk about institutional investor, it is usually the government or the private company or the banks or the financial institution. These are the institutional people and who does work in very bulk quantity, and that is why we say it's a wholesale market. So these are the certain basic features, and money market simply means that whenever securities are issued for a period of less than 1 year maturity, those instruments are called basically money market. And participants could be many entity. It could be government, it could be financial institution, it can be corporates. So different entities could be there, but mostly it would be wholesale transaction, not a retail transaction, not a transaction like between you and me. It would be transaction between big institutions. So that is the basic meaning of the money market. And any bank, if any particular bank want to raise money for 1 day or 5 days or 1 month, so what type of instrument they are raising? That is nothing but money market instrument. So how it is an official network, since the people or institutions transact using certain well-established channels. So unofficial network means there is no mechanism as such called exchange. That way we are talking unofficial. It means it would be understand when unofficial here, the meaning is that whenever two entities are transacting directly between each other, they know it that we are transacting with you, or say like X bank is transacting with Y bank, so they know each other. Such markets are called as over the counter market. It means that it is not on the stock exchange. When we do on the stock exchange, we consider it to be more official for one simple reason, that ultimately the parties are anonymous to each other. We do not know if you should sell the share or if you buy the share, you do not know from which party you are transacting on the exchange. So that way it becomes an official. Here unofficial, don't take it in that way that it is unofficial means it has no validity or it is completely without any law or regulation. That is not the meaning. The meaning is that these transactions are mutual between the party. If bank is doing with another bank, or say like government is doing with some particular specific investor, so these transactions are between one to one, and that is why we say it is a over the counter transaction. You can refer the last word given in this particular slide, just the last wording, that these particular trading is wholesale and over the counter. So when we are talking about over the counter, mostly because short term whatever is happening, that is mostly over the counter. So suppose if ICICI Bank is raising money for Axis Bank for 2 days. So normally we will assume that Axis Bank will not default with ICICI Bank because these are big institutions. But let us say that if you and me are doing transaction with each other, there can be a chance that I can default or you can default with me. But institutions normally don't default. So that is the basic underlying assumption. But still now, suppose if there is a situation like in US market that a particular bank has defaulted, you know that particular story. So
Yes,
that
sir.
can happen. So if any particular trade which is happening over the counter, that possibility can always be there. Second thing is whenever we talk about any particular instrument whose maturity is for a very less period, which is within 1 year. So suppose today, if I'm raising money from someone or somebody is lending money to me and say like for 1 month, 2 months, 3 months. So obviously they will assess my financial situation. And if my financial situation looks very good today, so all of a sudden within 3 months, it's not going to turn very bad. It will take some period of time. So usually we consider that during any particular instrument, which is for a short-term maturity, the transaction usually sails through. The transaction is not in a problem. Even if the party has to get into problem, it will get into problem later on. It will not happen that within 1 year something going to happen. But of course, exceptions can always be there. So anything can happen. You have seen in many cases that even governments have also defaulted. So forget about the private institution. When the country's economic situation gets worsened, in that situation, the government also default. There have been many instances in the past where government itself has defaulted. The later one, I think it was Sri Lanka. So that can always be a possibility. But generally speaking, this is the situation. Right. So the institutions, banks, government, these are the people who participate in this segment. So suppose if you say that you or me, we want to buy this particular money market instrument. So that is not a possibility because it's not meant for retail. Even again, I want to draw your attention to the last line of this slide. You can just see money market trading is wholesale. What do you mean by wholesale? Bulk transactions are happening. So who does the bulk transaction? Not the retail investor. It is between the institution. So we move to the next part now, major players in the market. So you can see in the first para that ultimately all those things that we discussed multiple times, these are the basic players. Now you can see in the first bullet point, one more point is mentioned. Banks play a dual role, both as an issuer and lender. Between the issuers and lenders, these are intermediary. It means that sometimes one bank will borrow money from another bank, or sometimes the bank will act just as an intermediary, that there are two entities who wants to give money to each other. It could be two banks, or say the government wants to raise money from some another entity, or government wants to give particular money to some other entity. So bank can act just an intermediary. You know what is an intermediary? Just to bring the issuer and the investor together. Rather than saying buyer and seller together, we will say issuer and the investor together. So both the things can happen. The second point, intermediaries in and dealer. There are specifically dealers also in the market. The issuers lend the money to the intermediary, and the intermediaries further forward the funds to the lender. So I hope even if this statement is not mentioned, it is very much clear that ultimately the procurement of fund and supply of fund from one entity to another entity will be done by the intermediary. And in that way, there would be certain transaction cost, whatever commission or brokerage, whatever you say, you will pay to the intermediary, and that is going to increase the. Is there a possibility that we can avoid intermediary and directly go into a transaction? Very much possible. Let us say there are two banks in the market and both of the banks want to do transaction with each other and they have complete faith in each of them. They have trust in each of them. Might be they do not want to engage an intermediary in between. They will negotiate the terms of the contract or the terms of the deal or the terms of the issue with each other. And if they find it favorable, amicable between them, then they will go ahead with that particular transaction. So not always necessary that there is going to be someone as an intermediary. There can be intermediary, there may not be an intermediary. Now, what is the structure of the market? So you can see here, there are 2 points given. One is called organized money market and another is unorganized money market. Let's not jump to any conclusion. Let us see what is given further and then we will see what is there. So when we talk about the organized money market, see who are there. Reserve Bank of India, the scheduled commercial banks, lenders, the development bank, the investment institution, the regional rule bank, the foreign banks, among other. In short, we can say that when we are talking about organized money market, you can just figure out from the names that mostly it is RBI, central bank, that is Reserve Bank of India, and other bank, by whatever name you call it, whether you call commercial bank or you call it as regional rural bank, but mostly these are the bank. This is called an organized market in a technical way. If we say unorganized market, so it means that it can include indigenous banker. Indigenous bankers means who have not actually the banker, but they are acting as like, say, like payment banks or say like small finance bank. I hope you must be knowing there are certain small finance bank. So these are called indigenous banks also. The domestic money like local people, nidhis and chit fund, these are operating in an unorganized market. So nidhis and chit funds are like they're not a registered entity and these are not regulated. If you invest in nidhi and chit fund, there can be a likelihood that there can be default, and might be in the past you must have heard a certain chit fund from the I think West Bengal side also, which went for certain problem and lot of investors lot money. So basically, in short, these are not regulated entity. These are not governed by any particular regulator, and still transactions are happening. So we can say basically this is nothing but the unorganized market. So in short, we can say that even the money lender, in most of the small places you will find that there are a lot of unofficially money lenders also, like who will take basically your gold, silver, something, and against that they will give you some money on lending basis, and that will be very, very high rate of interest. They will charge you very high rate of interest. So whether this is an organized market? No, absolutely not. This is basically an unorganized market. So you can see you also have the sub markets, which include dedicated markets for call money, bill market, 364-day bill market. All this we are going to see that later, and that will be a different kind of a market. So this is basically the basic difference. Organized market, basically when we talk about all related to banks, whether it is a central bank or commercial bank, and unorganized market mostly either very short term, or we can say basically people who are doing transactions, even people are running schemes also, you know that. So these are certain unofficial markets. So far they are honoring the commitment, it's fine, but if some of them default, then ultimately that is not a regulated thing. That is basically called a unorganized market. Now, when we talk about instruments of money market, the first is called interbank lending. The interbank lending is also known by other name, which we are going to see shortly, which is also called as call or notice money market. I'm repeating, it is also called call or notice money market. So as the name suggests, interbank lending, what does it mean? One bank with surplus money may give money to another bank which is having shortage of funds in the short term. So there can be a situation that a particular bank have got a lot of deposit, but in the short term, they have not got so many customers who are taking loans. So they are sitting on surplus deposit. Then there can be a situation, another bank, basically because of their good marketing strategy and campaign, they have been able to give lot of loans to the people, but they are not having their own deposit so much. It will take time to mobilize the deposit. So in order to meet this short-term deficit, they will basically borrow money from another bank. That is also called as interbank lending. The second point is Treasury Bill. So Treasury bills are issued basically by Reserve Bank of India on the pretext or on the recommendation of central bank. So who is basically raising money? It is basically RBI. That is called T-bill, or that is called Treasury bill. The third is commercial paper. Commercial paper are again short-term instrument which are raised mainly by the corporate. So if the corporates are raising long-term money from the debt market, either we call it as bonds or debenture. But if they are raising money for very, very short term, say for 3 months, 6 months, within 1 year, so we technically call that as commercial paper. Repurchase agreement, I hope you must be knowing the repo rate. We call repo rate. Repo rate is nothing but repurchase agreement. It means the transaction is happening between RBI and the banks. So there can be a situation where instead of banks borrowing money from another bank, they can even go to RBI and say that we need some money. So whatever interest rate the RBI charges to the bank, that basically is a repurchase agreement transaction. We call it as a repo rate transaction. Just for your knowledge, that suppose if opposite happen, that basically banks are having surplus fund and they are keeping that particular money with RBI, in that particular situation, it is called as a reverse repo transaction. So repo transaction or repurchase agreement transaction means RBI to banks, and reverse repo means that banks are parking their money with the RBI. That is called reverse repo transaction. Again, for your knowledge purpose, you should remember that whatever is the repurchase agreement interest rate, let us say that RBI is charging, for example, say like 5%. I'm just giving you an example. I don't know what is the exact rate currently, but let us say that they are charging 5% to the bank. So what should be the interest rate when the banks keep the money with RBI? It will be less than 5%. It means that RBI will charge banks more, but when RBI accept deposit from the bank, which is called reverse repo transaction, that will be a lesser rate. So you can say that reverse repo rates are always lesser than the repo rate. Repo rate is always greater than the reverse repo rate. This is the first thing. And last is Treasury bill. I hope that doubly it has come, by mistake it has come. So you know what is the meaning of the Treasury bill. So this is about the certain instrument. There are many other instruments also, certain instruments of money market, which we have discussed right now. Whenever a company, say like Reliance Industry, want to raise money for 3 months, 4 months, 6 months. So what is this instrument called as? Commercial paper. Means if they are raising money for very short term, in that particular case, the instrument through which they raise money, that is called commercial paper. What is call money? So as I told you, call money basically is something related to bank. Let us see what is given here, and then I'll explain in simple word. Refers to deposits for an unspecified term, which is renewed on a day-to-day basis. Lender can call back the funds at any time and they are repaid on the same day. So basically, if we want to understand that what is the basic meaning of the call money, as the name suggests, that this money is available on the call. And usually this call money will be renewed day after day. So simple example, let us say today ICICI Bank has taken money for HDFC Bank. Whether this particular money will be with ICICI Bank forever? No, not forever, but it can be for substantial time. But usually the transaction is for one day. If they want to continue this transaction again for one more day, then it will be renewed. It means that the terms of the contract for between the two banks are for one day. And if they want to continue the same transaction, then it will be renewed on a day-to-day basis. At any point of time, if one of the bank which has lent the money, they do not want to continue the transaction, they say that we are also now having shortage of fund, we want the funds back. So they can call that money at any point of time, because ultimately it's only one day transaction which is happening at any given point of time, and the money will be returned back by the person, but they have to return the money within one day. That is the reason that we call it as call money. The other point which is given, notice money, refers to money borrowed for a period of 2 to 14 days. So I hope now the difference which comes is, call money transactions are basically renewed on a day-to-day basis because it is available on call. Anytime you can call. So it's available on a day-to-day basis. But when we talk about notice money, it is also very short duration money, but this is usually for a period of 2 days to 14 days. Why not 1 day to 14 days? Because 1 day transactions are already covered in call notice money market. But when we talk from 2 days to 14 days, then basically it is called as a notice money market. Combined way, sometimes we usually say it's a call and notice money market. Further, it is mentioned the exact number of days is specified at the start of the contract. So suppose if IndusInd Bank is giving money to Kotak Bank, so for how many days they are giving? So first of all, if it is a call money, it means it is only for one day. If they say it is for notice money, then they will have to specify that this particular contract which we are having with you, suppose if we are lending 1 crore rupees, or say like 100 crore rupees one bank to another, so we are lending it for 5 days. So they cannot lend beyond 14 days under notice money concept. If they want to do it otherwise, that's a different option. But if you are following notice money instrument, then under notice money instrument, the minimum duration would be 2 days and the maximum duration would be 14 days. Beyond 14 days, notice money will not be applicable. Then there are other alternative instruments through which you can raise the money. That this transaction is happening usually between whom? Between the two banks. This is not between any other entity. This is not the private corporate which is raising money. This is between the banks, because banks will always have certain kind of money issue, either with related to surplus of fund or related to some shortage of fund. So as a whatever is the case, according to that, basically they will borrow money. Now, just for your knowledge, it's not mentioned here, but question can come that suppose if X bank is following interest rates, say like 3% for short money, they are following 3%. There is another particular bank which is say like following interest of 3.5%. So one is following 3%, another is following 3.5%. How this transaction will go through, whether the transaction will be mutually decided or how it will go through. So when we talk about the Indian market, in India, we have a uniform interest rate for lending between the bank, and that particular rate technically is known by a word called MIBOR. It's not mentioned here in the slide. I'm telling for your knowledge purpose. It's called MIBOR. So what is the meaning of the MIBOR, or what is the full form of the MIBOR? It is called Mumbai Interbank Offer Rate. Mumbai Interbank Offer Rate. What does that mean? That at Mumbai, a particular interest rate is decided, which will apply uniformly to all the banks which are doing interbank lending for a short period of time, say like for 1 day, 2 days, 14 days, whatever is the case. So for that particular period, whatever rates banks may be following, that's a different story. Interbank offer rate, which is decided in Mumbai under this particular organization called MIBOR, that particular rate will be accepted by all the banks for the purpose of uniformity, so that all the banks follow a single rate, that is called MIBOR. The same practice goes at an international level. Suppose at international level, banks are doing transaction between them. Say for Germany bank wants to raise money from a say like a France bank or Italy bank or Denmark bank. So what rate they will follow? Because might be different particular countries will have different interest rate. So in that situation, usually, I'm using the word usually, they will follow the rate called LIBOR rate. What is LIBOR? LIBOR is nothing but just like MIBOR. It is London Interbank bank offer rate. It means that whatever interest rates are decided in London, that will be applicable to all the bank. If you feel that you want to do the transaction, you can do it. If you feel no, this particular transaction at that LIBOR rate or at the MIBOR rate domestically is not viable for me or not profitable more for me, or I do not want to do that transaction at that rate, it's absolutely your choice. But if you have to do for short-term transaction, then MIBOR would be applicable within India, and LIBOR, HIBOR, there are many other such kind of rates also, which is applicable at an international level. I am not covering all of them. Just for your knowledge purpose, I would discuss. Interest rate is decided at Mumbai, where it will be a association or a consortium or a bank which have decided there, but it is applicable to entire India, not in Mumbai. Because when we talk about the banks, so banks basically does not mean that we are talking from branches point of view. We are talking about a banking as an entity point of view. So that bank could be registered anywhere in India. Ultimately, the rate that will be acceptable for interbank lending, that would be the MIBOR rate. So now weekend money, just as you have seen 1 day money, 2 day to 14-day money, that was call money, notice money. Now your weekend money. So what it is refers to overnight money borrowed on last day of the week with repayment being scheduled for following Monday is called weekend money. So basically this concept is like over the weekend you have borrowed because you know there is going to be a holiday. So anyhow on the holiday you cannot raise fresh money from the deposit. The deposits, even if it has to come, it will come on Monday only. So during this particular weekend time period, if you have borrowed any particular money, that money is called weekend money. That weekend money can be 1 day money, 2 day money, 3 day money, depending how long your weekend is. Suppose if the weekend is for 4 days, that there are 2-3 public holiday or say like a festival, and one Saturday is coming which is also holiday, then Sunday we already have a holiday, and like way 4 days are coming as a holiday period. Obviously this weekend money will become a 4 day money. So there is no definition to that, but it simply means that before the end of the week, whatever money you raise and ultimately you pay that money on Monday, on the coming Monday, that is again you have to assume that on the coming next working day after the weekend is over. It can be a situation that again on Monday is also it's a holiday. So then it means that it goes on the Tuesday. So that meaning has to be understood. Next is term money. So term money basically refers to money loaned or term for a fixed period such as a week or a month. So it can be anything. As we are talking about the what to say money market, one thing is clear that it has to be within 1 year, but it can be any particular term within 1 year. So not any condition. It because it's a term money, you can fix the term. The term can be from any time period. It could be a week, it could be a month, 2 months, 3 months, 6 months, up to 1 year. You can fix any particular term that is called as a term money. And last is intraday money, refers to money loaned and repaid on the same day. So even you will not get 1 day of loan period. It is like you just take the money in the morning and before the close of the banking hours, you will return the money on the same day. That particular money is called as a intraday money. So there can be a possibility that a particular bank might be got some good ticket size loan customer and they want to pick up say like 100 crores of money in the morning. So they have to give that money. So they have borrowed that money temporarily from another bank and they have given the promise that within the day itself through various deposits of from coming from various branches, we will return your money on the same day. So that is called basically intraday money. So don't confuse with intraday and 1 day. 1 day money means for 1 day, means today I took money, I'll pay it tomorrow. Don't confuse money 1 day money with weekend money. Weekend money can be any day, but it means that just before the end of the week, you take the money and on the end of the week, that is starting of the next week, you repay the money, which usually is basically Monday. And last one thing, intraday money. So no days are involved here. It means the same day. Intraday money means what? Same day. You take the money on the same day and you return the money also on the same day. That is called basically intraday money. So today, if a particular bank has taken money in the morning from another bank, and today itself they'll return before the banking hours are closed to another bank. So this is called what? Intraday. Let us say that on today 18, some bank has taken money for 1 day. So 1 day means what? That tomorrow they will return it. So that is what it is, a call money. So call money is renewed on a day-to-day basis, means every day it will be renewed. So 1 day would be minimum time you will get it. But in intraday money, you will not get even 1 day time also. You just get the cushion to take money in the morning and return it on the evening. Usually it happens in a day-to-day life also, na? That sometimes we are going to office and might be I don't have money. I'm talking about myself. So might be I took money from my uncle and I told him while returning from my office, I'll just take money from the ATM and I'll pay you back in the evening. So what kind of money is this? This is intraday money. The same goes with the banks also. Might be they have some commitment to give money to the customer in the morning and they don't get deposits early in the morning, but during the course of the day through various branches they will get lot of deposit. So in the evening they will return that particular money. So they have taken money in the morning, they are returning in the evening. This is called basically what? Intraday money. Advantages of interbank lending. First is high liquidity. So I hope what is the meaning of the word liquidity you understand. Liquidity simply means that whenever you have sufficient cash or whenever you can get cash easily, that is called liquidity. So first of all, whenever we talk about the call market, notice market, or say intraday market, any short-term market, basically where interbank lending is there, lot of liquidity is possible. It means the bank is not afraid whether we will have money from another bank and give it to their customer, and later on they can repay to the other bank. So this is called basically the liquidity is possible. Secondly, high profitability. So any bank which is sitting on surplus cash and there are no customers who can take currently any particular amount on loan. So instead of keeping that particular money as idle, because you know already you are paying interest to your customer, so you do not want to basically keep your money idle. So your interbank lending offers that opportunity to the bank that they can lend this surplus cash to another bank and thereby they can generate certain profitability. So this high profitability simply means that it becomes a parking place for the bank in the short term to give it to another bank which is having shortage of fund. So basically it's a win-win situation for both the people. When one particular bank deprived of money, they can get it very easily, which means we are talking about the liquidity part. Another bank which is actually flushed with lot of liquidity, they can basically make certain return upon them. Suppose if this have not been the situation, there is no particular call money market or notice money market. In that situation, whatever money we are having surplus kept with us crores of rupee, that particular money is not earning any interest for us. But on the contrary, we are paying interest on the deposit. So it becomes a cost to the bank, but now the bank is able to generate certain profit out of that. So this is basically called as a profitability avenue also for the banking system. Now, moving to the next part, meaning of SLR. So I'll just first give you what is the basic full form of the SLR, and I'll explain in my own word, and then you can just read it what is given in the slide also. So SLR full form is statutory liquidity ratio. Now, when the bank takes money from you as a deposit, suppose if the bank takes 100 rupees as deposit, out of that 100 rupee, no bank can give 100 rupees as loan to the customer. Out of that 100 rupee, there are two things essentially which a bank have to keep it inside way. One is called statutory liquidity ratio, which means that in the range of 20 to 21%. It keeps on changing, so I'm not having exact idea. Currently, it is 20% or 21%. But out of the total deposit, 20 to 21%, the banks have to park that money in government approved security that is called statutory liquidity ratio. So let us say that bank has taken deposits of 100 crore. Out of that 100 crore, suppose if the SLR in the system is currently 20%, it means that banks will have to park this 20%, means 20 crore out of 100 crore in certain government approved security. Whatever the government has issued security in the market, they will invest into that particular thing. This is called basically SLR. Another thing is CRR, though not mentioned here, but since we are discussing SLR, so I'm discussing CRR also. It's called cash reserve ratio. So again, between 4% to 4.5% of the deposit, you have to keep this particular money with RBI. These banks will keep that money with the RBI. The purpose of statutory liquidity ratio and the purpose of CRR is that if the banks do not lend 100% of the deposit, it is a safe way of doing the banking. It means that at any given point of time, if the depositors come and ask money, or if there is any particular default into the system, the banks will not get into immediate problem because certain money is already invested either with the RBI or in certain government approved security. So we can liquidate those particular instrument and give the money to the depositor. So that is basic reason or basic premise, I guess so, or the logic behind that. But even if we don't understand the logic, that's a separate matter. The logic can be anything different, but the rule is important, and that rule is that SLR means out of the deposits, certain percentage, which is around 20 to 21%, has to be parked in the government approved security. Why do we say government approved security? Because we assume that in case of government approved security, it is completely free from default. there is no credit risk. I hope you can recall the bond chapter where we discuss about the credit risk and the default risk. So absolutely there is no default risk. It's completely free from default. That is why it is a requirement that you have to park the money with the government approved security. So this is the SLR requirement. Usually this particular requirement is always maintained on an alternate Friday, means every particular bank's details have to be confirmed with the RBI every alternate Friday, because you know that deposits keep fluctuating. Might be on a particular Friday, deposits are say like 20,000 crore, and might be after two Friday, the deposits could be more than 20,000 crore, less than 20,000 crore. So every alternate Friday, which is also called as reporting Friday from the RBI and the banking point of view, whatever is their deposits, that according to that particular deposit amount, they will have to maintain this SLR of 20 to 21%. So this is the basic meaning of the SLR. Okay, now we go to the next part, that is called safe and cheap. So what is safe and cheap? Though these loans are not secured, they are safe since the participants have strong financial standing. In simple word, you have kept the money with RBI, you have kept the money with government security. So this is safe and cheap. So basically, ultimately, no one is giving you security or guarantee, but parking the money with RBI and government itself is a very, very secured way, because we know that both these entities are not going to default. That is the meaning of the safe and cheap. It is cheap in the sense that brokers have been prohibited from operating in these market, and therefore banks do not need to pay brokers on these money market transactions. So for earlier, if you remember, we have dealt with in a particular slide that sometimes in money market transaction, there are banking intermediary, and this intermediary will charge you something and which will make the transaction cost little bit high. But since this particular transaction is directly between the bank and the RBI, or between the bank and the central government security or the state government security, there is no intermediary or middleman involved. It means that the transaction becomes cheap also. The transaction is not only safe, but it becomes cheap also, because there is no transaction cost involved. Directly the banks can do the transaction with the RBI or with them, because it's a mandatory, or you can say statutory requirement from the RBI to maintain these particular ratio. And that is why we also assume that the Indian banking system is comparatively not safe. So not we can say 100% safe, but comparatively we can say that it is very much safe. Assistance to central bank operation. So now you know that money market is the most sensitive part of this. Changes and demand and supply of funds are quickly reflected in call notice and term money. So whatever we talk about the short-term rate, the short-term rates can change or it will remain constant. So the short-term rates will keep on fluctuating. It all depends that what is the demand and supply for the short money, or we can say for the call money. So this is not completely dependent upon the interest rates of the RBI. The RBI may change the interest rate, say like in 3 months, 6 months, 9 months, or 1 year. But the call money, or the you can say notice money market, which is basically between 1 day to 14 days money market, this will keep on changing quite frequently, which will be decided as per the MIBOR, because of the demand and supply. So if we find that there is a particular time period where people are taking loan, and at that time the money is in short supply, obviously the interest rate for this particular short and call money market will increase tremendously. So this is basically dependent upon what? Upon the demand and supply. This is called basically the different kind of a central bank operation. Now we come to uneven development. So one disadvantage. Right now we are talking about the disadvantage of interbank lending. So uneven development. Only significant industrial and commercial hubs like Mumbai, Kolkata, Chennai, Delhi, Bangalore, and Ahmedabad are home to the call market in India. So suppose if any particular bank is located, which is not in any of these center, these big cities, they are not present there. So call markets are basically not accessible to them, because either you'll have to go to these big cities only, like Mumbai, Kolkata, Chennai, Delhi, Bangalore, Ahmedabad. These are the big cities where this call market is available. Otherwise, basically, you will have to remain deprived of the funds in the short term. So basically, you'll have to get access to these markets only in case if you want to tap the short term. I'm not saying short term, very, very short term, because when we say intraday or 1 day money, it's very, very short term. So the market has not developed equally. The point that this slide is trying to make is that ultimately this particular market is not developed across India. It is developed only to big city. But ultimately, one thing you have to remember, that even when we're talking about Kolkata, Chennai, Delhi, Bangalore, Ahmedabad, what rate they will be following? Ultimately, they will be following the uniform rate. And what is that uniform rate? That is basically the MIBOR rate. Whatever it has been decided in the Mumbai Interbank Offer Rate, that will be followed by everyone. So this is basically about the uneven development. Lack of integration. We'll see one more point. Different centers call markets are not entirely integrated. Additionally, there are other local call markets that are completely unintegrated. In simple word, he might be the Ahmedabad market or is not integrated with Bangalore market, or Bangalore market is not integrated with Chennai market. So every particular market have their own way of doing the operation. I'm not talking about the following of the interest rate, but whatever way they are doing the transaction, they might have their own procedures and they are not integrated to each other. So like just we have Bombay Stock Exchange is separately operating and National Stock Exchange is separately operating. So suppose if you have purchased some shares on Bombay Stock Exchange today, you cannot sell the same share on the National Stock Exchange today. You have to first get that share on your delivery account, which is called Demat account. Then only you can sell it, because these two are different market. The same thing they are talking, that these call markets are different and they are not integrated to each other. That you cannot do the transaction in an integrated manner in these particular market. All these markets are independent. Volatility in call money rates, it means that you can see in the last point that call prices can change more significantly between centers, between season, between days, or even within a fortnight. The rates can range from 12% to 85%. So 12% to 85% sits up per annum. Don't get confused that it is for one day. It is on a per annum basis. It can change from 12% to 85%. So as it is given, how it will change? Either between center, that different center can have different rate. Between season, so suppose if there is a festival season and there is lot of home demand, lot of say vehicle loan demand, lot of say personal loan demand. So every kind of a loan demand is very, very high. So every bank is basically trying to rush for the loan, but the deposits which are coming is very, very less in number. So still, if you want money in this particular market, you will get it. But ultimately supply is short and demand is very high. So the rate can go as high as even 12 to 85% also. Otherwise, if the market is not in the festival mood or there is not a peak season, in that situation, then it can fall even to 3, 4, 5% also. So that is very rare, but usually the high interest rates which can be 12 to 80. That means there is very, very high volatility in this kind of a market. Okay, so now we move to the next slide. You can see when we talk about the money markets, there are certain terminology which is usually applicable in context of a security. So first is trade date. As the name suggests, the date on which the trade is agreed. Whenever you do a trade, that is called the trade date. Settlement date, that the date on which the actual exchange takes place. It means that might be today I am doing the trade, but might be the money is not happening today. I agreed that I need the money tomorrow, or I need the money 2 days afterwards. So that is basically called the exchange rate. So trade date and exchange date can be same day also, or we can say settlement date can be same day also, or it can be different dates also. So trade date means the date on which I have basically agreed into a contract with the other party, that is will be a trade date. But the settlement can happen on the same day also, or it can happen on another day also. So for example, a bank entered into a contract with another bank that we need money for one day, but we don't need it money today. We will need money on 23rd of March, because that day we want money, because there is some customer who is going to take a lot of loan from us. So we want it for 23rd. So in this case, what is the settlement date? It is not 18th of March, which is today. It will become the 23rd, because the actual transaction is going to happen on the 23rd, but we have negotiated that contract on 18th. So that will become the trade date. Price, cost of contract that the buying party has to pay to the seller. I hope that is very clear. Notional amount which is invested, borrowed, or lent. So that is basically, suppose if I agreed with a particular bank, means any bank agreed with another bank for say like 1 million US dollar, or let us say we are in India, so say like 100 crores of rupee. So this 100 crores of rupees becomes the notional amount. Next is counterparty, parties involved in buying and seller. So any transaction you do, there will be always two party, and this is technically called as counterparty. So who is the counterparty? That will also be mentioned in that particular agreement. Trade direction, agreed to decide who is the buyer and seller of the financial instrument. So obviously one has to be the buyer and another has to be a seller. So we are talking about all the financial instrument. DCC full form is day count convention. I'm repeating, it is called day count convention. It means that when we are talking about the interest, so suppose if I say interest is 12%. So you say that, okay, interest is 12% for the year. But suppose if I want to calculate interest for 7 days, so how would you calculate? You will say that suppose if the notional amount is 1 lakh, so 1 lakh into 12%. Now divide by what? Whether divide by 365 or divide by 366 or divide by 360. So this, what is the day count convention you are following, that will also be mentioned in that particular contract. So usually some people may follow 365. If it is a leap year, they may follow 366. Some people have the practice that neither we want to follow 360 nor 366. We want to follow 360 day for a year. So that particular thing has to be clearly mentioned, because it's going to make a lot of difference in the calculation. These transactions are in lakhs or might be in crores of rupee. So just few days of difference can create ultimately altogether different impact on the total interest rate liability. So this is called the day count convention. You have to mention that in that particular thing. What is the day count convention the two parties are following with each other? Brokerage, if there is an intermediary, then what kind of brokerage we are paying to them? Settlement, final cash amount that will be transferred post execution. It means together with the interest, or suppose if we are adjusting the interest, the net of interest, ultimately what would be the settlement amount that has to be given. And standard settlement acts as address for delivery of the securities and cash in international trading. So delivery address is an electronic form. So since now most of the transactions is electronic, you do not have to deliver anything at their home address or at their physical address. Everything now gets delivered in the electronic manner. So even when we talk about the banking transaction, ultimately banks also do the transactions in electronic manner. They don't say ki HDFC Bank people will fill the money in the particular bag and then they will deliver that bag of money to the IndusInd Bank next day. That doesn't happen. Everything will happen electronically. So what is the address or what is the standard settlement place? It is nothing but the electronic address. So whatever we are studying here, this is not only applicable in the context of the banking transaction, but later on, whenever you will see even the equity market trade cycle, where we will study basically how the trade verification, settlement, clearing, everything happens. In that case also, most of the things will remain the same. So for example, as I told you, DCC, you will find DCC will be there also. There will be some more additional thing, which is specifically applicable to the equity market, which is not to the banking market, but most of the things will be there also. For instance, brokerage, what is the settlement date, what is the standard settlement address, all this will be mentioned there also. So once you understand this thing, you'll understand that thing also very easily. So right now, for an example, we quoted here in terms of annual basis. Sometimes banks may even quote the interest rate not on annual basis, but they can quote it on a monthly basis. That suppose instead of quoting 12% interest on a per annum, they will say it's 1% per month. So if it is per month, then for month also, how many days you have to take, whether 26 days or 30 days or 31 days, or usually sometimes people will say, even if it is a month of 31 days, we will assume it to be 30 days. So whatever practice you are following, that has to be clearly mentioned for day count convention. So there is uniformity for the calculation of the interest. So I specifically asked you that because that is something which is where some understanding is required. Rest all other things, I think by the name itself, you can understand most of the thing. So there is not much of the explanation required in other activities. Okay, so moving to the next part now, Treasury Bill. Obviously, we discussed T-bill and Treasury Bill, one and the same thing, basically issued by the RBI. Let us see further, something more is given here. So what is given there? T-bills are short-term debt obligations backed by the government. They are sold in denomination of $1,000. We are talking in the context of US market, have a maturity of less than 1 year. That is why we call them as money market instrument, such as a month, 2 month, or 6 month, and issued through a competitive bidding process at a discount from par. Now, some new things are coming here. Issued at a competitive bidding process at a discount from par. So whether Indian market, US market, or any market, basically when we talk about T-bill, it is issued by whom? It is always issued by the central bank. So if we talk about the US market, it would be Fed Reserve. If it is Indian market, it would be RBI. Now, the process of issuing these particular T-bill is through the auction market. When we say bidding process, so where the bidding happens, it happens in the auction market. So basically, we will issue these bonds at an auction, and let us say if the par value in this case as it is given is 1,000. So people will say that basically, let us say we are bidding not at 1,000, but say somebody is bidding at $990, someone is bidding at $980. So whoever will bid at the lowest price, that particular person will become eligible to purchase that particular bond. So basic idea is basically ultimately the difference between the issue price and the difference between the par value ultimately becomes your interest. I just quoted $990. Not necessarily it will be 990. It could be 997. It could be 998. So whatever basically you are quoting the price, that particular price becomes the auction price or the bidding price, and accordingly that particular treasury bills will be sold to that particular person. So I hope this point is clear. So just take a small example. Let us say that somebody has basically purchased a T-bill, say today for at 997. At the end of maturity, let us say it is a 3-month bill. After 3 months, suppose if we go to the RBI and we say that please take this treasury bill return because the maturity has come. So RBI now, instead of paying you 997, they will pay you 1000. So you initially had given 997 to RBI in against that particular T-bill through the auction process, and now you're getting 1000. So the difference between 1000 and 997 is nothing but your interest income that is through which is auction you have come. So basically they're not paying you directly, but through the bidding process, whatever you get it at a lowest price, that ultimately calls for the interest rate of that particular T-bill. That is the basic auction process. Let us see one more point, and you have questions, then we can discuss. This means that rather than paying fixed interest payments like conventional bond, the appreciation of the bond provides the return to the holder. So already I explained you with an example. No fixed interest is being paid. If you can recall, in one of the previous sessions, we discussed about zero coupon bond. If you are still able to recall that concept. So what used to happen? Zero coupon bond, that was ZCB. Ultimately, those bonds were also issued at a discount to its maturity value. So whatever was the maturity, that you will get it. But today you are not purchasing at the maturity value. Today you are purchasing at a discounted price. So the difference between today's price and the maturity price is nothing but your interest, which you are not going to get right now, but you will get it at the time of the maturity. The same thing is applying here also, but we don't call it as zero coupon security. We call it as a T-bill because the transaction is now directly happening with the RBI through the auction process. Yeah, the process is different. The rates are not fixed, but it will be as per the auction. How the people bid in the market, accordingly, we will issue this particular security. And we means it is not you and me, huh? Please remember that thing again and again. All this participation is happening by whom? By the institutional people. So you and me can't buy T-bills, huh? Because you can see the starting when we did this particular module, we discussed that ultimately the participation is from the institutional investors like banks, financial institution, etc., or even the government. So basically, it is for the institutional category. A retail category will not go and participate in the bidding. He do not have that much of financial muscle because here the transactions happening in crores and crores of rupees. So the eligibility criteria would be for institution only.
Let's have a quick quiz question, guys. And the question is, what is one good source of free data? And your options are Thomson Reuters, Friends, Fred, or Warp. Please mention your answers in the comment section below.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.
So now we move to the next part, that is commercial paper. Already briefly I discussed commercial paper, if you can recall. So again, a short-term instrument, but this instrument is basically by a company or by a corporate for short-term raising of money, and it is unsecured in nature. So normally when we talk about the bonds or debenture, they are secured in nature. What do you mean by secured in nature? That ultimately if the company gets defaulted tomorrow or it goes into liquidation, then when the assets of the company are sold, you will also get some amount out of the sale proceeds of those assets. But when we talk about the commercial paper is completely unsecured and it is for the short money market. Let us see what is given here. Unsecured promissory notes for a specific sum due on a specific date are known as commercial paper. The most common type of security in the money market is commercial paper. Large firms issue it to satisfy the need for short-term financing. So basically, I hope this is clear. Compared to T-bill, commercial papers have a greater yield. So what do you mean by greater yield? I always ask you to remember yield word as interest or return. The better word would be return. Whenever the yield comes, the something should reflect in your mind that we are talking about the return. So why we say that basically commercial paper will have a better yield as compared to the T-bill, because T-bill is issued by RBI where we assume that default risk is zero. So obviously you'll get lesser interest rate. In case of commercial paper, it is by the corporate, and that too it is unsecured in nature. There is no security. So it means if there can be a possibility of a default, so it means somebody will ask for a higher interest rate, and higher interest rate implies higher return. So that is why we say that basically the yields on the commercial paper as compared to the yields on a government security or the T-bill would be always higher. And last point is financial institution and banks are among the issuer, but they are also joined by well-regarded domestic and international businesses as well as sovereign issuer, because commercial paper is typically traded in round lots of 1 lakh US dollar. The buyers include mutual funds, banks, insurance firms, and pension fund. So just like we discussed about T-bill, this in this case also, since the ticket size is very big, the entry level size is very big, it is not possible for retail people to participate in chunk. That is why this market is exclusively for the big players like mutual fund, etc., banks, mutual fund, etc. So you can just remember basically 1 lakh dollar. 1 lakh dollar is the basic size of the commercial paper in the US market. I'll just discuss this one and then we'll take a short break. Certificate of deposit. As the name word terminology comes deposit, I hope everybody can easily remember deposit has something to do with the bank. So if the bank wants to raise short-term money, apart from the interbank lending, this is not interbank lending, that is they want to raise money from the public or through some other way, then they may issue a security called certificate of deposit. Again, it would be for a period of less than 1 year. So don't confuse certificate of deposit with fixed deposit. Fixed deposit is where the customer goes to the bank and they will, according to their choice, they will decide what time period they want, how much they want to give. Different people will deploy money for different time period. That is called basically fixed deposit. Certificate of deposit would be a standard thing. Say, for example, any particular bank is saying we are issuing 5,000 rupees certificate of deposit for 1 year or say for 8 months. So it's a standard thing. If you want, it will be for 8 months or 9 months or 10 months, whatever is the tenure of the certificate of deposit. You cannot have your own choice. So that is the basic difference between fixed deposit and certificate of deposit. You can see money market CDs are interest bearing receipt for funds led to a depository institution, usually issued at par and pay interest explicitly. So normally this will be at par only. Suppose if it is 10,000 bond, rupees or dollar, whatever you want to say. So we will pay interest on this 10,000. This 10,000 is nothing but the par value. They are negotiable instrument. Negotiable means that you can give it to any particular person, and whoever is holding that particular instrument, that person will become entitled to receive the interest. So that is called negotiable, or sometimes you also call it as a bearer instrument. That can be sold before maturity, typically issued with a face value of $1 million. So when we talk about the US market, usually in US market, certificate for deposit will be available with a face value of $1 million. That is 1 million is nothing but, how much is 1 million? 10 lakh. Basically, it will be 10 lakhs. So 10 lakh dollar. We are talking about the 10 lakh dollar in the US market. Commercial paper also you can remember it is 1 lakh dollar. And here you can see it is 10 lakh dollar. When we are talking about certificate of deposit, it is 10 lakh dollar. Or you can remember $1 million. What difference between certificate of deposit and term deposit? I hope very easily now you can correlate. CDs are negotiable, but term deposits are not. So what do you mean by term deposit? Whatever FDs basically you open with the bank, that is called term deposit. So can you say that I will sell my FD to another one? No. Your FD only you can encash it. No other one can encash it, or you cannot trade that particular thing. So it is not negotiable. But when we talk about certificate of deposit, that is very much exchangeable, or you can transfer it to another person also. For CD, maturity is only up to 1 year, but for term deposits, maturity is generally more than a year. So not necessary, even term deposits can be for less than 1 year, but usually you will see that people will park their money for longer duration, because higher the duration, higher would be the interest rate. CDs are easy to liquidate before maturity, but the same is difficult with the term deposit. So term deposit, either you will have to lose interest in terms of panel charges, They will charge from bank to bank, it will differ, or else you will have to wait for the time that it matures. Certificate of deposits are traded in secondary market, but term deposits are not. So now you know that fixed deposit, at the most what you can do, you can ultimately just transit with the bank only. That if you want to, what to say, put an end to your FD, or you want to terminate your FD, or you want to premature your FD, in that case, the transaction will be with the bank only. But certificate of deposit, since they are negotiable instrument, they can be easily transferred from one person to person. And in case of the US market, it is possible even to sell them on the secondary market. When we say secondary market, which means basically stock exchange. It is can be also sold on the stock exchange. And last is CDs offer lesser yield, but term deposits offer higher yield, because CDs are for the less duration. That is why the return is less. But usually when we talk about the term deposit, they are for longer duration. So when you lock your money with the bank for longer duration, bank is willing to pay you more interest, because ultimately they can also lend it to some customer which is having the requirement for the long term. So these are the basic differences. The difference is purposely given so that ultimately you should not get confused between the term deposit and the certificate of deposit. If in case some people are not able to understand what is term, you can just understand fixed deposit is nothing but term deposit. We call fixed deposit and term deposit one and the same thing only. Now we discuss capital markets versus money market. So already I think the basic difference is very much clear. That is about the timing of the maturity. Under capital market, trading of financial instrument can be done with maturity of more than 1 year. Risk is more and varied. You know that when we talk about equity market, there is enormous risk. Even if it is a bond market, there will be substantial risk, because you don't know what will happen to the company after 3 year or 5 year. So there is substantial risk. Capital markets deal in long-term capital, and instruments include shares, bonds, etc. Even debentures, if we talk about, that will also come under the capital market category. Under money market, the trading of financial instrument with maturity of less than 1 year, and they are less risky, and they deal in short-term capital. Instruments include T-bill, certificate of deposit, etc. So my very simple question to all of you, since you have a lot of good understanding now about the money market, why money market instruments are less risky as compared to capital market instrument? If I ask you as a layman, if you want to explain me why would I consider that money market instrument is less risky? What would be the logical reason for that? But exception can always be there, because right now when this Silicon Valley Bank defaulted, or when it became bankrupt, so just few days back, there had been lot of good research reports indicating that one should buy Silicon Valley Bank. There were lot many research reports in the market which were painting an optimistic scenario about this bank and other banks which also failed now. So in short term, what is going to happen, nobody can predict precisely. But generally speaking, we say that in short term, there is not going to be significant changes. Thus, changes happen over a long period of time. Moving further now, we come to an end of this part, and now we move to the next part. That is basically foreign exchange. So we will talk about foreign exchange. First thing, something is given to, or what is foreign exchange. I hope that everybody understand what is foreign exchange. That is nothing but we are talking about the foreign currency market. Very first thing, in the entire world, the biggest market or biggest financial market is nothing but foreign exchange market. So it even surpasses the volume of the equity market and the debt market and the gold market or any commodity market. That is the highest traded volume of the foreign currency, because you know, at international level, if any transaction has to take place between any particular country, ultimately it will be in foreign currency only. So there will be changing of foreign currency between the two countries, and that is why we say that the largest volume of transaction which is clogged or which is happens is basically in the foreign currency market. So you can see the foreign, I'm in the third bullet point, the foreign exchange market is the largest financial market in the world, representing more than 5.09 trillion worth of transactions each day, with participants trading 24 by 7 owing to the time zone. It is also the most liquid market in the financial system. So again, you have to remember this part also. This is the most liquid market. Why? Because transactions can happen even at a difference of single paisa, single cent, and that transaction will also happen in crores and crores and millions of transactions. So this is the most liquid market. When at any given point of time, if I want to do a transaction, either buy or sell, I do not have to keep waiting for the buyer or the seller to come up. For every particular point every particular paisa in Indian currency, we can get different buyers and seller. So that is basically we say that it's a highly liquid market. And since the different countries are operating in different time zone, as we say, we are operating in Indian time zone. Some countries operating in EST, that is Eastern time zone. Some will be in Greenwich Mean Time. So because of different time zone, if we see the entire world, ultimately this world becomes 24/7. So might be for some time we are closed, but another time some other country is operating. So if we see the actual foreign currency market, it is basically available 24/7. 24/7 it will be available. So this is the basic introduction about the forex market. Now let us see what are the different elements. First is FX buy. So it means that if somebody wants to buy, basically we call that particular thing or denote that transaction as FX buy. So for example, if it is given buy USD and sell euro. So this is nothing but a buy transaction, because whatever is stated first, that becomes a buy transaction. If you can remember, earlier we discussed one thing which gets applicable in the forex market very much, and that is called bid and ask transaction. So when we say bid transaction, it is nothing but a buying transaction, and whenever we say it is a ask transaction, ASK, we are talking about the selling transaction. So if somebody is buying a foreign currency, it's basically a bid transaction. Second point given is FX sell, selling foreign currency for the domestic currency. So basically, ultimately, buy and sell would be there. So obviously, you are not going to buy your home currency. Suppose if I'm doing a buying, so obviously one thing should come to your mind that basically you are trying to buy the foreign currency. Similarly, if I'm trying to sell the currency, obviously I'm going to sell the foreign currency. And if we say foreign currency, so it will be versus some other currency. It will be my currency or it will be some other country's currency. But the objective is some foreign currency. Cross deal, buying foreign currency for another foreign currency. For example, if I buy Great Britain pound, or you can say sterling pound, and I basically buy Danish krone. This is DKK, means it's of the Danish krone. I think it's of the Dutch country. So basically, in simple word, that whenever you do not do transaction in terms of your own domestic currency, but you do transaction in terms of two foreign currency, then that particular is called as a cross deal transaction. It's called a cross deal transaction. Suppose if I say that I am selling US dollar, so it's against rupee. If I say I am buying UK Great Britain pound, so it basically against rupee. But if I say that basically I want to sell some Great Britain pound and at the same time I want to buy US dollar, so this is not within home currency. This is something to foreign currency. Such kind of a transaction will be termed as a cross deal transaction, or sometimes it is also called as cross currency transaction. Either say cross deal or we will also say cross currency transaction, CCT. In short, we call it as CC, cross currency transaction. Types of FX rate. So now we get two, three things. First is called fixed exchange rate and another will be floating exchange rate. So apart from what you see on the slide, I first give you a basic idea what is fixed and floating. Whenever a particular country fixes the exchange rate for their own currency, that is called fixed exchange rate. For example, suppose if the Indian government says that 1 rupee is equal to say like $2, we have fixed this rate. And irrespective of what happens in the market, based upon macro and micro factor like demand, supply, or unemployment, or trade and business practices, whatever happen, this rate will always be fixed. That 1 rupee is equal to $2, or say like 2 rupees is equal to $1, whatever we want to fix it. This will become a system of fixed exchange rate. When we say floating exchange rate, it will be based upon number of factor which we actually see in the India. That suppose every day if you see on the screen, on the television screen, you will figure it out that today the rupee has depreciated by 10 paisa, or rupee has appreciated by 4 paisa, or over a period of time rupee has depreciated against US dollar by 5%. So this is nothing but we have kept our currency in the floating rate mechanism. If floating means nothing but changing, which is variable, and variable against US dollar, because our currency is principally pegged against the US dollar. If you would have pegged your currency against some other currency, then our floating would be some against other currency. But currently, Indian currency is pegged against the US dollar. So we say that is a floating currency. Let us see what is given in the slide. Government or the central bank of a nation may fix the official exchange rate to the value of gold or to the currency of another nation. So now gone are the days where basically it is fixed against the gold, because earlier they used to fix it against the gold, but now the currencies are fixed against another currency. So if we fix it, officially we fix it, we do not leave it to the market forces, but we voluntarily fix it, then we will say that we are following a fixed system or FX rate, which is basically done in a fixed manner. Further, it is given fixed rates give exporters and importers more security. Why they get more security? For simple reason, because they know that this is the rate. So we do not have to worry that ultimately tomorrow when we actually do the transaction, what amount of money we will receive or what amount of money we will have to pay, because the rate is completely fixed. There is no volatility, there is no change, there is no fluctuation. So for the people who are doing international transaction, either of importing or of exporting the goods and services, in that case, these people will feel super confident because they know that the exchange rate has been crystallized. Further, it is given, last point, a fixed exchange rate system goal is to keep a nation's currency value within a fairly small range. So our objective is there should not be a significant range or not significant change in the home currency value vis-a-vis foreign currency value. And that is why we follow sometimes the fixed exchange rate system also. But again, asking that what in India is followed. So we follow currently the floating exchange rate system. Let me go to the next slide. Floating exchange rate. A floating exchange rate is a type of exchange rate regime in which a country's value is allowed to fluctuate in response to foreign exchange market mechanism. So in India, RBI allow that rupee can get fluctuated. But suppose if the fluctuation is very vast, please listen this carefully. If the fluctuation is very severe, for example, within 2 days, we found that rupee depreciated by 5%. Then in that case, RBI will intervene in the market and they will do certain open market transaction to give some amount of stability to the rupee. So basically, it is called certain open market operation or some artificial transaction, which will ultimately help to curb the volatility of the rupee vis-a-vis dollar. So despite the fact we are saying that we have kept it floating, which means we will allow it to move as per the market direction or as per the demand and supply, but still if it is at extreme level, there is too much of volatility, either in terms of depreciation or in terms of appreciation, then RBI will come into picture and basically they will try to do some open market operation. What do we mean by open market operation? That suppose if we feel the dollar reserves are declining. And because dollar reserves are declining, ultimately the rupee is becoming weak. And why dollar reserves are declining? Because foreign investors are selling in the Indian equity market and they are taking the dollars away. So it means the RBI dollars are getting reduced. So what does the RBI will do? RBI will start buying from the international market US dollar. It will be buying from the international market certain US dollar, whatever it want to buy. Thereby the reserves of the US dollar will increase with our country, and might be after certain point of time, the rupee will get stabilized. Similarly, other way around can also happen, that let us say a rupee is getting not strengthened and that is hurting the exporter. In that situation, might be to certain extent, basically RBI can come into the market and they can sell US dollar. Instead of buying the US dollar, they find that lot of US dollars are coming to India. And that is the reason that now rupee is strengthening, and that is not good in the short term, so much of strength for the exporter. So what does the RBI will do? RBI will sell certain foreign currency, that is US dollar, in the market. Somebody will purchase it, some other country or some particular institution will purchase it. In this way, we try to basically balance out the currency movement when we follow the floating rate system. So this is about the basic discussion about fixed and floating. So first of all, let us say that why actually the rupee starts depreciating against the US dollar, because there is a lot of foreign currency outflow. What is foreign currency? US dollar. So suppose if US dollars are continuously declining, it means the reserves of US dollar is decreasing with the RBI, and therefore the rupee is becoming weak. Let us say it has become weak by 10%. RBI feels this is not a good thing. It is ultimately damaging the economy. We want to restrict this particular fall of the rupee. So what the RBI will do? RBI will come into the market and it will start purchasing US dollar internationally from some other country or some other way. It will start purchasing. We know that ultimately dollar is available for 81 rupee, 82 rupee. So from the open market, the RBI will start purchasing. So once the RBI start purchasing, ultimately ultimately RBI will get certain US dollar reserve. So now if the US dollar reserves are maintained adequately, it means that the rupee slide will stop. The rupee depreciation will stop. So this is way of conducting an open market operation. Through open market operation, ultimately you got the dollar reserve, which was earlier declining. So one way is not to do open market operation. In that way, how it will come? Obviously, people who are working abroad, they will transfer money to the India in dollar, so you'll get US dollar. Foreign institution investors investing in the Indian stock market, so we will get the US dollar. We increase the interest rate for foreign people, and we say that if you park your money in the Indian account, that is in the Indian NRE account or FCNR account, we will pay you this much of interest. So if the interest rate is greater as compared to the US market, people will start bringing US dollar. So these are the some of the way that you attract the dollar. But suppose if the dollar starts going away, it means the reserves will fall. So how the bank or the RBI will manage it? By buying dollars from the open market. So that is called open market transaction. So basically we are pegged a rupee with against a dollar. And when we say that the rupee is depreciating or appreciating, it is not because of the shortage of rupee. It is because of the shortage of the dollar. Only if it is specifically into an agreement with a country that we can pay in rupee, then only it is possible. Otherwise, normally, whatever international transactions happen, it is assumed that it will be settled in dollar. Unless and until you specifically have a, basically with any particular country, you have that particular agreement. So right now, suppose, just for small example, if we want to purchase crude oil from Saudi Arabia. So in Saudi Arabia, we do not have the rupee contract. So we have to make the payment in dollars only. If you pay in rupee, they will not accept it because rupee is not an international currency or currency which is not internationally accepted across the world as dollar is accepted. Let us say Infosys want to receive the payment from the US customer. So they will receive the payment in dollars, not in rupee. We have to convert it into rupee. So most of the transactions for the country which happens is basically in the US dollar. Okay, so now we move to the next part. There are economists who think that in most circumstances, floating exchange rates are preferable to fixed exchange rate. That floating is fixed because ultimately we can control that. And suppose if we talk from foreigners' point of view, if anything is fixed, then whether it is exporter or importer, might be they will feel safe. But then there is no incentive to carry out an international market. That is first thing. The second thing is how can you can fix a particular currency against another currency when a lot of things are changing. For example, might be the size of the economy will change, interest rate differential between the two countries can change, country's economic outlook in terms of basically sovereignty, or we can say bankruptcy, or you can say like default risk, that particular situation can change, demand, unemployment can change. It means multiple macroeconomic factors can change, according to which the currency should also change. So you have seen in the past that many countries' currencies have devalued significantly, but if you keep it fixed, that always our currency will be say like 70 rupees versus US dollar. But suppose if we as a country are doing very miserably, very badly, then we do not deserve to be at 70 rupee. We deserve it to be 150 rupee. And if the US country realizes that we are not following a floating policy, then they may not prefer to invest in India because they know that the worth of the Indian rupee is not 70 now. It should have been now 150 rupee. So that is also one of the biggest challenge, that if you follow a fixed rate of system instead of floating, then might be you will not be able to attract the foreign capital. Foreign capital can be attracted if everything is left to the market forces. Nothing should be basically controlled, or nothing should be superficially handled. That is the basic meaning of that. And that is the reason we follow in India, basically floating exchange rate, where the exchange rate gets automatically adjusted. So in India now, currently, we have moved to completely floating everything. For example, few years back, when we talk about the interest rate. So interest rates, what the banks will charge for savings account and for the fixed deposits for different tenure, everything was fixed by the RBI. But now it is left to the individual bank that what rate you want to charge basically for different periods, for savings account, for deposit or fixed deposit account, it is for the bank. This is called deregulation. It means that interest rates have been deregulated. Earlier, whatever was the crude prices, that is the petrol prices and the oil prices, if that was fixed, whatever used to happen in the international market, whether the price is going up and up and up, we used to pay a fixed price. But now that price has been linked to the international market and subject to certain taxes, etc. So suppose if there is a significant rise in the international crude price, then you will have to also pay higher prices because we are now floated. We have basically, this is called technical words, we call it as administered price mechanism. So basically the price mechanism is completely on a floating basis. The same thing applies to currency also, that ultimately nobody should get into a shocking situation, neither the foreign investor nor the domestic investor. And that is why we have kept the currency at the market level, which is called floating currency. So this is the basic logic behind why do we keep it as floating. So floating is preferable in any circumstances. Even if you see in US market, they follow a system called dollar index. So basically, based upon multiple factors in other country, their dollar index will tell you that what is the current value of the dollar. So value of the dollar vis-a-vis other country and whatever is there, calculation I don't know. So basically, floating is always considered to be better. So whether it is depreciating or appreciating, ultimately the currency will also give you a hint where the country is headed for, whether the country is really doing good or it is doing bad. Because a simple logic is, if the country is doing good, it means you will attract more foreign capital. If more foreign capital will come, it means your local currency, that is your home currency, will appreciate. So that is something linkage is there between the size or the performance of the economy versus the currency movement. And if you keep it fixed, then that particular thing cannot be captured because it's fixed. So whatever is happening in the economy, nothing will get captured in the fixed currency. Rupee versus dollar. How much of dollars daily basis we are getting and how many of dollars is going out of India. That is the relationship between the dollar and the rupee. So now our currency is pegged against US dollar. So everything is basically the currency value, what we say, whether the rupee depreciated or appreciated, it has nothing to do with the price of the gold. It has to do with the price of the US dollar. So price of the US dollar means basically what is the inflow or the outflow of the US dollar in India. That will determine the value of the rupee or the future of the rupee. So let us say that tomorrow the Indian stock market crashes and crashes by say like 30%. So you know that when the market will crash, obviously, so if foreign investors are leaving in India or Indian stock market, obviously what will happen? They will take US dollar. So it means that US dollars are going away. US dollars are declining. So it means ultimately the rupee will become weak. That is the basic thing. So whatever is happening to the Indian rupee, it is all now currently correlated to the US dollar. Currently, in future, there is a chance that ultimately we will slowly isolate ourselves from the US dollar. So currently, India has started moving in that direction, and now we have started doing transactions in rupee with many particular country. We are promoting rupee and we are asking many countries to follow the rupee whenever the trade will be settled in rupee instead of settling in the US dollar. If that happens, then we will require less amount of US dollar and might be over a period of time, either rupee will strengthen or it will depreciate at a lesser rate than what it had been appreciating over so many years. Now we come to the concept called Reserve Currency Board. So what is the meaning of the Reserve Currency Board? I'll explain you again in simple word. Something is given in apostrophe. So if you read it, that's fine. But currently, if we talk about any particular country, basically the management of the foreign currency, the quotation of the foreign currency, open market operation, that is buying and selling the foreign currency to maintain the stability of the home currency, usually lies with the banking regulator, which is RBI in India and Federal Reserve in USA. But suppose if we say that this particular responsibility we want to alienate, we want to dissociate, or we want to keep it separate. We do not want this thing to be done by RBI in India, but we want to do it separately by another board. So that particular board is nothing. We call it as a Reserve Currency Board. So basically, currently, when we talk about RBI, what are the functions of the RBI? To announce the interest rate, to control the inflation, to print the currency, to act as a stabilizer in the economy, to boost employment and other initiatives related to the economy, also to control the currency, to tell the reference rate of the rupee versus many dollar. These are many parts of the RBI. So basically we say, basically when we talk about the monetary part, or monetary supply or monetary policy, the complete role is of the RBI. But suppose if we detach this particular function from RBI and we separately create a particular another function, which is basically handled by another board, which is called Reserve Currency Board, then this particular concept will come into picture. The question is, why does we want to do this? Why do we want to keep it with RBI or with any particular country's regulator? Because might be the regulator is too much involved with other thing, interest rate, or say like funding or liquidity creation or printing of the money, or there is some in US market, there are new terms which is basically quantitative easing or quantitative tightening. That is how much of money we should release in the system or how much of money we should basically suck from the system. All this is part of the monetary policy, which is basically decided by the Monetary Policy Committee of the Fed Reserve. If they say that now currency part we will not deal, so that is separately given to the Reserve Currency Board. Let us see further what is given. Low inflation, economic credibility, and cheaper interest rates are benefits of utilizing a currency board. So when currency board has to be created, when we know that inflation is very low, and now when inflation is low, RBI or the country's basically regulator has nothing to do or deal with the currency part, or they can keep it separately from their routine work, then it will be separated. Further, it is given practically little monetary independence exists since monetary policies prioritize preserving the reserves monetary supply at the expense of other domestic factor. In other words, we can say that basically we want to prioritize other things. We do not want to prioritize the currency movement of the currency crisis, and that is why we have kept all these two things basically altogether different. So in India, let us say we talk about India, do we have a currency board? The answer is no. Currently, RBI handles everything, even the currency movement, open market operation, providing the reference rate. Let us say tomorrow you want to buy US dollar and you want to know what is the rate. So where will you refer the rate? You will not ask someone. You will visit the RBI website to confirm that actually what is the official rate of the rupee. Now, obviously, when you will go into the real market, to say like Cox and King or Thomas Cook or to any bank or authorized dealer. So the price that they will quote, that will be slightly different from this reference price because ultimately the commission part will be involved. So that is the reason basically we have to create the reserve currency board. You can see the central bank, when reserve currency board is created, what happens? The central bank will no longer serve as a lender of last resort, and its ability to conduct monetary policy will be closely constrained to what is permitted by the currency board arrangements banking regulation. It means that certain work will obviously go to the currency board, which can involve not only about the currency printing and the currency management, there can be some other activities also which will go separately to them. So currently in India, we do not have currency board, but now we have one particular committee which is called Monetary Policy Working Committee or Monetary Policy Committee, MPC. Usually we see MPC. So earlier, 2-3 years back, we used to say RBI announced changes in interest rate, but now specifically we say MPC of RBI has announced certain changes in the interest rate. So we do not have the currency board, but we have a separate monetary policy working committee, which will be focusing only about the monetary policy. And what is the monetary policy main role is to, the monetary policy main rate is to basically have a complete say on the economic development, that is economic growth, inflation control, currency movement, and interest rates of the economy. These are the basic things which the monetary policy committee will be looking about. So this is about the reserve currency board. So now we go to the next part now, and you can see features of foreign exchange. So first of all, again, when we talk about foreign exchange, ultimately there is no standard place where these transactions happen, and that is why we say that this particular transaction is also OTC in nature. Now I hope you know what is the meaning of the OTC market. So OTC market is nothing but over the counter market, which is nothing but unofficial market. Unofficial in the sense that between the parties transaction take place, and if one of the parties default, then you have no particular rescue mechanism available. So there is no standard place, but it is, we call it as basically OTC market. We are talking about majority of the part. We are not saying 100% part of the OTC market, but majority of the transactions of currency still happens OTC. Just to give you an example, suppose if you want to buy currency, and you want to buy currency because you want to travel to USA. So where do you buy your currency? Either you go to an authorized dealer or to your tour and travel operator, or you go to the bank. You do not say that I will buy it from, say, like stock exchange or the currency exchange. You will buy from these particular entity. Similarly, when we talk about big corporate who are hedging their future currency agreement, for example, if Infosys basically wants to hedge its currency, that in future, ultimately, whatever happens to the currency market, we should get at least this much of rupees against every dollar. This is called hedging mechanism. So this is also done on a mutual basis. We try to figure out a party in the market and we do this particular transaction with the party. So this kind of a contract is also over the counter contract. So mostly, of course, currency is traded on the exchange. Even in the India market also, you can find that what is the rupee value against a different prominent currency. But the maximum number of transactions that happen in terms of currency market are basically between the party, and that is why we call it as a, you can say, over the counter market. Further, it is mentioned also because bid and ask prices are quoted by participant, it is a quote driven market. So I hope you can recall in the starting we have read quote driven market versus order driven market. So this is called a quote driven market because quotes are there both from the point of view of the buyer and the seller. Bid price is also there and ask price is also there. So this is called as a quote driven market. The foreign exchange market is open from Sunday at 5 p.m. EST. EST is nothing but Eastern Standard Time through Friday to 5 p.m. EST. A 24-hour market exists there. Currency transfers from one bank account to another take place electronically rather than physically. So very important part. Every particular currency transaction internationally which is happening, it is happening electronically. And why it is 24 hours? Just imagine that if somebody wants currency at any given point of time during the night, he's traveling or he wants to buy something. So we cannot say that the currency market is currently closed and we cannot offer you the alternative currency. So currency is certain thing where because the trade is happening 24/7, because of different time zones in different country, ultimately this market has to remain open 24/7. So even in India, price is available 24/7. You can ask any particular person that I want this currency at this particular point. Even if you go to the airport, you will find that 24/7 certain outlets will be open where you can exchange the currency. That is why we say that this particular market is 24/7. Who are the market participant? So first is individual, like you and me, authorized dealer and money changer. So authorized dealer usually are banks. Usually banks are given the license of authorized dealer that they can basically transact in bank. But apart from them, there can be travel and tour operators also. And not necessarily the travel and tour operator means just Cox and King or say like Thomas Co. There are different kind of tour operators which are recognized by government and they can be given that particular license that yes, you can also operate in the foreign currency transaction. So that is called authorized dealer. Central authority, so central government, etc., or even the RBI, international corporations and company, that is any particular company which is doing multinational transaction or transactions at an international level. Commercial banks, obviously, brokerage houses and investment bank. I hope by and large you know what is investment bank also. So investment bank has to deal in foreign currency because most of the transactions happen at an international level. So investment bank can get the money from the foreign client, they can invest that money in the India. They are doing a mergers and acquisition transaction. So obviously one party can be in India, other party can be in USA or in other country. So that is the reason that investment banks will also be dealing with the foreign exchange. So these are the major participants in the foreign exchange market. Now, when we talk about the quotations, the forex, so basically the forex are quoted in two ways. First is called direct quotation, and second is called indirect quotation. Please understand, sometimes people get confused here. Directly, I'm coming to the below part or the bottom part. Then we will study the up part. If we are talking about USD INR is equal to 80, in general, basically I can say that if I read this, what conclusion I can draw? I can say that one US dollar is basically 80 rupees. So suppose if I want to say that how much is $1, so $1 is nothing but we can say 80 rupee. This is something we are talking about the direct quotation. So in simple words, we can say the exchange quotation that gives the price for the domestic currency per unit of the foreign currency. It means for every one foreign currency, what is the value of our currency? That quote is called as direct quotation. Let us say, suppose if I say that I want to know for every US pound, US pound, I'm saying UK pound, for every UK pound, how much rupees I will have to give. So whether I'm asking for the direct quote or I'm asking for an indirect quote, direct quote. So what is the definition of a direct quote? Whenever we are trying to understand that how much local currency we will have to give for 1 unit of foreign currency. That thing is called as direct quote. So just keep in mind, in direct quote, we determine for every 1 unit of foreign currency, how much of local currency will go into that particular transaction. That is direct quote. If this is clear, then basically exactly the opposite will happen in case of an indirect quote. You can see in indirect quote, the next slide, basically what is happening, the exchange quotation that gives the price of foreign currency per unit of domestic currency is known as indirect quotation. Means exactly the opposite will happen. Right now, suppose if I was saying that $1 is equal to 80 rupee. Now the reverse I want that for 1 rupee, how many US dollars I will have to shell out, or basically what is the value of 1 rupee vis-a-vis basically $80. So I know that $1 is 80 rupee, but now I want to know that if somebody comes to in India and they want to purchase 1 rupee, so how much of dollars they will have to pay to get basically 1 rupee? So this is nothing but we are talking about the indirect quotation. So in that particular thing, obviously now you have to divide, which will become basically, you can see here, 1 INR is equal to 0.0125 USD. So if you just spend this much of USD, then you will get basically Indian rupee 1. So this is basically called as an indirect quote. So let us say that I am in US, United States, and I give you a price quotation like this, USD versus GBP. I'm in US country and I give you the quotation USD versus GBP, whether this is a direct quote or an indirect quote. So I'm saying USD oblique, let us say UK pound, or you can say GBP. In UK pound, we can write it as like Great Britain pound. So USD versus GBP, something value is there, whether this is a direct quote or an indirect quote. That whenever we are in a particular country and we are talking from that particular country's perspective, and we are talking about the direct quote. So normally what should come to our mind, that if it's a direct quote, then first, since we are in USA, our USD should come first. Exactly the opposite will happen. It means what? That basically when you are talking about the direct quote from the US economy point of view, as a US citizen, then you will write GBP oblique USD. You will not write USD oblique GBP. You will write GBP oblique USD. It means that basically for 1 Great Britain pound, how much US dollars I will have to pay. And that is what we call it as a direct quote. Because what is the definition of a direct quote? For every 1 unit of foreign currency, how much do I have to pay? That is nothing but we call it as a direct quote. So if I say GBP versus USD, it means for 1 GBP, how much USD I have to pay. So that is basically a direct quote. Exactly opposite will happen. Let us say that if I'm quoting an indirect quote, in indirect quote, the first will come basically our country. In indirect, the first will come our country. So if I am living in USD, it will come USD oblique GBP. Assuming that the another country is Great Britain pound, so we have taken USD oblique GBP. This is a very basic thing. When you get into the forex market and you have to refer the rates, then this is a very basic understanding that should come to your mind. Next slide, what does it is? Non-deliverable forward. What is this non-deliverable forward? So have we discussed futures and forward? Yes or no? So basically forward transaction means that suppose if I try to lock price of any particular currency, not for today, but for a future date, might be after 3 months, 6 months. So that particular transaction is called basically a forward transaction. But we will be talking here about non-deliverable forward. So first understand forward transaction. Again, what is the difference between forward and futures transaction? If the transaction happens on a stock exchange, it's a futures transaction. If the if the transaction happens mutually between the party, then it becomes a forward transaction. So let us say that I entered into a contract with Infosys that after 3 months, for every $1, I will pay you, say like 82 rupees, come what may be the price of the rupee versus dollar. I entered into this transaction with Infosys. So this is basically what kind of a transaction? Forward. Why? Because for a future date, and it is between me and Infosys, not on any stock exchange. So this kind of a transaction is called as a forward transaction. Forward transactions are always between the party and it is not routed through the stock exchange. This is the first part. Now the question is non-deliverable. So what do you mean by non-deliverable? In non-deliverable, after 3 months, I'm not going to pay the currency to the other party, but instead, whatever is the difference in the pricing of the currency, I will only settle that much of amount on that particular date. So suppose if I say that today the rate is say like 82, and let us say that after 3 months the rate becomes 85. So the difference is 82 minus 85, that is 3. And whatever is your total transaction amount involved, let us say that it is $1 lakh. So $1 lakh into 3, I will only pay this much on that particular date. This is called non-deliverable forward. So basically, you have not delivered the currency completely. You have just settled the value, which is profit or loss on a forward date in connection to that transaction. That is called basically a non-deliverable forward. So no delivery. We are not delivering any currency as such. We are just settling the difference in the prices. And this is a forward transaction. That is why we say sometimes as a NDF transaction or non-deliverable forward transaction. Let us see what is given here. Currency that cannot be freely exchanged between two non-domestic counterparty, which cannot be exchanged between two non-domestic counterparty, is known as a non-deliverable forward. Second point, they also go by the name cash settle forward. So for your understanding, you can say that this particular terminology is also known by another name, which is called cash settle forward. And why do we say cash settle? Because as I told you, that instead of exchanging the entire currency, just the difference between today's price and the forward price, that much of transaction we are settling in cash. We will pay to the other party, or the other party will pay to me, and that much of transaction we will settle. That is why we say it's a cash settlement transaction or a cash settled forward. They are mainly currencies with little market liquidity. When this transaction will take place, when we know that there are certain currency where there is not significant market or a matured market for that particular currency, then we will enter into a forward transaction. And last part is major market players can therefore buy and sell NDF currency, but they can only make money or lose money on the deliverable CCY. It means that we have nothing to do with the currency. We are betting on the price movement of the currency for a future date. And whatever would be the outcome, either the profit or the loss, that would be either coming to my pocket or it will be going from the from my pocket. But I'm not going to involve with any particular currency exchange. I'm not settling it in currency. I'm just settling the difference of the profit or loss in the currency. That is called basically non-deliverable forward. So these are the few countries which are given here. These are basically are doing non-deliverable forward in different particular currency. Just for reference purpose, it is mentioned here. So you can just see here. Argentina ARS, South Korea KRW. So even few countries, currencies, even I also don't able to recollect, which is not very prominent. So you can just see few of them. Again, this is just a indicative list. This is not a complete exhaustive list. This is just an indicative list to give you a feel and example that ultimately these are the currencies which are having non-deliverable forwards. Suppose if I say that I have a 1 lakh outstanding amount, and against this 1 lakh US dollar, whatever is the exchange rate that I will make payment to a party after 3 months, means 46 rupee into 1 lakh. 1 lakh is what? The transaction value, or in technical terms, we call it as a notional amount. So notional amount is 1 lakh US dollar, and let us assume that the exchange rate is 80. So if I say that I will deliver 80 into 1 lakh dollar after 3 months to a particular party to settle the trade, whether this particular trade is a non-deliverable forward or it's a deliverable forward. Why? Because you're delivering the complete currency at the prevailing exchange rate at that time. But let us say if I say we will take the notional amount, today the rate is say like 82 rupee. After 3 months, it's say like 85 rupee. The difference would be 3 rupee. So 3 into 1 lakh. I will just pay the difference after 3 months. That will be 3 lakh rupees only. I'm not paying the entire amount. I'm just paying 3 lakh rupees. So that means I have entered into a non-deliverable forward transaction. So in non-deliverable forward, you just have to remember that parties will just exchange the profit or loss between today's spot price and the forward price as the compared to the notional amount. Whatever is the notional amount, it can be $1 lakh, $5 lakh, whatever is the notional amount. Against that particular notional amount, you will do this particular transaction that is called non-deliverable forward. So suppose if I entered into a contract for 85 rupee, so and today's rate is 82. So it is sure that one party will lose and the other party will gain. Might be suppose if I'm gaining, so I will demand from the other party that 3 rupees into 1 lakh pay me that much. If suppose if I'm losing, then I will pay to the other party 3 rupees into 1 lakh. So I am not paying complete 1 lakh into the prevailing rate. Only the difference between today's price and after 3-month price, that much amount only we are settling between the two parties. That is called basically non-deliverable forward. Indigenous bankers means any particular person who is acting like a banker, but officially they are not registered as a banker. It could be like even a money lender. So basically, what does the money lender is doing? It is also lending money to people. So basically, we can say that it's an indigenous banker. So it's not an official banker. Otherwise, we would have called it as a commercial bank or a regional bank. So that is basically the meaning of the indigenous banker. In short, basically all these entities which are in unorganized market, which can basically say that, okay, we are taking deposits from you, we'll pay you interest, or we can give you loan on interest, but there is no regulation as such of these entities, those will come under that particular category.
And lastly, we have interview questions. What are the three financial statements?
What are the three financial statements? First is income statement. The income statement is a financial statement that shows the profitability of the company. It begins with the revenue line and works its way down to net income after various expenses are deducted. The income statement is for a set period of time, such as a quarter or a year. Second is balance sheet. The balance sheet does not cover the entire period, but rather provides a snapshot of the company at a specific point in time, such as the end of the quarter or the year. The total number of assets and liabilities must always equal the total amount of equity and liabilities. Third is cash flow statement. A cash flow statement is a magnified version of the balance sheet's cash account that accounts for the entire period, reconciling the cash balance at the beginning and the end of the period. Next question is, what is the difference between enterprise value and equity value? So enterprise value is the company's overall current value, whereas equity value is the value of the company's shares and loans, which can provide an indication of the company's current and future value. Third question, what is beta and how to calculate beta for a company? The beta of investment security is a measure of its volatility of returns in comparison to the market as a whole. It serves as a risk indicator and is crucial to the capital asset pricing model. A higher beta means a greater risk and higher expected profits for the company. Because 1 is the benchmark for beta, everything above 1 is more variable and carries more inherent risk. Next question, what is the difference between a merger and an acquisition? A merger is a combination of two or more commercial companies to form one joint entity with a new management structure, ownership, and name that capitalizes on its competitive advantage and synergies. In contrast, an acquisition occurs when a financially powerful entity acquires all or a portion of the total shares of a less financially powerful commercial firm. Next, what is DCF? The term discounted cash flow refers to a valuation method that determines the value of an investment based on its expected future cash flows. The purpose of a DCF analysis is to determine the current value of an investment based on projected future earnings. It can assist those deciding whether to acquire a company or buy securities in making the decisions. Discounted cash flow analysis can assist business owners and managers in making operational and capital budget decisions. Next question, how do you value a company? A company can be valued in three ways: comparable company analysis, discounted cash flow analysis, and precedent transaction analysis. First, comparable company analysis. It entails locating companies that are similar to the one under consideration and comparing their EBITDA, stock price, and price to earnings among other variables. Next is DCF. The discounted cash flow analysis uses the amount of money that the company is expected to make in future, discounted to present values. Finally, precedent transaction analysis. Precedent transaction analysis is similar to comparable company analysis, in which you look at how much similar companies have sold in order to determine the value of the company you're valuing. Next question, how do you calculate terminal value? Terminal value is the estimated value of a company after a certain period of time and is a key component of DCF analysis. There are two methods for calculating terminal value. First, the growth in perpetuity method and the exit multiple method. The growth in perpetuity approach assumes that cash flows will grow at a constant rate indefinitely. The exit multiple approach does not assume perpetual growth, but rather examines the net value of a company's assets at a given point in time. It is used to describe a company that will be acquired or liquidated in the future. Next question. When should a company issue debt instead of equity? Because the cost of debt is typically lower than the cost of equity, there are many situations in which issuing debt makes more sense than issuing equity. Issuing debt rather than equity makes sense if the company can benefit from the tax breaks by issuing debt, the company has consistent cash flows and can pay interest. As a result, the WACC is lower, and with more financial leverage, the company can get a better return on investment. Next question. What is the PEG ratio? The PEG ratio is an abbreviation for the price earnings growth ratio, which includes the PE ratio as well as the EPS growth rate of a company. Rapidly growing stocks have higher PEG ratios, whereas conservatively priced stocks have the same PE and PEG ratios. If a company has the same PE and PEG ratio, one could argue that its stocks are overpriced when compared to companies with the same EPS but a lower PE rate. Next question. What is net working capital? Net working capital is the amount of money a company has after paying off all current short-term debts. So it is given by current assets minus current liabilities. So current assets include balance sheet items such as accounts receivable, inventory and prepaid expenses, whereas current liabilities are short-term debts such as accrued expenses, deferred revenue and accounts payable. Now we're going to look at investment banking intermediate interview questions. Starting with the first one, what does negative working capital mean? When a company's existing liabilities exceed its current assets, it has negative working capital. This means that liabilities paid within a year outnumber monetizable working capital during the same time. Buyers frequently regard a target company's negative working capital as negative because it represents the additional capital required to operate the company after the transaction is completed. A buyer prefers a working capital ratio of 1 to 1.5, which means at least $1 in current assets for every $1 in current liabilities. This gives the buyer confidence that the company will be able to meet the seller's and payroll obligations in the short term. Second question, what is the difference between cash-based accounting and accrual accounting? So cash-based accounting records revenue and expenditures only when cash is received or spent. Accrual accounting, on the other hand, records revenue when it is reasonably certain that it will be collected and expenses when they are incurred rather than when cash is actually spent. Because credit cards and lines of credit are so widely used for payment these days, most large organizations use accrual accounting. However, very small businesses may choose to use cash-based accounting to simplify their financial statements. Next question. Two companies are identical except one has debt and the other does not, which will have a greater WACC. The company with no debt will have a higher WACC because debt is less expensive than equity. Debt interest is always tax deductible. Debt is ranked above equity in a company's capital structure, which means that debt holders would be paid first in the event of bankruptcy or liquidation. Contrary to popular belief, debt interest rates are typically lower than equity cost of equity figures, which are typically higher than 10%. As a result, the cost of debt component of WACC will account for a smaller portion of the total than the cost of equity component. Fourth question, give an example in which you encountered a difficult situation while working in a group. So you can frame your answer in a way by saying, during my senior year internship in financial management, I worked in a variety of small groups. Each student had a very busy schedule and I took the initiative to help everyone reprioritize their schedules and find areas to compromise. This aided in the group in balancing workload and work quality. In the same situation, there was a member of the group who was not carrying out his responsibilities, and I contributed to the solution by assisting him in discovering his strengths and allowing him to focus on them while the others filled in the gaps. Next question, what is terminal value and how do you calculate it? So terminal value is the value of a company, project or asset after a period for which future cash flows can be predicted. So terminal value assumes that a company will continue to grow at a certain rate indefinitely after the projected period. The terminal value is calculated using the following formula, where FCF stands for free cash flow for the last forecast period, G stands for terminal growth rate, and D stands for discount rate. Sixth question, how is the balance sheet adjusted in an LBO model? The additional debt is first added to the liabilities and equity sides, and then the shareholders' equity is wiped out and replaced with the maximum equity contribution from the private equity firm. After cash on the assets is adjusted for and any cash is used to fund the transaction, goodwill and other intangibles are used as a plug to make the balance sheet balance. Depending on the transaction, there may be additional implications such as adding capitalized financing costs to the asset side. Moving on to the seventh question, what is the difference between high yield debt and bank debt? Some of the major differences are, high yield debt has a higher interest rate than bank debt. Bank debt interest rates are not fixed like high yield debt rates. They fluctuate based on the Fed interest rate and LIBOR. Maintenance covenants apply to bank debt, whereas incurrence covenants apply to high yield debt. The main difference between the two is that incurrence covenants prohibit you from taking certain actions, whereas maintenance covenants require you to maintain a certain level of financial performance. For example, the debt or EBITDA ratio must always be less than 5 times. And finally, in case of bank debt, the principal must frequently be amortized over time. However, in the case of high yield debt, the entire principal is payable at maturity. Eighth question, determine if an acquisition is accretive or dilutive. So this is an important question whenever a company considers acquisition. Fundamentally, any transaction that increases the buyer's earnings per share is accretive. Any transaction that reduces the buyer's earnings per share is dilutive. So here's a quick rundown of how to respond to this question. Inquire your interviewer if the deal is all stock, and if the transaction is all stock, it is simple to determine whether it is accretive or dilutive. It is accretive if the buyer has a higher PE ratio. It is dilutive if the seller has a higher PE ratio. Ninth question, what is an LBO and what are its value drivers? A leveraged buyout is a debt-financed acquisition, typically a very high percentage of debt. The following are the primary drivers of an LBO's success or failure. First, the cost of acquisition, then the amount of debt used and the debt cost, and finally the anticipated exit price. It is also worth noting that the actions taken by the acquiring firm to increase the exit price of the target business have a significant impact on the success of an LBO. Successful LBOs, for example, typically involve expanding or restructuring the business to increase its value. 10th question, what is the difference between goodwill and other intangible assets? When a company is purchased, a goodwill premium is paid over the fair value of assets. As a result, it is linked to a company or business and cannot be purchased or sold on its own. Other intangible assets such as licenses and patents can be sold and purchased separately. Moving on to investment banking advanced interview questions. Starting with the first question, what is the distinction between capital and operating leases? Operating leases are used for short-term leasing of property and equipment and do not involve any ownership. Operating lease expenses are shown on the income statement. Capital leases are used for long-term items to provide the lessee with ownership rights. They depreciate, require interest payments, and are classified as debt. Second question, explain an IPO valuation for a firm that is about to go public. We only consider comparable public company IPOs as opposed to traditional valuations. We choose comparable public companies, apply the most relevant multiple, and base our estimate of the company's enterprise value on that multiple. We can calculate the equity value by working backwards from the enterprise value. We also consider IPO profits because they are new funds. The price per share is then calculated by dividing the total number of existing and newly issued shares by 100. This is what it means when people say an IPO is valued at. Third question, tell me about major items in shareholders' equity. The first is common stock. The most common type of stock in which most people invest is called common stock, which represents a portion of a company's ownership. Second is retained earnings, the amount of net income that the company has saved up over time. Third is treasury stock. The monetary value of the corporation's shares are purchased. Finally, additional paid in capital. This accounts for the number of new shares issued as a result of employees exercising their stock options as well as the amount of stock based compensation granted. It also considers how much additional money a company receives from an IPO or other equity issuance. Next question, in a DCF, why would we use the mid-year convention? This is because a company's maximum cash flow does not always occur at the end of a fiscal year, but can occur evenly throughout the year. We would use the discount period numbers of 1 for the first year, 2 for the second year, 3 for the third, and so on if there was no mid-year norm. Instead, with the mid-year convention, we use 0.5 for the first year, 1.5 for the second, 2.5 for the third, and so on. Next question, what are your strengths? If you are asked this question, this is one of your best chances to demonstrate why you would make an excellent banker. Your analytical, quantitative skills, communication skills, the ability to learn quickly, detailed orientedness, and ability to work extremely hard are likely to be highlighted. You should be prepared to back up what you say about your strengths with one or two concrete examples from previous jobs or school. Next question. Explain the use of revolver in an LBO model. A revolving credit line is used when you need more money to make your mandatory debt repayments than you have available. The revolver, like credit cards, begins undrawn, which means you don't borrow money and don't accumulate debt unless you need it. Before calculating mandatory and optional debt repayments, add any required revolver borrowing to your running total of cash flow available for debt repayment. You assume that any revolver borrowing from previous years is paid off first with surplus cash flow before any term loans in the actual loan repayments. Seventh question. Why are deferred tax liabilities and deferred tax assets created in the merger and acquisition transactions? These are generated as a result of the writing up and writing down of assets in a transaction, which include both tangible and intangible assets.
Let's have a quick quiz question, guys. And the question is, what is the future value of a fully amortized loan? And your options are 0, the value of the interest only, the principal plus interest, or the outstanding principal. Please mention your answers in the comment section below.
An asset write down generates a deferred tax asset, while an asset write up generates a deferred tax liability. Because of the frequent differences between an asset's fair market value and its book value, which appears on the balance sheet, the asset must be written down and written up. A write up of an asset results in a deferred tax obligation because the new item will have a higher depreciation expense, which means you will pay less in taxes initially but will have to pay them back later, resulting in the liability. For an asset, write down and a deferred tax asset, the inverse is true. Eighth question. How do you approach problem solving in a complex financial scenario? You could answer this question by saying, when faced with a complex financial scenario, I follow a structured approach to problem solving. First, I gather all the relevant information and data. Then I analyze the information to identify the root cause of the problem. Finally, I evaluate various options and make a recommendation based on my analysis. I always ensure that my solution is feasible, practical, and aligns with the client's objectives. Next question. Can you walk us through a recent transaction you've worked on? So you can answer this question by saying something like, yes, I worked on a deal for a company and my responsibilities included conducting due diligence, developing financial models, and negotiating the terms of the transaction with the counterparties. The transaction was completed successfully and it was a valuable learning experience for me. And for the final question, what are some of the examples of non-recurring charges that are reflected in the company's EBIT or EBITDA when reviewing its final statements? First, goodwill detriment, then charges for restructuring and asset depreciation, legal expenses, expenses related to bad debt, accounting procedures are changed, expenses associated with a disaster.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.